Let me begin, of course, by thanking our sponsors, powered by Radico, Spirit of Excellence, Exchange Partner NSC, Banking Partner AU Small Finance Bank, Mutual Fund Partner ABG, Financial Technology Partner Heckyl, Fashion Partner Gabbana, Energy Partner BeOne, and Digital Media Partner Daily Hunt. I'm Abha Bakaya, Senior Editor and Anchor with Business Today Television, and I'll be your host for today. I'd like to begin by the launch of Market Today, and in order to kick things off, I'd like to welcome on stage Rahul Kanwal, News Director, India Today and Aaj Tak, and Executive Director, Business Today. Rahul. Big round of applause, please.
Hello everyone, and welcome to the first Business Today, Market Today Summit. This is a big moment for us at the India Today Group because for 3 decades now, Business Today has been at the forefront of long-form, cutting-edge narrative journalism in this country. Over the last 1 year, our teams have been working very hard as we pivot towards the very exciting space of the financial markets. What you're seeing on your screen are 4,000 plus company pages that have just gone live on Business Today. So for every stock, there are very cutting-edge tools that have been made available to India's growing retail investor audience, and some of the SWOT analysis, the peer comparisons, the technical analysis that are now available on Business Today are really at the cutting edge of design thinking in terms of what the new generation of retail investors would like to see, and hopefully will help them make more informed decisions. So this is a very big moment for us. It's only the first step in this journey. There's a lot more coming up over the next few weeks in terms of company pages, sector pages, index pages, which really the idea is to empower younger, newer investors with the kind of tools which they wouldn't ordinarily have access to on a public platform. The likes of some of our gurus sitting over here most certainly have access to these kind of tools, but we want to make that information coming from a credible platform as readily available. This is balanced, it's technically solid, it's completely bipartisan, it's based on strong fundamental and technical analysis, and we're making it available to all those who are connecting with Business Today across our multiverse. So thank you so much for being here. May I request Ashish Chauhan, our chief guest, to come up on stage, as we have this bell, which I saw in his office actually at the NSE. So it's not as flamboyant and dramatic and big as the bell that you have, Ashish ji, at the NSE, but we thought this is what we have. And can I request Samir to come up on stage as well, Samir Arora, Saurav Majumdar, the editor of Business Today. Can I have Siddharth Zarabi, Managing Editor, Business Today Television. Alok Nair, our Chief Revenue Officer. Can we have them up on stage, please? As you see, it's quite a star cast in terms of the talent that's working on bringing the Markets Today piece live. Abha.
All right, before we ring the bell, we'd like to show you a little bit of a teaser as to what Market Today is all about and what it's going to bring for you.
The men and women who built Indian industry, and the young guns who are shaping tomorrow's India. From storied careers to unicorn dreams.
The equity market is a dynamic space that needs sharper insights and perfect timing.
What stock, what fund, what to pick and what to sell.
How do you make money on the markets? And what are the superior strategies for a winning portfolio?
Your questions answered by 30 years
of undisputed leadership.
Only at the Market Today Summit.
Powered by Radico, Spirit of Excellence. Every single listed Indian company. One financial analytics destination. Capturing the market mood index to technical analysis and trend spotting. Peer comparison. SWOT analysis. Breaking news and much more. India's most new age stock market platform will help you make the right investment decisions. Backed by 3 decades of knowledge and expertise. Market Today Live. Now on businesstoday.in.
Mr. Chauhan, could we request you to say a few words?
Thank you. It's an honor to be here. I think we need more trusted opinions and trusted opinion makers to come to Indian markets. We are struggling with lots of opinions happening through private channels, which are also creating issues. So we need and we encourage more and more such important publications to provide information to public at large. So we are thankful to India Today Group and also Business Today for this initiative and hope more and more will keep on coming. So we have now our old friend Udayan also sitting, and I think he should come up at least to show his face. So we all in a way started television revolution with him in business channels, and now we see him back. Thank you for coming back, and I think all of you have come here to listen to the stalwarts and not me. I mean, in any game, umpire has to be there only for the toss, so I'm there, and of course, I'll be there for the game, but watching and stuff like that, but not for playing. Thank you very much.
Right. Thank you so much, Mr. Chauhan, and thank you so much to all our special guests, as well as the key talent and editorial team at Business Today. We have a star-studded lineup for you, of course, as the summit unfolds today, especially when we're at the cross-section of not really knowing which way the world will turn this year. While India is poised, of course, for multifold growth, will global dynamics play spoil sport? We're already seeing what's being called the tech winter unfolding ahead of us, and will this also lead to other negative impacts and a deepening of recessionary influences across markets? Some of the themes we'll pick up and discuss today. But before we dive in, we'd like to pay tribute to the man who will be well remembered as the ultimate bull and the legend of the stock markets, Rakesh Jhunjhunwala. And one of his last in-person interviews was in fact with us at the India Today conclave. A tribute to him. I'm sure it'll play in just a moment. Yeah. I promise to play this for you again with sound, perhaps during one of the other breaks between sessions. Yeah, we'll replay this for you again. All right, let me welcome our first session this afternoon. It's great to have him here in person. It's somebody...
On Southern soil, who grew into one of India's greatest investors, a perfect Indian idol for millions on the last street.
I do predict. And I'm right sometimes, I'm wrong sometimes. When I'm right, I feel very elated. When I'm wrong, I learn.
A man with the Midas touch. He turned a 5,000 rupee investment into 47,000 crore, picking up the moniker, the big bull along the way.
This is a four-letter word, it's an adjective. So it means different things to different people. Right? But remember one thing, risk, debt, markets, weather, we can all try to predict it, we cannot know it. Only the future will tell us what it is. So what is risk? But I know one thing, that risk is the essence of life. If you don't risk, you're nothing.
He bet on sectors no one else would, finding value when no one else would.
हमारा टाइम आएगा, ऐसे हमारा टाइम आ गया है, अब आ गया है. वो बोलता है ना कि मुहूर्त का समय आ गया हिंदी फिल्म में, कन्या को लाइए, तो हिंदुस्तान का मुहूर्त हो गया.
He often went against the tide, beating the odds in markets and in life, fighting till the end for what he believed in, flying high at the end of his days.
Rakesh Jhunjhunwala soon after his 60th birthday. All right, let's kick off the conversations today. It's somebody that we don't have the pleasure of seeing in person all that often, and today he's right here with us. In fact, both our guests today, Sameer Arora, founder, Helios Capital, in conversation with our global business editor, Udayan Mukherjee.
Hello, ladies and gentlemen. It's nice to be here sitting in front of a markets audience after many, many years in Mumbai. I don't know when was the last time I did something like this, and I almost seem to forget that I did this for a living for so many years. In fact, this morning I was speaking to our speaker, Sameer Arora, over breakfast, and he said, my God, this boy, when I first met him, he was talking about me, he was a real bacha. He was a baby, he said. So I mean, must have been in my early 20s, but yeah, it was a long time ago. And Sameer's been around much longer than I have, and we are old friends, and it's great to have a conversation with him today. Sameer, it's great to see you.
Thank you very much, and good welcome you back to Bombay.
Thank you.
Mumbai.
Mumbai. Well, since you're here, I'm wondering whether you'll tell the audience to begin with that this will be a better year than last year for the stock market. Will it?
For sure, it will be better. And actually, I tweeted on it recently that the rabbit will help you more than the tiger did. And it is very simple, because if you look at the big picture issues affecting the world last year, one was the US market and the US interest rates, and one was maybe China and its policies and everything else that they might have done wrong. Both have gone past their negativity in some sense, and I think both the markets will be flat to up. China is actually already up a lot. And therefore, two external influences which were negative last year, which I think hurt India, are not there. So then we have to create our own negatives, and hopefully we will not create that in this budget by having some capital gains or something. So it should be okay.
You think it's coming? Because this time the noise is louder than last time.
No, actually, I don't think it is louder. I think the strategy is that if you don't have it, then we will all call it a good budget.
That's true. I mean, yeah, they fly a kite before the budget. Yeah. But you don't think that 1 to can become 3 years?
It is such a waste of an opportunity to do that when, first of all, the world, nowhere in the world do foreign investors pay tax anywhere. Like even Indian was to buy stocks in US, there is no tax in US except for tax on dividend. If you buy them in Singapore, Hong Kong, etc., etc. So you make it even tougher for an FII to justify. But the second thing is, we keep saying every day that our GST collections are up, our railway revenue is up, everything is good. Why do we need one more avenue right now to collect extra resources. I don't think it is needed, and I don't think they are doing it.
Okay. Talking about this year, when we started the year, almost everybody seemed to be saying that the first half will be tough, but the second half will be good. Do you agree with that, or is it too much of a consensus
There's
for the market?
too much preciseness, which is not needed. Look at it big picture. In the US, the US market has been negative 2 years in a row, very rarely. In the last 25, 27 years, only once, in 2000 and 2001. Supposedly in the last 100 years, it is negative only 4 times. That 2 consecutive years were negative. So if we look at last year, what was the issue of FII selling, which was in the first half something like $28 billion. It had to be for non-India reasons, because I don't think India did anything specifically bad in the first 6 months last year for us to have a 28 billion outflow. Because in general, foreigners invest. In India, they have only sold net in a calendar year 4 times in the last 20 odd years. And all of our bad years, 2008, 2011, 2018, you could say was India related maybe a little bit, and last year. So one reason would be US interest rates, US inflation, and that is out of the way. And plus minus 2-3 months, the US interest rates would have reached the current target, which is say 5 and 5.25 type. One will be on Feb 1. So in 2-3 months that would be over. The China problem is over. Actually the sad thing has been, which I never imagined, that to get to their rebalance in China, it seems that they are actually taking out money from India, because the flows right now are positive in all of China, Taiwan, Korea, all markets except India. I think that is a little bit of a rebalance, which I never imagined. But I don't think that rebalance that you take out of India to fund other markets, that I don't think is a very longer term thing. So if both those markets are okay, then our external thing is positive to flat, and then we can move on in life.
But sometimes people sell something because it has done well. Do you think that could be India's problem?
I don't agree with that, because last year in absolute the Indian market was flat. So what happened was that China did very badly. Now China did very badly not for random reasons that you don't precisely know. It's like saying 2 companies are going up, and then suddenly after some time you realize that, oh my God, one company's valuation relative to other has gone up a lot, and therefore there will be a mean reversion. But if the second company has fallen because of very specific, some corporate governance issue, some very poor result kind of reason, then you can't say no, they should move in the same band. I think China issues were specifically hurting investors, and all of that cannot be forgotten just because now you'll play a mean reversion. But in the first round, it is happening like that people are playing the rebound. Plus minus a few months, the big new allocators are unlikely to put the same amount in China as they might have been doing before in proportion, as a percentage, as if whatever happened in China was just a 1-year story. So I think it'll be okay in a few weeks plus minus.
If this is going to be a better year than the previous year, is it your expectation that we'll have double-digit returns? Because last year was flattish.
Yeah. So do big picture. So in every 6-7 years, there's one bad year.
Yeah.
That one bad year is not bad only for that year. It takes away the returns of the previous year, and mostly sometimes even the 1 year before that.
3 years.
So you get 4 years of returns in a 7-year cycle. So that means the years in which it is positive on average is more than the 13-14% 7-year average. So when it is up, it has to be up more. Now that part you might be right, that might happen in the second half. Why? Because the US will be keeping these rates for some time. They say 8-9 months, whatever. So maybe by end of year, the US rates will be cut, which also allows India to cut and all that. And if the world is actually relishing a rally, then all that will happen by end of the year, because a few months will be at these high rates, which are not increasing anymore, but are still quite high, the US rates. And therefore, I think end of the year, you might in one spurt get the last 5-7% extra percent to have your overall returns higher than 10% for sure, I think.
So the gains will come in the last quarter?
I'm saying if for the general year, the market is flat to up a little, and then you get something right at the end, that also is acceptable. All we don't like is a minus 10% kind of a year. Plus, we all accept that over time equity markets beat debt by a reasonable number, which is like 5 to 7% per annum, which is basically the equity risk premium, which means what the equity markets deliver relative to government 10-year type bond of that same market. That globally and in India on annualized basis is 5, 6, 7% per annum. So that normally leads us to be 13, 15, 14% type of return, which you can see we have done for the last 25 years, for the last 10 years, for the last 18 years. Why I say 18 years? Because Helios started 18 years ago, so I know exactly what the index has done. Broadly speaking, it is thus 13, 15%. So plus minus a little bit, it'll do the similar amount.
No, what you say is especially important this year because a lot of local investors have this quandary because last year was flat for equities. This year they're saying they'll get 7-8% on fixed deposits. So
yeah, that is true.
Equities have to beat that 2 years running. Will they be able to beat that?
Over time they will beat. If they don't beat it in 1 year, then they will beat it with compound interest in the next year. So you look at 2000, 2001. 2002 was a particularly boring year, flattish kind of a year. It was not a negative year. But after that, from 3 to 7, you got everything back. That part is inviolable that you will make 6-7% more than fixed income over time. Now, if it came every year, it would be too easy. So it can't happen every year as a clockwork. But it happens over time, and there is no reason to say that today India's situation relative to the world has not improved, whether you call it compared to China, compared to Europe, and in general compared to other markets. And therefore, we will get our fair share of foreign flows. That, along with the fact that Indian flows are also good these days, and that there's nothing bad happening otherwise in terms of economy or this thing, yeah, you will make similar returns as you have made in the past.
The other decision a lot of local investors need to make is where do they put their money? Because last couple of years they have invested in some PMSs, mutual funds, but a whole lot of them have struggled to beat the Nifty. Should they just be buying index funds and paying peanuts? And
no, absolutely not. Please don't do that. So the thing
is it a problem? It is getting to be a problem to beat the index.
For 1 year, it has been a problem because the stocks that have gone up last year, we don't buy. Nobody buys Coal India and NTPC except the guy who bought them, but then he underperformed the previous 9 years. So the point is, some of these value type stocks, these are not even real value. These are just beaten up, forgotten, should not have been listed kind of stocks. So if they do well for some time, that doesn't really make that a viable strategy going forward. India is a growth market. See, value can work in many situations, but the main situation is that you should have the ability to take over assets, break up assets, go to court, change managements, force management, just unlocking value in some sense. All that is not possible here and nobody has the energy to do it. So we would stick with our broad thesis that the three big sectors in India are financials, consumer and technology, which is mostly the case everywhere. If you look at the Forbes billionaires list and say from where have these billionaires come, because that is the genuine long-term wealth creation in long-term, all come mostly from financials, tech and consumer.
Yet I believe that you have sold your IT stocks for the first time in life.
I have sold many stocks in my life, but first time I have gone to near zero weight, which worked for the last 7-8 months, didn't work this month.
All gone? Infosys, TCS, everything?
All gone. Because, the thing is that I have 100 rupees. So I can put it here or there. I have not sold India. I have only sold one sector and bought another.
I'm not blaming you. I'm asking you. Because you've been an IT bull for the longest time. I have been all
my life an IT bull, and that is what made me my performance in the 90s. But over time, I realized that the IT guys have only a 2-month lead over me, if at all, in terms of what they can see. Because in 2000, I saw that they kept saying we are getting orders, and nothing happened. And now, when you can see the very visible symbols that even Satya Nadella comes and says that when he said that I'm firing these 12,000 employees That's
Pichai, Sundar
that
Pichai.
are No, not Sundar Pichai. Satya Nadella said Microsoft. that we are seeing slowdown in customers. Just now, I think yesterday or day before. Then the cloud companies, the business software companies, Salesforce, then the cyber security companies, all of them are seeing slowdown. Only one group does not see slowdown, which is the Indian IT companies. And I don't believe it for now.
They are misleading investors, you think?
No, they refuse to talk about the future. They'll say, right now we are not seeing. Because right now you are getting orders based on the current US economy, which is actually doing well. The US Federal Reserve is trying to engineer a slowdown. Correct. Otherwise, currently, of course, the economy was doing well. That is why the inflation was high and the jobs opportunities were high, and therefore the employees were having more job opportunities, therefore they are acting tough and resigning or asking for higher. So this is a little bit ahead, if at all. But I don't think that they're going to massively outperform that. I will feel very bad if I don't have it. Suppose they do well, but they do plus minus similar to what my other stocks, then I'm comfortable not owning them right now. I don't feel that, oh my God, I will regret it so much later, that why I didn't go back. So I'll go back after 6-8 months. Right now, let me enjoy.
Did you ever feel regret about not owning some of these value names which did well this year? No. You did buy State Bank of India.
State Bank we bought in 2020 June. That was a good one, yeah. Others we haven't bought because those we would not even consider buying. I mean, in the sense I would never.
Which are those other than Coal India and NTPC from that?
These are the basic. Who will go to buy them? Not me.
Any of the Adani Group stocks?
We have Adani port.
Only one? None of the others because the float is small?
No. Float for us is okay. They are quite big. It's just that they went up too fast before you could analyze them.
Okay. That's the reason?
That's one of the reasons.
Have you sold any of your financial holdings? Bajaj Finance?
Bajaj Finance, we made 70x, but we sold it.
Fully?
Yeah, and now we can be on the other side sometimes on these stocks, yeah.
Okay. What do you do these days with the short part of your portfolio, the ones which you don't like or you bet on the short side?
So this is one of them.
Bajaj Finance?
Leave it. There are many, but we do 2% in many stocks, in 10 or 10, 12 stocks, or 25, 30% or 40% is in shorts in 10 to 15 stocks of approximately 2% each. Okay. So no one position can kill me, but collectively they work very well. Actually, my outperformance against the index is quite high on the short because every year something or the other is doing quite badly. Now the short names, you're not supposed to talk so much in public.
This is hardly public, very small sliver of public. On this point that you just made, that nothing will kill you, I want to ask you, because a lot of people in this audience and generally begin to wonder what level of diversification they should have in the portfolio. Because a few PMSs have told them that they should have concentrated portfolios of 10 to 15 stocks, and that is the way or recipe for outperformance.
It's a recipe for disaster. I just taped a program with my own team called Dhan Ki Baat, which you can see, but basically proving literally in black and white that even Mr. Buffett's concentration has not worked in the last 25 years. Initially, some might have worked. So the thing is, what we did is we looked every year at his top 10 holdings, which he reports, 10 or 50, whatever are his top holdings, which are in his annual report, and seen their performance versus his own performance. And if he had 20 or 15 stocks which are concentrated, less than 2 or 3 of them even beat the index in any one period. So what that means is that his tail did better. The stocks that were not in the top 10 did better, because it is just simply too much of a random bet that if you are concentrated, so let us say one PMS is concentrated and they have 10 stocks, and then another PMS is concentrated and they have 10 stocks. So if there are 50 people like that who have concentrated on 10 stocks each, unless some stocks are common, that means this group has collectively bet on 500 stocks. Let us say some stocks are common. So that means they are betting on 200-300 stocks. So how can they all do well? So what will happen is that the fund manager who does well will tell you his stories, and the fund manager who does badly will disappear and not be a fund manager. So this is no formula. This is a lottery. It's like I say that if you win a lottery, nobody comes and asks you, can you tell us how you chose the number? And then you'll say, I chose my birthday and then I added my anniversary and then I divided by 3. So everybody will say, oh, good idea, we'll also do the same. It's a lottery, and lottery is not a strategy.
What's the ideal number? I mean, what do you go with? 25, 30
we
stocks?
go with 30 names.
30
in
stocks.
which we go 10 big names and 20 medium cap, callow, whatever, mid cap kind of stocks.
So-
or new names. New means they could be large caps, but they were in trouble and are coming out. For example, if you buy Indian hotels after COVID, now you can't make it a 5-7% position because the hotel is closed. There is no vaccine. There is no idea whether India will get a vaccine. But you still feel like you're buying it for, it's a survivor, it's part of Tata, it's not leverage, whatever. You can't buy 5-7%. But that portfolio of 20 stocks, all the multi-baggers come without your knowing that these will be, but you get a slightly higher proportion than others or the market. And that is how it has been. So I have got, other than some specialty chemical guys, literally every multi-bagger of this country without knowing that it will be a multi-bagger.
But they all
by
started...
buying 2%. Yeah,
2%.
Whether it's Bajaj Finance, HDFC Bank, Kotak Bank, in the new life, Varun Beverages, or kuch bhi, but 2% se hota hai kaam. And then they go up whatever number of times.
What do you do when 2 becomes 10%?
No, we don't let it go to 10 because we are a fund. So new investors are coming in all the time. So 2 also doesn't mean 2 because if a stock is doing well, you can always add a little because now it's your stock. If 2 becomes 2.5 by its performance and you think everything is doing well, okay, then you add it. But day one, I'm not buying 4 of anything. That's the idea. But we won't let it go beyond 4, 5.
Okay. What do you do with some of the old stars that have always done well for you but have disappointed you for 2-3 years? Do you let them go? I'm asking for something like HDFC Bank.
No, it's still our number one holding and it will not be, it will be a star, I think, starting maybe this year.
Have you already seen signs of a pickup again? I mean,
No. You see, it's a technical issue also.
Yeah.
So the thing is that, of course, it's doing well. It's growing 18-19%. And it is very, very cheap. It's 1/3 the valuation of a Bajaj Finance. But the thing is, it's a technical issue. Once HDFC Bank and HDFC merge, we expect, based on these things that people put out, that $5 billion might be the selling just from index funds. Because currently HDFC Bank is not in the index. And HDFC in the index. When they combine, the whole thing will be in the index. Currently, 20% of HDFC Bank is owned by HDFC, which is counted as a foreigner owning it.
Okay.
Because HDFC is viewed as a foreign company. But it's not literally owned by FIIs. So that capacity will be released, you can say. So there are technical also in the case because there's an overhang in the past 2 years that is not in the index. If it is removed from the index, that created extra this thing. I think it is very good. Let's see.
In any of your smaller holdings, did you consider including any of these newly listed digital stocks in 2022 after they crashed 50%?
Yes, we have bought 2 of them.
Which ones?
We bought Zomato and Paytm. Paytm though we bought less than 1 month ago.
But not Nykaa?
No.
Why?
Because Nykaa's business looks more easily doable by others.
Fewer moats.
Yeah, because in the sense that business, I think, can be done by many more and will be done by many more. Whereas Zomato's business, you can't easily replicate, and Paytm also you can't replicate now. And both of them are not making losses, and both of them are $1 billion cash, and they are down. Paytm we bought basically effectively 75% down, but Zomato we bought at this price only 51, and it went up to 70 and has gone back to 51. Let's hope that we go back now because of resignations of their some founders. Let's hope that is. But right now we believe in both that they are worthy of that 2.5% second group bet.
You think it's a possibility they'll go on to become multi-baggers?
Yeah, I think they will become. Or at least they will give me first round 30-50%, then we'll see. Paytm in Davos has in an interview announced that they will break even pre-ESOP ahead of their announcement, of their guidance, which was September. So I think it'll happen in March, because otherwise if it's going to happen in July, then what's the big deal? It's going to happen just like 2-3 months before. So let's see if they do it now.
What do you buy in consumer? You said IT, finance, consumer. What do you like in consumer? What do you own?
Consumer, we own these low-ticket consumer. That means the guy who can go to the mall and QSR, Varun Beverage, we own Lemon Tree, we own Indian Hotels. Basically, the low-ticket middle class. And I am bullish, I hope it works out, that in this budget, if they increase the limit for income tax for the public to whatever, 3.5, 4, 5 lakhs, then they'll all go and eat McDonald's burgers.
Okay.
Or they can have a drink also, Varun Beverage or something they can have. Or even their drink.
No alcoholic beverage.
We don't have currently. We don't have.
Why? Sin stocks?
No.
Nothing else.
Actually, I made a presentation that good people should only buy sin stocks. Because if good people don't buy sin stocks, then bad people will buy sin stocks. And since sin stocks are generally good, that will make bad people stronger. It is better for good people to buy sin stocks, take the profit, and then do whatever charity or whatever donation they want to do. They do good things with it, yeah.
What is the big risk, Samir, going into 2000? We've spoken about good things, what may happen, why markets will go up. What is the one thing which makes you worry at night?
So I still think that the US guys are getting a little bit excited because although the inflation is going down, the target is 2% and not just 6 has become 5.5. So that disappointment can happen. By the way, from tonight the results are coming of Microsoft and all. So we'll see whether, because all those stocks are up, like this year, 20%. Not Microsoft, but most of the other beaten up names are up 20% type number. Okay? Not the big ones, but anything which was beaten up, PayPal and I own the Spotify, all those are up 20%. That's a bit too much, I think, suddenly in like 2 weeks. So if the US doesn't settle, then the problem is Indian interest rates also have to be high. Otherwise our rupee is under attack. So all these things are there. Nothing is straightforward, but in the end we have seen everything. I have seen everything from plague, which you did not remember, in 94. We had a plague also. Then we had US sanctions, nuclear tests, then we had whatever. One government of Mr. Vajpayee lasting 14 days or something. Then we had Kargil, then we had whatever, then we had lockdown, then we had demon. Or sab ghoom phir ke, you make good money. So, it's okay.
It'll work out.
It'll work out in the end. That is what the equity guys are, bullish guys and bulls and optimists. It'll work out in the end. India has got relative advantage. That we did not have before.
True.
And I think India's relative advantage versus China is quite serious now. Because you tell me, if people have just lost money, that means, say, the corporates, I'm saying, a McDonald's or whatever, putting money in Russia and then being asked to mark it down to zero and sell. There is a non-trivial probability that something happens in Taiwan. And even if it doesn't happen, China will never say that I'm not going to do it. They can't ever say that black and white, right? So there is some 10% probability. Now, what does a new guy do? A new FDI guy or who wants a supply chain, he has to little bit diversify away from China. And India is one very reasonable, fair alternative. And we need some of that also. We are not saying make us China. Give us that overflow or that shift in some this thing to us. That's a big advantage, I think.
That will be enough. Samir, always great talking to you.
Thank you
so much for your time. Thank you. And now for our next session, which will come.
Thank you so much. In our next session, we look at India Inc. expectations for this year and beyond. Which direction are things moving in as we head into yet another tumultuous and uncertain year? We have two wonderful speakers joining us from India Inc. today who have an inside view onto how some of the latest developments are being looked at, whether or not we're feeling earthquakes or whether things are starting to get back on solid track. In conversation with Saurav Majumdar, editor Business Today, I'd like to invite on stage Niranjan Hiranandani, co-founder and MD Hiranandani Group, and Dilip G. Piramal, chairman VIP Industries. Welcome, gentlemen, and thank you so much for being with us here today at the Business Today, Market Today Summit.
Global headwinds, inflation, rising interest rates, and generally an era of uncertainty, which we discussed even in the previous session. But now we have two very well-known industrialists with us to give us a sense of essentially where this coming year and beyond is going to, what it's going to look like. There is the first the first milestone is on February 1, which is the last full budget before general elections. So we'll talk a little bit about that. And of course, beyond that, in terms of what the economy is looking like, what are the headwinds essentially which we see, and how India Inc. and the Indian economy can sort of overcome some of those. So I'll start first with Mr. Hiranandani. To give us a broad sense of where you see 2023. We've already talked about, there is a lot of discussion around a possible rebound in China after the last year, and also, of course, global recessionary challenges coming up. In a sector like yours in particular, and in general, as one of the country's foremost industrialists, what do you see as 2023 looking like?
Thank you. It's looks very exciting to me. I think it's very positive too. Look at the numbers that float around. 6.2% as compared to any other Western country, which looks very sad and downwards. The challenges which you see in Europe with the Russia-Ukraine war, where you see a lot of difficulty there. I think overall the sensitivity of the West, which has now almost removed 100,000 people from their jobs as a cumulative number. Somebody said it's 50,000, but even 50,000 for the US in one shot is pretty high. I think all these things definitely indicate an international challenge for all of us across the globe. However, we're seeing some differences in India with the demographics that we have, with the kind of thought process that we have put in terms of geopolitics. I think we have had several wins. Number one win, we were able to get petroleum and gas from Russia. It saved us 35,000 crores as an upfront amount, which was otherwise which would have bought from the open market. I think that made a world of a difference that happened. We have been able to see that our markets itself have remained high internally, both in terms of the stock markets and the other markets in terms of it. Real estate volumes have grown between 15 and 20%, depending on the type of sector that you're looking at. So all in all, we have seen a growth path which has been unprecedented, so in spite of that. And this is in spite of the fact that interest rates have gone up. Home loans have gone up from 6.5% to 8.2% on an average. So obviously those are the headwinds that you talked about. But in spite of that, home finance has gone up 20% across the board. So that's a win that you see blowing in the thing. Second, we thought that COVID would be a negative to home buying. It's been the reverse. People have actually gone in for homes and home loans. In fact, 22 has seen the first time in my career that I've seen that the upper segment of homes has grown faster than the affordable segment. Though, of course, the affordable segment is a much larger segment as the total. But even then, this thing has never happened before, that the growth of the higher segment has grown faster. All these things put together shows us that we've been able to be resilient to the international move, and one of those times where we haven't seen it. As far as tech is concerned, there is a huge concern, and I think that the market sensitivity is also indicating that. However, there are contrarian views, and this is what I would like more than anything else. The contrarian view says really that the moment the West has a problem, they want to offshore more work, because obviously because of the cost arbitrage. And if that is happening, then I think we won't have a problem in the tech sector as much as we would do it. Infra has grown hugely, and that is with 35 kilometers of national highways per day, and the inauguration in Mumbai by the Prime Minister and do it. I think we are seeing a different India completely, more resilient, more there, 6.2%, very positive growth. I'm looking at 2023 with a very positive angle. Yes, I do believe that the budget is going to be very critical for us. We are hoping that in this budget, 1 year before the final budget, which would come next year before the elections, we would be able to see a further positive impact on investments, because that is something which is very badly needed. I know the government is investing. Disinvestment, according to me, has been too slow. I think a faster disinvestment would have definitely helped the market, and the money being used for the purposes of putting up further infrastructure, airports, roads, waterways, ports, all these things put together. There's one number which I want to put down across to you. The logistic costs in India is around 13%. So anything that you buy, 13% is the cost of logistics. Contrary to that, the logistic cost in China is close to 7%. So we have a 6%, China has an arbitrage for every item of goods that it exports or supplies to the local customer. With the national highways, with roads, with transport, airports, all this, if we can bring this 13 down to less than 10 in the next 2 years, that itself will be a 2% GDP growth which will be added to the economy simply because of investments into the infrastructure. Yeah. So very positive.
That's clearly the government's objective also in terms of logistics, like you rightly said. We'll come to details a little bit of the budget a little later. Mr. Piramal, you are in a business which is directly related to the consumer in that sense. What is the sense you get? We talk about India, the domestic market being one of the key strengths which will sort of tide us through these challenges which are global. What is your sense, and how do you see, the kind of headwinds and the kind of way in which we can sort of tide over those challenges, banking on the domestic market?
I am a confirmed optimist, and I have been saying since '92, since the reform started, that there is only one way that India can go, and that is upwards. But I would say now, for the first time in the last 5 years, 6 years since this government has come, that we have never seen an India in this light, and what we have experienced in the last 5 years. And particularly with China now on the decline. China is, people sort of say China economy is finished and all, but that's all rubbish. China is the second largest economy in the world, about 6 times the size of India. So even if China grows at 3% and India grows at 6%, the overall input they have, the growth is much more than what happens in India. But nevertheless, China is on the decline, which is a big change for India, and we are getting that advantage. We have never seen that normally when such a large country, large economy like China goes down, it has an impact on the world because demand goes down. There's such a big part of the buying and selling. But for India, I think it's an advantage because we are mainly buying from China. So we should get things at a slightly cheaper price. Our main imports are either consumer goods from China, consumer and industrial goods from China, and of course, crude oil. So if China demand goes down, then crude oil also relatively it has an impact. And of course, at the moment, even Europe and all are under strain. So this sort of juxtaposition of India with the rest of the world is their problems are not really affecting us so adversely, I feel. But in fact, it is to our advantage. We can take advantage, and especially the low manufacturing industries. I mean, I am in the luggage manufacturing, which is one of the, probably the smallest category of anything. But even there, I mean, China was the world's capital of manufacturing luggage, like so many other consumer goods. Unfortunately, I mean, it's a very labor-intensive industry, but all the once consumer imports were allowed. I mean, a lot of people don't remember that consumer imports were totally banned into India up to the year 2001. So we had to make everything what we sold in India. And so after that, after the imports were relaxed, and now in the initial period, the duties were about 85%, but very soon, within 4 or 5 years, they came down to 10%, which I think was very anti-Indian. I mean, though it benefited me personally, but I was dead against it. That, I mean, it was really killing Indian industry. But anyway, so now luggage manufacture is taking place in India. We have set up a very large factory in Bangladesh for soft luggage because India is still not as competitive as Bangladesh. You know, India manufacturing, unfortunately, at the lowest end, low wage goods, is very poor because our wages are still very high. The minimum wage is about 18,000 rupees. Whereas this industry, most industries at that level, which are not technically, which are sort of labor intensive, would sort of, fair wage would be about 10,000, 12,000, which most Indians are not even earning that much in the unorganized sector. So, coming back to the consumer goods, that the outlook is very good. I mean, especially like I'm in a very extreme industry, which is very badly affected by the COVID. I mean, for the first year, our business was zero because I'm in I make luggage which is dependent on the travel, on travel. So that was virtually nothing. And in fact, now there is a rebound and people are doing that revenge traveling and all that. But then again, we are having a problem because Chinese supplies are not there and there's a problem of supply. So we're not able to meet, just like the hotels and all, and the occupancy is complete. Even airlines are absolutely running at more than 90% occupancy, which is very, I mean, which means that there are a lot of rejections. A lot of times people don't get tickets. Prices are high. And same thing for hotels. But overall, the outlook is very good for the consumer industry. And I think there are very few, I mean, there are some problems, but not too many.
Interesting, Mr. Piramal, that you talked about manufacturing and, you know, how India is still not competitive in that sense with even countries like Bangladesh. But let me come then to the to the whole idea of PLI, which is being seen as a game changer in many cases. I will ask both of you this question, and I'll start with Mr. Hiranandani. PLI is being seen as the government as a game-changing policy. A lot of industry does seem to agree with it. But there is a section which also believes that is there genuine value addition happening in PLI, for instance. Now we talk about electronics having been a major gainer, but that's one. Now there is a view that MSMEs particularly need more help. So, and it's a form of subsidy. So, which is again not a great thing to do. So where do you see the whole PLI debate, and do you think it's really benefiting and can change the game for manufacturing in India?
It was needed. I think it was required. I think it sent the right signals through the world that India wanted to get into the manufacturing side. And actually it has made a difference because all the other. Number two, the states have gone into competition of trying to see that they come to their particular state. And I think it will be absolutely imperative. The next stage of this is, I think, more interesting to see. For example, the semiconductor side. And I think that is going to make a world of a change in terms of how we get into that industry. So very positive, PLI is working. and it's definitely making a difference. Yes, there is a contrarian view. I can even give that contrarian view to you. I can share that with you. We don't see that the investment in PLIs are necessarily in terms of employment generation. So we have a lot of other sectors where we see that if investments came in those sectors, we would get much, much more employment per rupee of subsidy you gave. So for instance, let's take the real estate industry. The number of people employed as a multiplier to the manufacturing industry is only 100 times more per rupee of person or per lakh of people. You will have 100 times more people employed than a factory. And in the good old days, if you had an automobile manufacturing plant, on an average, you'd get 5,000 workers. Today, it's fully automated. You'll get 500 workers. But in a construction, real estate, infrastructure project, you will still get 5,000 workers who are getting it. So it's an employee. So like textiles, tourism, real estate, these are the sectors, infrastructure. In these sectors, the employment is higher. So I think a rupee subsidy there would give you much bigger employment. I'm not against the PLI, I'm for it. But what I'm saying is that they need to equally bounce off that the benefits to be given to other sectors where the employment generation is more, and I think that focus is required. So if you give some small benefits in the real estate sector, for instance, the number of people who would be gainfully employed is going to just increase beyond imagination. And I think that is the kind of, or tourism, for instance, that also I think is a multiplier effect which is unimaginable. We have more tourism tourists going to Dubai than the whole of India. And that's just one city, state. So, and can you imagine the possibilities in India that we have with the number of airports, destination, religious tourism, destination, sun, sea, Himalayas, all the other things combined? I think there are so many sectors which equally require help in terms of it, which are employment generating.
Mr. Pinamal, your sense of PLI, since you spoke about
I think, let me also add, let me expand on the changes that are happening in the last 5 years. I don't want to I'm not at all negative about the manufacturing industry. The only area where manufacturing really suffers, and is probably I don't see any solution to that, is in the low-wage goods industry, because India is a democracy, and I don't see any government changing that policy, and there is too much of pressure. So, but today what has happened is that we are at the bottom of the pit as far as any manufacturing country goes. I mean, there are a lot of African countries which are poorer than us, where the wages might be lower, but they don't have that sort of infrastructure. So if you really go into a manufacturing scenario, you see which are the countries which will compete with us in this low-wage goods sector. Is Bangladesh, Vietnam. Indonesia per capita income is over nearly $3,500, nearly double of ours, slightly less than double. So Indonesia also is in a different league. So there are very few countries, but that is one area where I feel with such a large population, we still, it is, when things went to China, China was poorer than India or as much as India, and look at what they have done, but they are not a democracy, so they can rule that. So PLI is very good. And there is, in fact, I was watching one debate on television where I got some input that the opposition was saying that government has spent so much on subsidies and all that, whereas the government spokesman said that whatever we have spent on subsidies, in 1 year we will earn more than that by taxes and all, even on this Apple and some other things. So there are, and in the beginning you have to subsidize, you have to help. Look at China. How do you think China has grown so much? Because their infrastructure is done at a very low cost, and the amount of money they have spent on infrastructure, why this logistic cost is so low? Because all that investment has been made by the government.
So we are running out of time to both the panelists. I just want to round off this discussion by, in 1 minute, since the budget is upon us, tell me 2 things which you would like the budget to do immediately, so that we get back to the growth path in right earnest. Mr. Hiranandani first.
And the highest marginal rate of tax is on an individual at 42%. It's grossly unfair. So if I'm a sole proprietor, I must become a partnership to make it 35%, and I must make it a limited company to be 25%. I think this arbitrage is too high. I think it needs to be corrected. Number two, you need to focus on things like home loans. You have had the tax deduction at 2 lakhs of rupees 12 years ago. The prices have gone up, and obviously this standard deduction needs to be done, and people are buying, young people, middle-aged, older people, retired people are buying, needs to go up to at least 5 lakhs of rupees in order to make that. And the loan to value, which is 65%, 70% for normal loans, and affordable segment 90%, and the margin between affordable is only 45 lakhs. In Mumbai, you can't get anything at 45 lakhs. I think that loan to value through the RBI, through the central government, I think needs this change. If these things change, the multiplier effect in the economy is huge. And the unfairness of 42% is unbelievable. And nobody is talking about it.
Mr. Piramal, your two wish list.
I fully agree with what Niranjan is saying about the 42%, but I don't think there's any chance in this political scenario. Today you have all these foreign think tanks saying that the rich are becoming richer and the poor are not going anywhere. They say the poor are getting poorer, but which I don't think is correct. But poorer also in India are improving. But one has to live with that. And I would like it if the rate comes down, but I don't see anything. And I think the budget has become a non-event, which is very good. You cannot have reforms every year. You have a tax rate of 25% and manufacturing is even lower than that. So I think, in fact, I don't even bother. Today there's not all that old excitement. Earlier, 30 years ago, they'd scrap one policy, change the name of development repair to investment allowance, and again bring the same old thing. It was all rubbish, So now we have a settled thing. It's like the West. I was a frequent visitor to London, and I was there once on the budget day, and nobody was even aware that the budget has come. It's like one of the routine things, which is a good thing, I feel.
But in India, it's still far away.
Because we are not got out of that habit. But what's happening? There's nothing new. There's no changes in the tax rates, or they're very marginal rates, and then there are all these development activities, but there's nothing substantial, which is very good. You can't go on now. GST also. Yeah. Of course, GST is not part of the budget, but you can't go on changing the. In fact, most of the industrial policies are nowadays outside the budget.
Yes, that's true. So we'll see what the FM does on February 1 and whether it is substantive or it is just one of those things. Thank you very much for your views, and we've just run completely out of time. Thank you very much for being with us.
That was a real express session.
Thank you. Thank you, Saurav. Thank you, guests. Saurav, we're going to have you back on stage. Our next conversation is on private equity investment trends in emerging markets. To take that conversation forward, who better than Manisha Girotra, CEO, Mobilis India, along with Sanjay Mehta, founder and partner, 100x.vc. A big round of applause, everybody.
So just after that session on the economy, we have two very well-known people who know about the private markets, the public markets, and the interplay in between, and also about venture funding, private equity, and how this whole game is sort of playing out over the last couple of years in particular. So without much ado, Manisha, I will start with you. You've been an investment banker for a long time. We've been talking about various trends for many, many years. How do you see the private equity and venture capital sort of scenario playing out in India, in particular in the emerging markets and India, in the face of global headwinds? And we'll come to various aspects of that in a little while.
Thanks, Saurav. Can you hear me? Yeah. Thanks, Saurav. Thanks for having me here. So I think, look, private equity and venture capital has become an integral part of the capital flows into our country in the last 10 years. It really started with the IT services sector as India became the office to the world, I think, and there was very high corporate governance in this company, in these companies, no regulation, no government interference. Basically, they became the darling of the private equity investors. It started from there, and then investors just started to like India more. I don't think that's changing. In 2021, about $65 billion of PE and VC capital came into India. Last year went down to about $45 billion. And don't forget, this is $45 billion when continents like Europe, a large part of Asia got close to zero. So it's still even a country like China barely got any private equity. So I think it's an integral part. It will continue. What's also heartening, and I'm sure we'll talk about it, is the fact that private equity today is able to get exits in India. I remember when I started my career, if there was a private equity investor which invested in an Indian company, we would say, for an exit, oh, let's go to an ADR, let's go to a GDR, or let's find a strategic investor. But today the Indian markets are so deep that you can easily get exits here. So I continue to be very confident that private equity will continue. There are certain sectors they like more than others. As I said, IT services, consumer, they like the whole play on the Indian demographics. But off late, what is heartening to see is that not just private equity, but sovereign wealth funds have come in. The Canadians, the Middle Easterners, putting in very large checks, and they're going across these sectors. They're not just staying in the traditional consumer IT services where exits are very easy, but they're also going into infrastructure, roads, ports, etc. Renewables is a big play. So I think in India, I'm very positive that they'll continue. Emerging markets, I think the countries they like are probably the ones which play the China plus one strategy well, the countries like Taiwan, etc. Beyond that, I think the other countries will struggle because capital is scarce, leverage is scarce, so it will tend to find a home where you can have easy liquidity exits, and that's not too many of them.
Sanjay, you deal with, you are a seed fund. Also, you talk to a lot of these young startups. You mentor many of them, and at 100x.vc, you've sort of funded a lot of them over the last few years. In fact, what is your sense of the funding winter, which is the topic of heated discussion has been over the last 1 year or so? What is your sense, and how are we dealing with it?
I think. Whether funding winter is here or not, but fear is here, right? So everybody is worried about it. People talk about it. I don't see, we have got queues to get vehicles. Automobile is booming, kind of. Malls are thronging. Restaurants, you have to wait. Where's winter? I don't know, right? From a consumer side, we are not seeing.
But
yes.
PEVC funding has gone down significantly.
Yes, definitely. I mean, there are always excesses in the market, right? You will see excesses everywhere, and then it rationalizes, come back. It's a cycle, and when you are operating in this business, you have gone through those multiple cycles. We have seen. In fact, the way we believe is these are the times where the next giants of India will be born, especially in the startup story, right? We'll see across the new unicorns getting germinated in this era. So, I mean, you are not going to, as an investor, you don't miss vintages, right? This is a vintage which you would like to play out, you would like to invest across, create a portfolio, and that's how the whole story works across. You will see on the Series C and D side, yes, the momentum has slowed down. Earlier, we had fear of missing out, which is not there as an investor. We can take our decisions at leisure. In fact, these are the best times where companies can get great talent at a right value. That whole euphoria is off. So, cost of customer acquisition is down because you're not paying to Facebooks and the Googles of the world so much. So, in every aspect, this is great time to build a company and also to invest across. You get great deals. So, I think it's a great. So from a fundraising perspective, lot of that momentum which was there, yes, it has mellowed down in somewhat bit, but investing continues.
So, Manisha, coming to an investment banker's perspective, we've seen some of the storied startups last year really come to grips with reality in a pretty depressing sort of way in the public markets. So this whole private market valuation versus that in the public markets, where people, where the whole, what would I say, innards of the company are known to investors and therefore the valuation, takes a beating. How does an investment banker like you see it? And do you think there was clearly irrational exuberance on the part of even investment bankers who seem to have advised the clients differently?
So you essentially called me here to beat me up, right? No, look, I think there was irrational exuberance. There's no question, right? There was just free money floating around the world, and basically you just have to have an idea and some execution abilities, and you found capital. So many of my colleagues, young colleagues, quit and joined as CFOs. 1 year into working, became CFOs of these companies, and you can see that they lack the experience or the tenacity to go through tough times. What is happening now, I would add to what Sanjay said, is a good outcome. It's led to a lot of pain. Some of the IPOs you mentioned, that people have lost capital. But the outcome is good, because I think now what capital is doing is following the real businesses. You had Dilip Peramal talk earlier. That's a real business. There's cash flows there. There's a real business model there. And capital will now follow that or growth. It won't just follow anyone who has a business idea and barely has any execution abilities. So I think this is a good outcome. Companies which have, which address a large addressable market, have margins, have a path to profitability, are the ones that will be able to come to the market. As far as, private to public, of course, the fact that these IPOs haven't done well creates some sort of hesitation in terms of deployment of capital. But I think private equity, don't forget, sort of looks at a 3 to 5 year horizon. And when they look at a 3 to 5 year horizon, the way our equity markets and the way the flows are coming in from all over, as I said, it's not just the traditional European and US investors, it's the sovereign wealth funds, the pension funds, all coming in. They can see that the depth of the market is improving. And actually, if you speak to a lot of them, they're happier because they're saying capital is now going into stronger business models. So I think this pain is welcome, maybe a bit discomforting in the short term, but in the long term, we'll come out as winners, and the business models which were actually stronger will be the ones that will sustain, just like in every other sector. I mean, why should tech have froth? Every other sector, the winners have taken it all, right? So tech should have a similar outcome and will have a similar outcome.
So Sanjay, you think the global tech meltdown, which took, which really took the whole world and the private equity and VCs globally by, really taken a hit, and therefore the impact was felt in India as well. How do you see that playing out, and how long do you think this whole reset period, if one were to call it that, will last?
So Saurabh, if you look into it, most of these discussions or the news are in the public market, right? Which is more of a secondary market. For us, we at Venture Capital, we do primary investment. We invest in the company. Capital goes to build a company. And when we invest across, we are investing for 5 to 10 years kind of horizon. So the kind of sentiments or the emotions which are flowing in the public markets typically don't flow across while we are investing across for that future, right? We invest on hopes while public markets are working on a quarter to quarter kind of results. So it's a very different temperament in the venture capital side.
But Sanjay, there are large venture capitalists who have also taken a big beating because of the kind of problems they've faced both globally and in India. So the large venture funds, you are talking about, the smaller ticket size, but there are large venture funds who are today struggling, and you keep talking about them, you keep hearing about the biggest names who have really been storied investors in some of the well-known companies which have grown. How do you see that? Also on the PE side, it's also a problem where the limited partners will also be forcing people the private equity funds to take a very hard look at some of the new investments. So do you think it's all that easy for us to say that, it's okay, it will tide over in a bit?
It will tide over, for sure. India at least is insulated from my perspective. I'm very bullish on India, and I would advise anybody betting against India not to kind of do it. But it's all about your, as an investment, it's all about your risk muscle, right? What's your appetite? Where are you seeing across investing? If you are investing, for a long-term basis, India is the only shining piece within the whole world where, you've got so many opportunities happening across. So I'm not at all worried across, even for the large VC guys who are coming at a later stage. Their entry points are phenomenal, and the companies are getting built out. And I'm sure with this signaling which has happened across, the funding winter, the scare which founders have seen across, the fund managers, everybody's alert. Everybody's tightening their belt and trying to see and steer the ship so that the things and the outcome are much, much better across, aligned to possible how the public investors react to the startups kind of stuff. So I'm sure we are quick learners. We'll learn quickly in that sense. And, but there is a mindset with investors, right? Most of them, if you look into it, the fear of loss is more bigger and motivator than, income kind of generating income. So I'm sure these sentiments will correct.
Manisha, you keep having discussions with the largest private equity players who want to come into India. You talked of sovereign wealth funds as well. We recently did a story in Business Today about the dry powder. Globally also, and in India, people are sitting on a large amounts of dry powder but scared to deploy, or maybe hesitant to deploy right now. What is your sense on that?
So I think, if I could just connect to your earlier question also, I think the funding winter, as you call it, I think we're probably seeing the last leg of it. I think the markets have pretty much discounted all of the shocks, hopefully all of the shocks, the supply chain shocks, the war, China's reopening, which is actually a good thing if China reopens, supply chains reopen, demand comes back, exports will improve. So I personally think the second half you should see more capital coming in, you should see people deploying more capital. And through the whole last 6-8 months, to Sanjay's point, you've actually seen sovereign wealth funds, pension funds deploying capital quietly, right? They've actually even gone and bought into some of the listed IPOs that you talked about, which are doing poorly. They've said there's a trade here, there's a rebound trade here to be done. But if you speak to all of them, just given what's happening globally, they see India as the only market which is showing growth. You and I debate and agonize on whether it's 6% or 7%. Don't forget the rest of the world, you're anywhere between -1 to 2.5, right? So, and at a scale, right? We're the 5th largest economy in the world now. So I think you'll see deployment. You're seeing some deployment already. You saw a fund like CPPIB, which basically does minority investments, come and take a large majority stake in Renew Power. So that's how positive people are on renewables in India. India has 100 gigawatts of capacity in renewables. China has 10x of that. China literally puts on that capacity every year. So, things like renewables, etc., deployment has continued consistently. When will it become more wider? I think in the second half, with inflation coming down, rural demand coming back, I think you'll see consumer staples, etc., also see higher demand. So I'm quite confident that you'll continue to see capital come into India in larger volumes and values in the second half.
Sanjay, from your interaction with founders, where do you see most interest in? I mean, despite the fact that there is this whole, let's say, pause in funding, what are the new founders you speak to, the younger lot? Which are the areas where they seem to be bullish about? Tell us a bit about the few sectors you see a lot of action coming up.
So investment trends, in the startup early stage, a lot of innovations are happening in the EV space. So there are basic inputs which people see across. Like today, if you look into it, the industry incentives, the infrastructure which is getting created in EV is propelling the whole industry kind of. And a lot of the innovations are happening in the space. Like for example, challenge with saying that batteries are getting fire or something. So there are new innovative battery technologies which are coming, the battery swapping, the infrastructure charging. So that's one space. Next is generative AI has been a big boom kind of. The AI earlier was very different than what we are seeing now. And with everybody hearing about the chat GPT-3 and, it's like a new brave world which is happening across. And a lot of the new businesses will emerge out of those generative AI kind of working. Then we see across a lot of the gaming kind of businesses which are attracting across, while for a lot of the businesses, gaming remains like a non-touchable kind of stuff, but those are massive businesses which are getting created in that space. So, tech is still continuing to take the lead in that sense. And D2C brands have been really emerging. It is like threatening the existing incumbents in that sense, I would say, across a good amount of corporates. I mean, we work with a couple of corporates who are deploying large amounts of capital to get access to those startups, right? They want to be in that, having that seat on the table, see those category defining businesses very near. In healthcare, digital health, a lot of people are...
You're talking about family offices also?
Family offices, definitely, but those were more financial. Corporate venture capital is all about strategic, right? Saying that I would like to be part of those future businesses which will get created. While internal innovation is limited, how do I get those startups to work with the corporate? And that is which is driving quite a lot of significant capital also outside of the traditional VC fund. So a couple of our portfolio companies, we have got corporates who are our shareholders who are on the same cap table. So corporates are having a lot of interest in startups.
You talked about gaming, Sanjay. I must say, I mean, you've been one of the very early proponents of the crypto craze in India and otherwise as well. You've been a great advocate of the crypto space. Now, recently at another summit of Business Today's, we had the governor of Reserve Bank making it very clear once again that he is in favor of a total ban on crypto because he says that there is no underlying asset. Now, what's your sense of where the whole crypto world in India and in the emerging markets will be playing out?
Just on the Saturday, we had our 100x VC pitch day. We announced 4 deals in the Web3 space. So, I mean, people have a misnomer. In that sense, I wouldn't say anything against the regulator. But the idea is this space needs more regulation than ever before. More people are joining. It's better to have a regulation. Like, for example, people talk about FTX. Now, that was a challenge because there was no regulation. Assuming an exchange having the ownership of an asset, why don't you have a custodian outside? Like no exchanges hold across the asset. The FTX wouldn't have happened. So today in India, if you have a custodian and the exchange, which are crypto exchanges which are separate, things will never happen across. So today we have got taxes or TDS on doing a trade. A lot of the Indian investors floated their digital assets on FTX. There is no respite, right? So I mean, various things, if the space will get regulated, it will just boom kind of stuff. So hopefully regulators take a cognizant of this space and see the kind of momentum which is coming across. It will have to regulate it some.
But in India, you don't see it completely dying down over the next few years.
It's impossible.
Yeah.
You can't stop,
you
right?
You need regulation is basically...
That's it. That's the only way how you can build the Web3 or at least manage, be party to it, right? Government themselves have started with their own digital currency, right? And it will evolve across. And we have seen every new areas, right? We never had an e-commerce regulations. Now we have an e-commerce regulation. We never had for Uber, Ola, transport. Some of the instances happen, government comes with a regulation, right? It is always, innovation will always lead it. And then the regulation will follow across. So that's how I see it.
True. Manisha, I'll split my question into two. One is, which are the areas where you see PEs and sovereign wealth funds coming in and, really looking at, particularly in India, which are the sectors you see them really getting interested in, number one? And number two is, do you see, as IPOs also get withdrawn, many of these IPOs which were planned are waiting, some of them have been called off. Do you see that because of PE exits, do you see a lot of consolidation also coming up in the next couple of years maybe?
Yeah, I think, look, with the IPO market getting a little lukewarm, definitely, there are more opportunities for private equity. There were a lot of consumer, retail opportunities, tech, which basically became unsustainable for a private equity to invest in. Today, all those companies are back at the table talking to them. So that will be something that the PEs will definitely get more active on. I think, as I said before, 2023, private equity will play a much more active role just because of what's happening in the public markets. Exit is not a concern for any of them. sectors, basically consumer, pharma, whatever plays on the Indian demographics is something that's very attractive. I think what we've done sort of in the last few years is the structural reforms that India has undertaken. We've used technology as such an inclusive tool that we basically integrated Bharat with India. So, you've got 60% of rural India, which basically now through e-commerce, etc., is integrated into the mainstream. Then, you have disruptive technologies like you have ONDC, OCEN. The OCEN will lead to, more disruption with banks, traditional banks. You'll basically have cash flow lending. So that will lead to different fintech models. ONDC will lead to more sellers and buyers coming onto the more formal platform. So all of these, brands which you and I don't even know about through rural India will get capital because, they have such access and reach and distribution. We hear about a lot of large cap multinationals saying growth is slowing down in rural India. When I talk to people in rural India, they say that's because, let's say a Tata Salt is replaced by a very domestic brand which you and I haven't even heard of. And that's now getting such scale, governance around it because of certain VCs going in, that you will see capital follow there too. So, much wider capital flows will come in, much deeper capital flows will come in, but I think they will definitely follow cash flows. I think the days of just following an idea and just top line and, companies which were just racing to get that growth number because we were all getting valuations which were a multiple to sales, those days are gone. Where's the EBITDA? Where's the cash flow? Where's the earnings? That's the mantra now.
Do you also see some of these IPO plans coming back but in a much more realistic valuation level?
Absolutely. Not just as IPOs, you may just see reverse mergers into listed companies. You may see consolidation into large caps. A lot of the tech companies, as you've seen, the large caps in India, the traditional companies are integrating with them, Reliance, Tatas, Birlas, etc., leading. Because, also online and offline need to be combined for the last mile connectivity. So you'll see mergers. You may see mergers into listed companies. You may see mergers of scale. And then come back into the public markets with a more sensible, scaled-up idea. So definitely, I don't see people saying, look, nobody's throwing the baby out with the bathwater. People are saying, come back with a sensible business model with valuations linked to EBITDA, and then there is a positive outcome.
You agree, Sanjay, that the valuation, craze has now completely gone, and now we will be witnessing a stage of much more realistic valuations overall?
See, as an investor, you change colors continuously. Right? If you say that, okay, I'll be doing this only, and you have no market, right? So, as an investor, you change positions as the market changes its, color kind of, and you align to it. And that's where things are happening across, where the sentiments were bullish, people were able to price, at a different level. Today, the founders understand, the investors understand, and they price it at a much different level. But the underlying thesis of saying that are investors or retail investors interested in new age companies, I would definitely say yes. Look at the kind of numbers what a TV show is getting. Like, it's now touching to what IPL was. It's crazy. It's unbelievable the way people are viewing that. It's a reality show, but the way it is being accepted and people are talking across, including, a lot of those guys who never understood how startups work, suddenly come up to us and ask across, is this how you behave? No, we don't behave like that, kind of in doing a transaction. So it's unbelievable. India, everybody is now looking upon startups and new age company with a much different lens.
We are running out of time, Manisha. I think I'll just ask this question to both of you, but first to you, Manisha. This also brings us to this whole issue of governance. I mean, that's been a recurring theme over the last 1.5 years in terms of the kind of tremendous unfortunate incidents we've seen in some of the storied startups. I don't want to get into names, but we all know who they are. What is your sense? Are startup founders, private equity, venture capitalists getting much more, tough on these, and what is the way out? Do you think there needs to be a solution of some sort coming together where the funders come together and insist on some kinds of, sort of checklist before they put in money in terms of these companies?
So sort of exactly, the answer is in your question. Basically, a lot of the investors have got together and they're forcing governance around the founders, forcing professional management teams, a lot of the CFOs, CEO, divorcing the role of the founder from the CEO, having proper accounting firms. I think all of that's being done, and I know of a lot of my clients who are investors who are basically coming together and saying, look, these outcomes have to be forced on the founder, because what was right for the company in the first stage. And always it's not just a governance issue. It's the issue is that what's right for the company in the first stage, the founder doesn't evolve the company into the next stage where you need a deeper management team. So, what seems as governance to outside is basically because the founder is holding on too tight, and the company's basically gone beyond the founder. And I think we, as Indians, didn't actually force these kind of outcomes. We don't have activist investors like the US has, where even the large caps, the CEOs get thrown out by these activists.
It's happening, but not too much.
Happening, but not too much. I mean, US and Europe, it's a big business, right? Activism. It's not the case here, but it's happening now. Maybe not as aggressively as in the US, but definitely investors are very clear that they are not going to have the kind of tolerance that has happened in the last 2 years, where the founder basically convinced them that he's invincible and to the company, and without him the business model doesn't exist. I think everyone's moved beyond that threshold.
Sanjay, you see founders becoming wiser now after the hits of last time? I mean, hits in a negative sense?
So I wouldn't put founders in that bucket, because most of them have good intentions. A lot of the circumstances with the board members and stuff, I would take that responsibility where ethics and governance has to be part of the board and driven through that kind of. So I would take it one level up in terms of how active the board is, right? How actively you are working with the founder. And if you have the right questions, definitely founders will align kind of stuff. So ethics and governance has to be part of the board, and it's more responsibility coming to investor, we as an investor, to drive that whole ethics into the mind of the founder and or the founding team per se.
Let's hope that wiser sense prevails, and we are again back to seeing startups doing well and new age companies in India doing well, and the funding coming back in good form. Thank you very much for this lovely session. Thank you.
Thank you, Manisha. Thank you, Sanjay. And thank you, Saurav. In conversation with Siddharth Zarabi, Managing Editor, Business Today Television, I'd like to announce our next set of guests. And it gives me great pleasure to welcome some of the biggest names in stock markets when it comes to the Indian markets. Nilesh Shah, MD and CEO, Kotak Mahindra AMC. Vijay Chandok, MD and CEO, ICICI Securities. Basant Maheshwari, investor and author, The Thoughtful Investor. And Dheeraj Reddy, MD and CEO, HDFC Securities. A power-packed panel, and these are eminent speakers whom we often go to for insight and guidance and anything that will help us understand better how to strategize in equity markets. So this promises to be a fantastic conversation. Siddharth, over to you.
Good afternoon. A very warm welcome to this fantastic panel. I am personally very happy to be moderating this stellar panel. Nilesh Shah, MD and CEO of Kotak Mahindra AMC. Vijay Chandok, MD and CEO of ICICI Securities. Dheeraj Reddy, MD and CEO of HDFC Securities. And Basant Maheshwari, a thoughtful investor who invests and writes. Glad to have you on the stage here. The big question that I want to start today's afternoon with is, how does one become Rakesh Jhunjhunwala? How does one become Warren Buffett? Because this is a question that a lot of the new age entrants, the retail investor, asks, and the topic of our session is the coming of age of the retail investor in India. Almost 106 million demat accounts, 15-year high participation as far as retail investors are concerned in stocks. So how does one become Rakesh Jhunjhunwala or Warren Buffett? Nilesh, I'm starting with you.
सिद्धार्थ भाई, अगर मुझे मालूम होता तो मैं बन जाता ना, आपको थोड़ी बताता.
That's a good one. The same question, Vijay, to you, and then I go across the panel on the same topic.
Okay, that's a serious question.
Yes, that's a serious one.
So I wish I knew. But, you know, from whatever I've heard and observed, I think people like him and other very successful investors have got some traits which kind of cut across. I think one of them is their ability to take risk, identify trends ahead of others, stick to their conviction, have patience. At least some of these traits they have displayed, but I still don't think that really makes up the man.
Okay.
There's so much more than that.
So much more than that. Dheeraj, the same question to you.
I'll add to what Vijay said. I think
if you could keep the mic closer. Yeah.
Other than what Vijay said, I think the passion and having a heart and soul for the investment and wealth creation is something, a start point. I think after that you have to build it over a period of time by acquiring knowledge on a regular intervals and making learning as part of the essence of the investing. I think that's something will add to, while, you know, it's very difficult to emulate Rakesh Jhunjhunwala or Warren Buffett, but you can get closer to that with these traits.
Basanji, just to follow up on Dheeraj, for those two people, even if we get 0.1% closer to them, most of us in the hall, we will consider ourselves through. Go ahead.
Yeah. So I think Rakesh Jhunjhunwala, if you want to be one, no financial planner will ever advise you to do what you should do to become Rakesh Jhunjhunwala. First is you have to have intelligence, passion, excessive risk-taking ability, and huge leverage. So the moment you think of leverage, people will say, "Arey pagal hai, mar jayega." So that's how you start. Warren Buffett is more of an, I think, entrepreneur than an investor. He manages people, he manages money rather. So that is possible. But and plus for Rakesh Jhunjhunwala, you need the roll of dice to fall in your favor. That's more important.
Nileshji, I'm coming to you because many of the questions that we routinely get asked, and you are also routinely asked, is about comparing 2022 versus 2023 from an outlook perspective as far as the retail investor is concerned. This story is very well known, how millions of Indians have taken to investing, but as 2022 taught them, there is a downside also. So to address that big sort of fear in the room, how does a retail investor in the Indian markets protect the downside that is likely?
So the only way to protect downside is through asset allocation. You follow your asset allocation strategy, take risk what you can manage, buy when things are cheaper and sell when things are expensive. सिद्धार्थ भाई, ये सब बोलने में बहुत easy है, करने में जान निकल जाता है. And maybe I'll take a minute to put the lighter side and then leave it to others for serious side. There is this couplet in Mahabharata where Krishna Bhagavan goes to Duryodhan before the beginning of the epic battle and says that, why are you fighting? They are your brothers, give 5 villages. And Duryodhan doesn't agree. Krishna is Bhagavan and yet he can't convince Duryodhan. Duryodhan replies to Krishna after a lot of persuasion, Janami dharmam nachme pravrutti, Janami adharmam nachme nivrutti. Oh Lord Krishna, please don't tell me what is dharma, what is right. I know everything, but I can't follow it. And don't teach me what is wrong, what is adharma. I know it fully well, but I can't desist from it. So हम सब में एक दुर्योधन आज भी छिपा है. वो कहता है कोला मत पियो, जंक फूड मत खाओ, बट हम लोग उसको फॉलो नहीं करते. Same thing is in finance. Everyone knows the 3 mantra of regular investment, long-term investment, discipline, asset allocation. बट वो दुर्योधन पे काबू कैसे लाए? सो जब तक दुर्योधन पे काबू नहीं आएगा तब तक आपकी वेल्थ जर्नी ऐसे ही रहेगी.
That's a good one, Nileshji, because I think for the next time this is a lesson to us. We should perhaps also do a session with spiritual gurus to avoid the Duryodhan when it comes to investment. Vijay, how does one avoid Duryodhan? Because the point that Basant also made, and all of you have said, intelligence and passion. If I were to take up only those things, intelligence is something that you are perhaps born with, passion is something that you can develop. And if one lacks these, is he ruled out of the markets?
So, actually, if you see the current context and look at the bunch of investors who are coming, so first and foremost, I must tell you, they are very, very smart guys. They're young, very smart guys, and they're coming from not just the top city, but Bharat. Second, they are pretty well read. I think what is unique about these youngsters coming to the market is, I think technology, digital stuff that's been happening over the last few years has given them access. They are, I don't think, there's something called cosmopolitan. If there's a cosmopolitan, world cosmopolitans, I think these guys may be coming from a small town, but they would know what's happening globally. Very well connected through various social channels. So they are not necessarily they have access to data, information, research, content, processed outcomes. So, I mean, if you don't have the intelligence to do it yourself, there is someone who's really able to do that. So that access and availability is there. And when we've seen this behavior this time of investors, I would observe that, yes, there is pain, but there's no panic. And I think one of the reasons why I would say that there is pain but no panic is because I think leverage, and I think Basant mentioned that earlier, leverage in the market relatively, at least in the retail side, is very, very low. And when there is low leverage, there is a relative panic doesn't creep in. So in the sense, I would just add that information is available, research is available, not very difficult for them to access, even if you don't have that intelligence. You can access it. It's pretty, lots of tools have come. That's another way of, dealing with.
That's a very good point, the role of technology, because 20 years back, I don't know how many people would recall here the process of opening a demat account. And now look at the process of onboarding on a demat account. Look at the kind of velocity of transactions that you can do using your smartphone. A lot of people of the newer generation that you spoke about do that. Dheeraj, I want to come to you and pick up the point about the difference in the retail investor this time around, because the market, one of the truisms is that the market is full of cycles, and we see cyclical investors also. Of the active users on NSE, we have seen a slight drop in October, but it's the 5th consecutive month drop from June. It's the last data that we have is only 36 million. Is that indicative of retail investor interest peaking because of the ongoing volatility, or is it something else?
I don't think so. It's peaking yet, because the retail investors are signing up more and more demat accounts. So we are seeing good inflow of new customer sign up across the industry. So I don't think so it has peaked up. I think in last 5-6 months we've seen less active monthly users as compared to 1.17 crore what we had in as peak customers, and now it's somewhere close to 89 lakh customers in the December or November 2022. So it's just about little bit correction in terms of monthly active users, but we are seeing good and more interest into the markets. What Nilesh mentioned, that when other asset classes like debt or gold become attractive, some bit of shift happens to these kind of asset classes also. And also when there is more volatility, some of the investors take their own time to participate in the market and they get a little bit more calibrated. But having said that, the financialization of savings as a trend is just on the cusp of even further exponential growth.
What sort of ideal equity allocation or a basket would you propose at this time? Debt versus equity versus other assets?
Siddharth, this is a very generic question, and there's no one-size-fit-all answer to this question. This depends on the age, risk appetite, and understanding of various financial instruments. So one has to really do this for an individual investor and not a ballpark number. But the most important thing, what Nilesh has also highlighted, that we should not undermine the importance of asset allocation and stick to that asset allocation discipline. So in any investment process, there are 3 steps. One is decision, second is execution, third is tracking. So one has to not only decide which asset classes are suitable at the time of the investment, then of course execute the same, and then on a continual interval one has to track that how the portfolio is performing, whether their asset allocation is right and is aligned to the market conditions or not. So it's a process. There's no one-size-all-fits solution that is available that I can recommend.
That's a wonderful answer. Yeah, Nilesh, please.
सी आपने ट्रेडर के लिए, ट्रेडिंग के लिए, इन्वेस्टर के लिए पूछा था कि इन्वेस्टर साइक्लिकल होता है क्या? बट इन्वेस्टर इज नेवर साइक्लिकल. इन्वेस्टर इज लॉन्ग टर्म. एक बार चालू किया जिंदगी भर करता रहेगा. ट्रेडिंग इज सीजनल. वो आता है, पैसा खोता है, फिर निकल जाता है, फिर उसका रिलेटिव आता है, वो भी पैसा खोता है, वो भी निकल जाता है. सो ट्रेडिंग इज सीजनल. इन्वेस्टमेंट इज लॉन्ग टर्म. ट्रेडिंग इज लाइक फ्लर्टिंग. इन्वेस्टमेंट इज लाइक शादी. 7 जन्म तक आप इन्वेस्टिंग ही करते रहेंगे.
That's a good one. Can I do a quick follow-up before I go to Bazar? Nilesh, to you itself. The sort of broader question, therefore, should one invest looking at price, or should you invest in a company and ignore price?
So, there is a philosophy, buy at any price. It is called BAP. Then there is a philosophy which is growth at reasonable price. That is CARP. Then there is a philosophy which is growth philosophy. Then there is philosophy called value. So there are many things. There is no one way to nirvana. You have to do what you think is appropriate.
आप अपने भगवान को पूजिए जैसे भी पूजना चाहते हैं.
Precisely. But investing करना, trading मत करना. Trading is a very, very hard way to make money. India's
and an easy way to lose money.
Oh, for 99% of the people, it is a way to lose money. And on trading, I'll say just one thing. India's best known trader is Radhakishan Damani ji. वो फ्लेम इंस्टीट्यूट पूना में थे, तो किसी ने पूछा कि सर मैं आपके जैसा ट्रेडर बनना चाहता हूँ, कैसे बनूँ? तो उन्होंने बड़े प्यार से कहा कि देख बेटा, मैंने अपने बच्चों के लिए ना डीमार्ट खोला है, उनको भी ट्रेडिंग नहीं करा रहा हूँ, अब तू रहने देना भैया.
Basanji, I'm coming to you, and the question is more to sort of get your view on what happened in 2022. We saw post-COVID a wave of people coming in, घर पे बैठे थे, extra time था, work from home था, and for many people there was no work either in office or home. They were laid off, and we saw this surge. And they entered new age companies. The panel has told us that technology, the ability to buy at a button, greater information. There are, several dozen registered entities and several thousand unregistered Telegram, WhatsApp channels who keep offering you all manner of tips and guidance. But a lot of retail investors have burnt their hands very badly. New age IPOs is one example. Have they learnt lessons, or is 2023 likely to continue to teach these new age investors harsh lessons of investing?
I think losing money in the first couple of years of your entering market is normal. It's like breathing in and breathing out. We all lose money, then only we learn. If you don't lose money, you will not learn. But what has happened in 2022, 2021, 2020, courtesy WhatsApp, Twitter, Telegram, and all those quick communication channels is the cycles have become compressed. So everyone wants to get out of the same door. Everyone wants to come in through the same door. आप मीडिया में आपको जो पता चलेगा मैक्सिमम 5-7 मिनट के लैग के बाद मुझे भी पता चल जाएगा. आज से 20 साल पहले जो आपको पता चलता था मेरे को पता चलते चलते तो बेयर मार्केट बॉटम होके ऊपर होने लग जाता था. So the compression of the cycle first, and secondly, on the previous thing, I think these newcomers have got a lot of intelligence. They want to read, they want to understand. What they really lack is experience. And that is why when they hear of recession and Amazon putting 18,000 people off the job, वो पहले आके शेयर बेचते हैं. कि अब तो रिसेशन आ गया, खत्म हो गया. फिर उनको लगता है नहीं फेड शायद इतना काटेगा नहीं, फिर वो खरीदते हैं बिकॉज दे डोंट हैव एक्सपीरियंस. सो व्हाट दे रीड, व्हाट दे हियर, दैट इज व्हाट दे परफॉर्म. एंड स्टॉक मार्केट आई थिंक इज as much experience, as much psychology understanding as it is about intelligence. So the negative part for this new age group from our perspective, from a general markets perspective, is they've compressed the cycles, and secondly the volatility has increased through the roof because हर 2 मिनट पे बेचना है, हर 2 मिनट पे लेना है.
So is the risk appetite different for this current crop of investors?
No, they have no risk. वो 2 लाख की सैलरी में से 20-25 हजार रुपए डालते हैं, पुट खरीद के चले जाते हैं, घर वापस आ जाते हैं. रिस्क तो हम लोग के लिए बनाते हैं वो, जो हमारी सारी संपत्ति लगी है स्क्रीन पे. वो तो 20,000 का पुट लेते हैं और वो पुट बिक गया, कर गया, हो गया. They are playing play with Lotto basically, most of them, and which is good for brokerage companies actually.
बारात में खुश होके जो ज्यादा फायरिंग करता है, that is the kind of risk that you're talking about.
I just want to make one additional comment. Lots of tools have come. And these tools enable you to enter into a trade with locked in appetite of risk. So you know that's the max you can lose is X amount. You lock that amount in and you hit the trade. Tech and analytics, combination research, all that has made it possible to make these things. So I mean to say that these guys have lost their shirt, maybe a little taking it too far. I think there's pain, but there's no panic.
Okay, there's pain, there is no panic. And since we sort of agree as a panel on that, Nilesh, I'm coming to you. And we started this conversation, it's the same question really in a different way. Therefore, how does a retail investor in the Indian markets in 2023 try to generate alpha?
Okay. So, alpha is relative to the benchmark index. Your benchmark index could be much higher versus mine versus which is. So please first find what is your risk appetite. If you didn't buy during March 20 correction, that means you are not an aggressive investor, you are conservative investor. So, आज बोलना बहुत इजी है कि मैं तो एग्रेसिव इन्वेस्टर हूँ. भैया मार्च 20 में जब अपॉर्चुनिटी तब आपने नहीं खरीदा तो यू आर नॉट एग्रेसिव.
तब मगर डीमैट अकाउंट भी नहीं था मेरे पास, मैंने सोचा नहीं था, बाद में पता लगा, भेड़ चाल हो गई.
सर अब पेनल्टी गोल मिलता है तो वहीं पे फायर करना पड़ता है. आप ये बोलो मेरी स्टिक अच्छी नहीं है, बॉल ठीक नहीं था, वो गोलकीपर रेडी नहीं था, बस वो तो अपॉर्चुनिटी गई. सो वन, प्लीज बी ऑनेस्ट टू योरसेल्फ. Are you conservative investor, aggressive investor, average investor, whatever it is? Second, what is your investment objective? Everyone wants to make money, but making money is like birbal ke khichdi. उसमें time लगता है पकने को. As Warren Buffett mentioned, so someone asked Warren Buffett कि भैया आपके लिए तो इतनी सारी किताबें लिख दी है लोगों ने, तो is there any secret left out? तो he said, no, there is no secret left out. मैं जो करता हूँ सबको मालूम है. So then how come other people have not become like Warren Buffett? So he says, my style of making money is very, very slow. People don't have patience. So be clear why you are investing. Making money is not the reason you are investing. You have some objective. And then based on your risk appetite and objective, try to build a portfolio. Some fixed income, some equity, some real estate, some gold, some offshore assets. That portfolio should give you real return. Compound karte raho, eventually you will make money. Now in 2023, for equity market, it is more like buy on dips market. If you look at from a fair value point of view, with the caveat that market does not necessarily always trade at fair value. In bullish sentiment, it will be above fair value. In bearish sentiment, it will be below fair value. But from a fair value point of view, the entry level of Nifty in 2023 and exit level of Nifty in 2023 should be similar. We expect Nifty EPS to be about 1,000 rupee anywhere in calendar year 24, but more towards December 24 than Jan 24. So 18 times 1 year forward, 18,000 Nifty looks like a reasonable fair value number. So if markets are going to enter and exit at almost similar level, you have to make money either by picking up right stocks or by buying on the correction. But be clear about your risk appetite, have your investment goals defined, and follow a disciplined asset allocation. ये 3 कर दिया तो 2023 में आपकी नैया किनारे उतरेगी.
2023 में नैया किनारे उतरेगी. Vijay, the role of discipline And these are like fundamental questions because the approach is what really matters. That is what all of you are saying. What is the key ingredient when it comes to investment discipline according to you?
Yeah, I think impatience plays a very big role there. The impatience that people have takes them away from discipline. The desire to make a quick return, a quick buck is so deeply ingrained in human behavior that the moment you see any kind of an adverse movement to your starting theses, you start becoming nervous and come out. Now let me just give you a small instance of what happened in the current year. We all talk about mutual funds, SIPs doing extremely well. But if you were to double click into this, a few quarters back, SIP was in the ballpark of about 10,000 crores a month. Today it's about 13,000 crores a month. And when you double click and look at the number of folios that were actually contributing to a 10,000 crore monthly run rate versus a 13,000 current monthly run rate, you will find a very interesting insight there. The number of folios have actually come down in relative numbers. What it seems to suggest is that the smaller retail investor has sort of got a little worried about tepid performance or an adverse performance or a market correction, and he's just stopped investing. The more seasoned, heavy duty investor has actually increased allocation. So this clearly points out to the fact that discipline, I mean the systematic investment discipline, if it doesn't match with your theses, there is nervousness. So I think, the point that was highlighted by Nilesh, that you've got to first understand your objective, understand your risk appetite, commit yourself to that risk appetite, commit yourself to your objective, and then stay completely resolute to the process rather than getting very nervous with every reaction that happens in the market. You have to understand market will show its colors of ups and downs, and you've got to take it in your stride.
Absolutely. Taking it in the stride is very important. Dheeraj, whenever the economy is a bit tricky, investors take a mode of, it's either flight or fight kind of mode. The economy is a bit tricky, more so globally than in India. The message for the Indian economy is far more robust, and if you take a medium to long-term view, even better. Does a tricky economy, in your view, make for a good time to invest?
If this question is in the context of if this question is in the context of retail investors, my answer to that is that retail investors do not pay so much cognizance to the macro environment. They are more focused on the bottom-up opportunities. And that's where they are spending more time, particularly Gen Z, millennials. They are spending more time in spotting the opportunities. And Basant mentioned that the information arbitrage that was there with the institutional investors is no more their privilege. And now through the social media, the access of information is available in fraction of minutes to all investors. That's where they are looking forward to the bottom-up opportunities. So they are not paying so much cognizance to the macro environment. More so, if at all there is discussion, it's all discussion in the more dinner get-togethers and more intellectuals conversations and nothing more than that. We are seeing that there is enhanced interest of the retail investor in the markets, and that get reflected through the number of folios, number of investors that are participating in the markets. Vijay just mentioned about the number of folios. Let me add that few data point to that. Today we have in the mutual fund industry almost 14.8 crore folios. This number used to be somewhere close to 10 crore a year and a half ago. So it's moved to almost 40%. What we have seen in the kind of accumulated number in the last 25, 30 years. So that's the kind of pace we are seeing. And with the growing awareness, I think the people are increasing their ticket sizes in the investment also. So retail investors per se have demonstrated more resilience than I think even the more institutional investors.
Okay. Basant, on the same point with a slightly sort of added question, does it also mean that domestic institutions have now sort of finally come of age vis-a-vis foreign institutions in being participants and in a way holding up the markets?
Yeah, absolutely. Because 2008, I think the foreigners sold about 70,000 crores and the market fell 60%. And this time we've just held it on. But I have a different view on this. I think domestic institutions, and Nilesh Bhai is at the forefront of it, ये बाजार बचाते हैं, ये बाजार बनाते नहीं है, ये सर्किट मार के नहीं लेते हैं. सर्किट मार के FII लेता है. 5% ऊपर, 10% ऊपर ले लो. So, domestic institutions give you a very cushion, a shock absorber effect, and that is because it's the retail guy who puts in money on behalf of so many of them. But I think on a longer context, 1 saal, 2 saal, 3 saal, moment people figure out that gold is only a dollar asset. Basically, if dollar goes up 3.5% every year against the rupee, that's what you're going to make in gold over the very long period of time, because इतना inflation आ गया, सोना का दाम तो उस हिसाब से कुछ बढ़ा ही नहीं actually if you look at it. So I think the shift will come, and they will come, and the domestic institutions are there for us. But I think the domestic guys saved us this time compared to 2008, 2009. At that time, I mean, the markets were falling 9 pins and nobody knew what's happening. But this time the support is there. And now think of it that once the Fed starts cutting rates, now we can debate whether it's 6 months, 1 year, 2 years. And once the FIIs come to buy stocks, share कहाँ है यहाँ पे?
शेयर का नीलेश जी, आत्मनिर्भर मार्केट्स, भारत आत्मनिर्भर है, आत्मनिर्भर मैन्युफैक्चरिंग कर रहे हैं, इसलिए मार्केट्स भी आत्मनिर्भर हो गए इंडिया के.
So one, it's not that we are against foreign portfolio investors. If share price goes up, they'll make money, we will make money. So the bread is buttered for us on the same side. We are not on opposite side. Second, as Basant Bhai mentioned, we also invest to make money. Now in March 20, FPIs were coming and telling the broker, 10 lakh Reliance बेचना है. They were not putting price limit. वो broker हमें phone करता था, सर 2 लाख Reliance बेचना है, लेना है. हमें भी उसकी बातों पे से लगता था कि नहीं बॉस, ये तो टेंटेटिव है. तो बोला 50,000 ले सकते हैं, बट थोड़ा नीचे मिलेगा तो देखेंगे. Now we were able to play a kabaddi match with foreign portfolio investors, and because they had not put price limit, we could bring markets down and continue to buy. जब उनकी selling अटक गई, market bounced back. But come October 21, those guys had also become smarter. Now they were saying 10 lakh Reliance बेचना है, but at this price. So it's a game of kabaddi. Sometimes they win, sometimes we win, but both of us are playing on the same side.
But कबड्डी खेल तो इंडिया का है ना.
हाँ, so hopefully हम उनकी टांग खींचने में थोड़े ज़्यादा माहिर होंगे because they don't know this game as well. But there is a big fundamental change happening in market. And this is kudos to mutual fund distributors who have highlighted this buying on correction, SIP kind of values to investors. Earlier, whenever there was correction, we used to do conference call and go out to meet investors and say that there is correction, don't worry. Now when there is correction, they call us saying, Nilesh bhai, डरना मत, हम लोग पैसे भेज रहे, खरीदते रहना. So game itna change ho gaya hai. And you look at the behavior from March 20, in a rising market, it is SIP of 10, 12, 13,000 crore minus redemptions. So I have to invest only 1,000, 2,000, 3,000 crore in a rising market. In a falling market, it is SIP plus subscription. So 13,000 crore plus 10,000 crore, 23,000 crore. This is the first time in life when I'm getting money when I want to buy, and I'm getting less money when I'm not that much interested in buying. This is all thanks to mutual fund distributors who have popularized this concept of SIP, regular investment, buy on correction, SIP top up. And as long as this maturity with investors and distributors is there, I think we will continue to play a role of shock absorber in FPI.
A round of applause for the distributors, because, you know, they are hardly celebrated. They are the real backbone of the industry. Vijay, you wanted to come in on this point? Dheeraj, both. Yes, absolutely. That's fine.
I just wanted to add, you know, to respond to both the observations. Shock absorber currently, yes, but just imagine. I don't think too many people imagined that this would have been possible. You know, when FIIs are selling, markets are holding, as a concept probably has happened for the first time in our living experience. If the momentum continues the way it is continuing, and there are no reasons to say it should not, and the structural undertone is pretty strong, I think it's a matter of time where even the domestics will probably start punching in a way that, they start creating the circuits. Basant said that is not yet seen. Like he said, they need the money at the point in time when the markets are up. I think that scenario will evolve. It's a matter of time before it happens.
Just one quick point, Dheeraj, before you come in on this. Vijay, how much of this would you attribute to greater trust that your industry has managed to create? Because I'm looking back when I started, you used to see headlines around a scam. I broke one scam story, and one doesn't get to do that at all. The markets have improved, technology, Aadhaar, everything is practically at a touch of a button. KYC is wonderful, video KYC. Many countries, advanced economies can't even dream of doing all of that. How much of trust is also responsible for this?
No, pretty much. I think this is a game of trust. As long as people believe that, their hard-earned money is that is getting put to work is in safe sort of zone, they will continue to put money, and I think the regulatory sort of mechanism that has continuously kept evolving over the years is to be complimented for, achieving this kind of an outcome. Systematically, we've seen, number of regulations coming under two themes. One is, what are the bunch of things that we can do to prevent mis-selling? I think all the incenting to mis-selling has been systematically eliminated. And the whole set of regulations that have come have ensured that mis-selling is, tending to zero, literally. And second is, what can I do to reduce systemic risk? So a bunch of regulations which have come, which have ensured that the money in motion, so to speak, and the securities in motion are moving through safe quarters. And, you don't suddenly figure out that while the money is in motion, suddenly disappears in between, or securities in motion disappears in between, particularly in a digital world. And plus, I think a bunch of regulations on the funds itself, what kind of discipline is to be instilled. It's on the one side, it may sound pretty onerous for the fund, but I think it is ensured that the trust factor, which is the core fabric of continuous supply, keeps getting built.
The same question to Dheeraj, and maybe if you could also dwell for the benefit of our viewers and audience here on the role of taxation also to keep the sector alive and kicking.
Before I talk about taxation, let me just add few more enablers to what Vijay mentioned and you mentioned, the trust. I think other than the trust, there are enablers like efficiency. And just to substantiate my point, tomorrow onwards, I think 27th onwards, we will be moving to T+1 settlement. Other than the China, we will be the second large country in the world to move to T+1 settlement, which will make markets more and more efficient also. So trust, efficiency, and also ease of doing business. I think these are big enablers that has added more confidence for the investors and participation of the investors. I think we need risk capital for sure as in India to grow to next level. For that, we need to incentivize the taxation on equities for sure. I am strongly in favor of having a better taxation for equities and particularly long-term capital gains, because we pay STT already at the time of executing the transaction. It's a double taxation. It makes no sense to have a long-term capital gain tax on this thing. And it wasn't there. It was introduced very recently again. So that's something I think in the business today, Vijay has covered very nicely on taxation. I would recommend everyone to read that article, and I completely endorse the recommendations made by Vijay. So I think there is a need for us to re-look at the taxation and make equity as more attractive investable option, and particularly make it at par with the insurance and other instruments also.
Basanji, I'll come to you because in the remaining 10 minutes I want to take one broad theme. But Nilesh, on the issue of tax policy, just a couple of months back, one of the senior most finance ministry officials told us, and we reported that as well, that the thinking in the government is that there shouldn't be any arbitrage. And then there was detail into how there is differential tax treatment. There is the likelihood of a sort of policy approach being announced rather than a step being announced in the budget in a few days from now. Regardless of what is done, what do you personally see should be done in the medium term?
So we believe there should be level playing field. A person should not be taking an investment decision based on the tax concession offered. Let the choice be on a zero arbitrage level playing field. But on capital gain tax, I want to recommend Finance Minister to plug the loopholes. I am a retired chartered accountant because I have never practiced in my life. But despite that, I can think of 4 or 5 things in which tax is being lost. So the first one is people convert interest income into capital gain through listed zero coupon debentures. This is 1 lakh crore market. At 10% interest conversion and 25% tax arbitrage, that's 2,500 crore for given. All you need to pass is a regulation that debenture is debenture and whatever they pay should be treated as interest, and you can't convert that into capital gain. The second thing is ULIP arbitrage. When you switch in my debt scheme to equity scheme back to another equity scheme or debt scheme, you pay tax at every level. In ULIP, you don't pay tax till maturity. It's a 6 lakh crore industry. Assuming 30% switch is 1,80,000 crore. Assuming 10% income on that, 18,000 crore. Assuming 20% taxation rate, 3,600 crore. The third thing is related to different maturities. In equity, 1 year becomes long-term capital gain. Now, how can you say long-term is 1 year in equity? We talk about 5 year and 7 year. Real estate is 2 year. Debenture is 3 year. Mutual fund is 3 year. Can we have just one standard definition of long-term? If you do that, what is considered short-term capital gain, what is today long-term will become short-term and you will get higher taxes. Then there is STT. We are probably the only country which doesn't differentiate between trading and investing. We have same STT for delivery versus in FNO. Now we must remember that there is no future in future and option for most of the ordinary traders. So why can't we increase STT on FNO so that there is some amount of deterrence, and let there be lesser STT on cash delivery? Yes. Finally, there is a cottage industry called SME exchange. वहाँ पे आपका पूरा capital gain का tax planning होता है. You can know what will be the price of SME stocks after 1 year. Now, these are all the loopholes which needs to be plugged. And this is coming from a person who hasn't practiced accountancy in his life. Now, imagine all the other chartered accountants, how many loopholes they'll be able to plug. Perhaps I can guarantee that they'll raise more capital gain by listening to them than increasing the rate.
Well, there's clearly a nice suggestion from you, and maybe a separate chapter in the finance bill on capital markets taxation. The indication seems to be that some sort of policy approach will come through. But as we are in the last 5-6 minutes of the conversation, Basanji, I'm coming to you. The search for stock ideas. I'm sure whenever you are in an airport or a hotel or even maybe somewhere else, you are asked, "Sab ek idea de dijiye." I don't want ideas, but for the newbie investor who has so much more information available than was 10, 20, 30 years back, what does the search for stock ideas involve?
I mean, for a new guy who's starting, he should not try and find the next Bajaj Finance, the next Ultratech, and the next Infosys, because wo next hota nahi hai, that's another wo cliche hai, but more often than not, he can figure it out, but wo exit nahi milega, wo sab abhimanyu ban jate hain udhar. So even, I can say it's not a recommendation, it's just for illustration purposes. आप 4 stock ले लीजिए. One is Kotak Bank, Nilesh ji wouldn't recommend on that. आप अल्ट्राटेक ले लीजिए, आप बजाज फाइनेंस ले लीजिए, आप डीमार्ट मत लीजिए क्योंकि पी बहुत ही एस्ट्रोनॉमिकली ज्यादा है. ये 3 स्टॉक आप सारी दुनिया का सारे अपना पैसा डाल के सो जाइए और सोचिए कि अब आप किसी को बोलेंगे तो ही वुड से अगर अल्ट्राटेक बंद हो गया, तो अगर बजाज फाइनेंस बंद हो गया तो आपके घर के आगे आप निकल नहीं पाओगे, पुलिस लगी रहेगी. So these are such companies which you can buy and hold and still make 14, 15, 16% CAGR. You don't need any mutual fund, you don't need any PMS, you don't need any investor, you don't need any Rakesh Jhunjhunwala, but you will not become a Rakesh Jhunjhunwala. That's the problem. So these are basic big ticket investments which anybody can do and everybody should do, but वो करते नहीं है. वो अगर कोफोर्ज में काम करेगा तो वो सोचेगा मैं फर्स्ट सोर्स देख लूं जरा कैसा है. वो अगर कहीं और काम करेगा तो कुछ और देखेगा. So I mean, a dentist will look at cement companies and a cement company will look at probably biotech companies. तो ये problem है. But big ticket investing, because 99% people, Siddharth, in this market come here to beat bank FD and inflation. बट उनको पता नहीं चलता करते करते कि वो कर क्या रहे हैं. उनका टारगेट होता है बैंक एफडी बीट करना, तभी वो मार्केट में आए हैं. बट वंस यू एंटर द मार्केट, देन यू वांट टू डबल इट अप इन 6 months. It doesn't happen, and that's why we lose money. And just one final point, I would say, what has really changed in the social thing last 25 years. So when I started investing 30 years back in college, in Calcutta, I don't know how the thing was in Bombay and other parts of Gujarat. So if you told anybody कि मैं stock market में हूँ, करता हूँ थोड़ा बहुत, they would look at you with contempt. तू शेयर बाजार करता है. But things have changed now because people can discuss stock markets in parties with elders, with youngsters, with friends, with relatives, with newcomers, with strangers, and nobody frowns and says, what? You are in the stock market? But 30 years back, if you were in the stock market, it was a perfect recipe for someone to walk up to your dad and say, तेरा पैसा संभाल के रखना इससे.
हमारा देश बदल रहा है. Dheeraj, the same point to you, and then Vijay, and then finally Nilesh.
I think there are easy names that are available, like Vasant said, but other than that, passive funds is a better opportunity. If you do not understand the market, just invest into the index fund, ETFs, and that's the best way to do it. If you get a regular income, SIP. If you have a lump sum money, put it into liquid funds and do an STP, that will work for you. These are easy and simple formulas for wealth creation. But as Vasant said, that people do not follow simple, easy, proven formulas. They try to be a superheroes or superwomen, and that's where they end up losing a lot of money.
Vijay.
Yeah, I think this year is going to be a slightly difficult year for equities. I think there was a mention of where we believe Nifty could go. Our house views, we probably would see a slight increase in Nifty by the end of this year. Closer to maybe 20,000. So nothing much really at a headline level. But the themes that we believe could be interesting for the year would be, in our view, discretionary consumption. That is one theme that we like as a house. Banks, private banks, as a theme we like. Some internet companies have been values have corrected very sharply, so there could be interesting finds there. And capex related manufacturing, that's another theme that we could find some good up. But this is something which looks topical just now. This obviously needs to keep getting evaluated through the course.
I'm glad you mentioned internet companies, because Vijay Shekhar Sharma just a few days back at Davos told us, I was interviewing him, that they will turn profitable in September. That was the first time that he's spoken about that. Nilesh, as we wind down, this same final question to you also for your perspective.
So my recommendation is that just follow the process, be a long-term investor, be a regular investor, and please, please, please have disciplined asset allocation. And if you can't do this, then there is a product called asset allocator fund. Our asset allocator fund is up about 4 times in 10 years. If you haven't multiplied your wealth like that, then just accept the thing humbly and invest in asset allocation fund. Let the fund manager manage your money.
Can I end this by saying that what you have said, if I describe it in my words, lalach buri bala hai.
लालच बुरी बला है, वो तो सिद्धार्थ बात सही है, बट उससे भी बड़ी एक बुरी बला है, वो भय है. It is not just the greed, it is also the fear. And ऐसा नहीं है कि हमें डर नहीं लगता, हमें 30 साल मार्केट में निकालने के बाद भी डर लगता है.
और जब ज्यादा ऊंचाई पे होते हैं तब डर थोड़ा,
हाँ, बट हमारा डर ऊंचाई का आता है, नीचाई का नहीं आता.
This conversation, I could take it forward by saying डर के आगे जीत है, but somebody said नहीं जीत नहीं है, उसके आगे और दर्द है. But this is something that we could continue discussing. But the bottom line, you have heard from 4 of the best pros in the Indian markets about investing, and especially if you are a new investor, welcome to the markets, but tread with caution. Mental composure, calmness, knowledge, and faith and patience is perhaps the best way to become the next Warren Buffett or Rakesh Jhunjhunwala. Thank you very much to the entire panel, and you, the viewer, round of applause for them. Abha, it's over to you. Thank you.
Siddharth, and it was great listening to all of you together on this stage at the Market Today Summit. Well, we'll take forward that conversation on retail investors with our guests from the mutual fund industry and the kind of trends that they're observing. Could I please have a warm welcome for my guests in conversation with S. Naren, ED and CIO, ICICI Pru AMC, Prashant Jain, Director and Fund Manager, 3P Investment Managers, Sandeep Sikka, ED and CEO, Nippon Life India Asset Management, and Rajiv Thakkar, CIO and Director, PPFAS Asset Management. Gentlemen, a very warm welcome and look forward to engaging with you on this. Fantastic. I have you captive now for the next 45 minutes, and I look forward to diving in. Naren, let's start off with you. You know, we've spoken time and again, especially at around milestone events in the year, trying to predict or really sort of encapsulate perhaps the way the trend is moving. Once again, we're beginning a new year with uncertainty in the backdrop. We're around the corner from the budget. And at the same time, there's a lot of conviction in the India story. From where you're standing, what is the view looking like?
I think one is that markets are, 2022 was most interesting. I don't think if someone had told us a year back, there'll be 2 lakh crores of selling by FIIs and markets will hold steady, I don't think I would have believed it. But that happened due to the power of domestic investing. So I think that showed that the domestic investor has become a force and is able to withstand such big selling from FIIs. And see, we are not in 2017. In 2017, we used to fear what are the credit event coming, what are the problems in the banking system, NPLs, etc. All those problems are not there at this point of time. Now we are looking only at positive events. So the only debate that keeps happening every day, morning, afternoon, evening, is valuations, valuations, and valuations. How much to worry about high valuations relative to the world, because India is costly, the rest of the world is not costly, the rest of the world has more problems, India has fewer problems, and that's a debate which never ends. And every day we wake up thinking about it, and we don't seem to have the answers actually. So what solution we have is we keep saying SIPs, because that's the only way in which we can try to reduce the risk. We keep saying asset allocation, because that's the second way to reduce the risk. The third way is to talk of debt. And these are the 3 ways in which we can find a way to reduce the risk of higher valuations at this point of time. But everything we are doing with a positive attitude, not with a negative attitude which we used to have in 2017-18. And I think 2022 was handled brilliantly, and it was actually because of the way 2020 was handled that 2022 was handled brilliantly. So in 2020, most of the other central bankers and government actually overprinted money and did too much of fiscal without looking at what are the long-term implications. So the final impact was in 2022, you had higher fiscal deficit, higher inflation in US than in India, which I have never seen in my life. So that's why we are in much better shape. But the reality is valuations are higher, and what is the negative that we are going to see due to that? Frankly, we also don't know. So that is why the only solution is SIP, asset allocation, and debt mutual fund investing, and that's what we are trying to do as an industry. Because we don't know the problems of higher valuation, how it will hit, and what problems we will suffer due to that. We ourselves don't know. But otherwise, things are good. The general mood is optimistic. The general mood is very, very good, even in the mutual fund industry, because of the way the SIP movement has happened and the kind of products that we have at this point of time.
Prashant, let me bring you in here. And, everyone always has looked to you as a consistent, for someone who delivers consistent returns through the funds that he's, of course, driving. How is the scenario different as we enter 2023? Do you see considerable challenges, or are you also extremely optimistic about the India story sustaining?
I think the growth outlook for India's economy is probably one of the best that I have seen. And I think there are two clear takeaways post-COVID. One, the outsourcing of services will become very broad-based, because as remote working has become acceptable, and as the Western world is aging and India continues to add to a young workforce, I think it will throw up a lot more opportunities to create white-collar jobs through offshoring in a very diverse range of areas. And I think that is good for medium to long-term economic growth. The second, I think India is clearly now competitive in manufacturing wages across Asia. So 10 years back, we were 2x of Vietnam. Today, we are at par with Vietnam. 10 years back, we were 30% higher than China. Today, we are we were 30% lower than China. Today, we are half of China's wages. Apart from that, I think China plus one and geopolitical need to de-risk beyond China, I think, will bring in greater investments into India by way of FDI. So I think the medium to long-term economic growth outlook of India is, to my mind, extremely positive. Coming to markets, I think two things I would like to say. The most sectors, the profitability has returned completely to normal. So I think we are here for profit growth in line with nominal GDP growth. And finally, coming to valuations, I think most sectors are trading around 15-year or higher than 15-year averages. And that is where, except the utilities sector, which is still below longer-term averages. So I would say this is a market where one's expectation should be moderated to around nominal GDP growth rate kind of returns over 3-5 year periods. I think the key decider for the current year, I'm not a believer of forecasting markets, but still, I think Indian bank deposit rates have gone up sharply, and that could moderate the pace of flows towards equities. Most of the investors are positioned in the growth stocks, and I think that will probably disappoint. And last 1 year, 18-month returns have also been quite lackluster. So all of this might lead to moderation in domestic flows. If around this time we get second round of foreigner selling, first round we absorbed extremely well because local flows were extremely healthy. But now valuations are higher and flows could moderate. That could lead to some correction. So I would say I am optimistic on the markets 3-5 years, but ideally one should invest slightly lower or maybe phase out investments, as Naren hinted to, through SIPs. And so, but there is clearly a need to moderate expectations, and I think the pockets of excesses that have seen meaningful correction, it's my personal opinion that there is still more pain to come in those pockets. And what excesses have been created over 5-10 years I don't think they will go away in such a early. So, and one last thing, I think China is opening up. While it is structurally probably out of favor because of the challenges there, but it's a large market, and rest of Asian markets, EMs are offering deeper value. So tactically, if some money moves out out of India into those markets, it could lead to some correction. And finally, as we go maybe 6 months ahead, as markets start focusing on fiscal 25, calendar 24, I think the risk reward will steadily turn more favorable. So I don't think this is a market where one should be bearish, but because slight correction, you will see value emerging. And as time goes by, I think one should start turning more optimistic.
All right, lots of interesting points coming in there, and clearly some amount of caution, as we've heard so far from both Naren and Prashant, at least in the early part of the year. Rajiv, let me come to you. And I know we're going to talk more about it later, but everyone's right now looking to what's happening in the West, and with the tech winter and the kind of sell-off we're seeing on Wall Street. So talking about valuations, the topple down effect is happening already. How much of that is going to hit us back home here in India?
So if we look at the Western world, we have seen positive rates coming in after a long time. So just about 12 months back, you had trillions of dollars worth of sovereign bonds trading at negative yields, which was never heard of in the past. Now, we are at a scenario where rates are probably 4%, 5% kind of thing in developed worlds for the short-term bonds. So really, money which had no business to be in equities is now going back to fixed income securities. Also, so much of easy money really led to this frothy environment where you had especially in the private space, where businesses with no prospects of earnings got funded, and people were really spinning stories around that. So the sell-off has been brutal. I think the traditional companies which have genuine business models and which are throwing out free cash flow, they'll bounce back and probably go back to their all-time highs. But the companies with very shaky fundamentals will probably have to go into liquidation, because additional funding rounds will not come in. So we are seeing a scenario where new funding rounds are happening at lower valuations than the previous funding rounds. We have seen in the public market space also, where after listing we have seen sell-offs both in the Western world and in India as well. So it will be difficult times for those kind of companies.
Okay. You spoke about it, on the panel earlier. We had some comments coming in about how we'd seen a large cleanup, when it came to the banking space. And we have seen that. Things are better than before. But is there any risk when we enter a potentially recessionary scenario of once again seeing any kind of, fallback when it comes to companies that have difficulties with their debt?
No, I don't think, not in the near term. Because if at all the companies which could be financially in trouble, it could be some of the startups. And those startups are not debt funded, they are VC funded. So it is the VC's responsibility to find a way to fund them more, or what are they going to do, they have to decide. Some of them will go belly up, but the loss will be for the VCs. And I don't think they're all debt funded. So I don't think the problem is for the Indian financial system, and most of those VCs have made multiples of $1 billion in some of the other startups, and some of them have sold it to mutual funds also at good profits in some of their other investments. So they are also not at risk. So I don't think there is any challenge at this point of time. But 1 year back, luckily I would say that the first few new age companies which got listed caused losses to the investors. Otherwise, we would have headed for disaster, because what people were trying to do is sell companies with no income, no profits, no sign of profits to Indian investors at absurd prices. And luckily, the first few investments led to big losses, so they have to now show profits to people like us. to get investments. Otherwise, we would have been in big disaster. Luckily, now we are going to tell the companies, boss, please show profits, please show some path to profitability, path to cash flows. Otherwise, we will not be in a position to invest. Luckily, I would say. Why? Because if 50 companies had got listed and then all the 50 had fallen, it would have been a nightmare, because most of the time people are asking people like me and Prashant, you're not looked at these new age companies, but luckily their first few failed, I would say. So I think the risk is not to the financial system, and the people who will lose money in it, they can afford to lose money. Because as you would have seen, each month there is one company which says, I have falsified accounts. But the losses are not to the Indian financial system.
Okay. What about, I was speaking to the CFO at Adani Enterprises because of the upcoming FPO, and he had a complaint. He said that, Mr. Singh said that enough mutual funds haven't picked up, our issues and haven't really participated. How would you respond to that? We've got a 20,000 crore FPO coming up there, one of the largest groups. Incredibly leveraged, although very confident of their debt ratio currently. Prashant? Yeah.
So I have no money to manage right now. No, I think some of those businesses are good, and the management quality, the operationally these are very sound businesses. Whether you look at the airports business, the ports business, the power business, these are extremely sound businesses with solid entry barriers. I think the issue is basically around the valuations, and when you look at the current valuations, unless you think too much into the future, I think it is, at least to my mind, I think the valuations are on the higher side.
All right, fair enough. Sandeep, let me come to you. Clearly profitability is the buzzword, and given the current environment, higher inflation, cost pressures, so on and so forth, we're entering earnings season now, of course. And while largely companies are expected to report earnings on track, do you feel that there may be pressures going forward, even on some of the most well-performing giants as of now?
I think overall, as Prashant and Naren mentioned, overall the outlook on India remains positive. I think what happens in 1 quarter or 2 quarters does not matter. But again, I think the most important thing from our perspective has been, because the mutual fund industry, majority of the investors have started looking things from a very long-term perspective. Rather, I think when you started, the starting 2023, I think one of the key highlights of starting this year has been a data point which a lot of us have missed out. While we see the SIPs which are there coming right now, the monthly SIP is coming to about 13,000 crores. It's actually crossed 13,000, shadowless of 14,000. If you were to look at the other way around, we are a country of 140 crore population. First time we have come to a stage we are getting 100 rupee per SIP per month from every Indian. Now, and this is happening with the population of only 3% of the population investing in mutual funds. Now let's see it the other way around. If this 100 rupee goes to 200 rupees, we are talking of going to almost 30,000 crores. And if this 3% population goes to 6%, we are talking of going to 50,000 crores per month. And I think that's the stage where we are right now. So I think from our perspective, I think the quarterly earnings are very critical, but I think we need to monitor closely. But the good thing has been, as far as the investors are concerned, they have matured a lot. They are coming from long-term point of view. And I think, and we clearly see the short-term volatility that can come in corporate earnings will not distract the mutual fund industry from investing in good companies.
All right. So talking about the companies of choice then, I'd love to get the themes or strategies with which you're approaching investing in 2023, where you find value at a time like this, and especially for those who are always wondering, which fund to go for. Is there a particular, strategy to keep in mind, whether it be, a larger portion of the heavyweights or certain sectoral themes that are perhaps safer at a time like this? I'd love to get all of you to sort of comment on that. Let me start with you, Rajiv. Okay, Naren.
So, we came to a conclusion that given that this will be a year where the Fed will stop hiking rates, almost all the asset classes become reasonably interesting. So that's why something like a multi-asset strategy, whether it's gold, silver, plus equity, plus debt, plus REIT, InvIT, everything should become more interesting, because no individual asset class also is at this point of time outside debt very, very attractive at this point of time, because equities are not cheap. And this is a year where there will be a lot of volatility, because a year where Fed is going to finally stop hiking. They're going to stop hiking because either the economy slows down or because inflation comes down substantially. And when inflation comes down, it's normally due to economy slowing down. And so that's why we felt that's the kind of situation. So we believe this is a year where it's difficult to make money outside debt, but you invest in other asset classes also through the multi-asset route, so that you make money subsequently in the other years with the other asset classes. That's how we've been thinking about it. Clearly, we are more in favor of large caps or flexi caps, primarily because in small and mid caps, we have not seen any redemptions for years at this point of time, and therefore many of the stocks in small and mid caps trade at 50, 60, 70 PE. Whereas thanks to the 2 lakh crores of redemptions which happened in FIS, most of the large caps actually corrected in the year 2022, whereas many of the small caps and mid caps, some of them have just not corrected, and they continue to trade at 50, 60, 70 P. There are a lot of cheap small and mid caps, but they are not held by the funds. It's only the costlier stocks which are by and large held by the funds, and where there has been hardly any redemptions. So that's why we are much more in favor of large caps and flexi caps. So that's how we look at it.
Okay. Prashant?
See, while we, of course, will debate and should debate 1 year outlook, but I think we should not lose sight of the nature of this asset class. And it pays to think long term and to hold equities for long periods. I mean, 100 Sensex has come to 58,000. And so, see, we are always focused on 1 year plus 10%, minus 10%. But I think India offers you a significant compounding story. So we should not lose sight of that. And valuations are not so expensive in India, while they are slightly expensive, that it will not create meaningful wealth over medium to long periods. I think coming to where could one invest, I feel the profit growth is clearly normalizing. See, at bottom, India's profit growth profits to GDP had fallen to almost 1% for 3 years back to back. We have recovered very fast to 4 to 5% range. So I think profit growth is very broad-based, unlike 3 years back, and it is normalized. I think in this kind of an environment where profits are broad-based, the high P's where growth is not supportive of those multiples, I think those excesses will go. And so I would avoid stocks where multiples are very high, even though they have corrected 20, 30, 40%. I would also focus more on large caps, because in the small mid cap space, while Naren said there are few stocks or many stocks which are not owned by mutual funds are cheap, but I don't think they would be any meaningful part of the market. So I think it would make greater sense to invest in small companies in deeper market corrections. I think the only space where I am also sectorally slightly cautious is the consumer space. That sector has benefited immensely from lack of profit growth elsewhere. It has benefited from corporate tax rate cuts, from GST cuts. It has also benefited from lower commodity prices. But now I think all these tailwinds are missing, and the multiples continue to remain quite high for a reasonably mature sector. So I would be slightly cautious there. I think banking appears to be in a sweet spot. The credit growth is good, NPAs are extremely low, provisioning costs are low, and valuations are in line with longer term averages. So that is one space I think I would continue to be positive on.
That's super interesting. And everyone has been, of course, talking about banking being the predominant theme going forward. I also like what you talked about when it comes to consumer, because I've been trying to question where this robust demand is going to come from when we're heading in for a inflationary environment. What's your take, Rajiv?
So Prashant and Naren have covered a lot of aspects, and largely the view is similar in those spaces. I think when we talk about index levels or valuation levels, if we say 18,000 Nifty and down the road we see 1,000 EPS, that average hides a lot of things. So to build on what Prashant ji said, I have seen consumption-oriented names in 2003 trading at early teen multiples, those going to triple-digit multiples these days. That is one segment. The other segment is the loss-making or the new age companies. So those are things which, even with a 20%, 30% fall, don't become attractive by any stretch of imagination. One segment which I think is largely ignored, so banking, of course, we also have more or less the same view. One segment which has been largely ignored and which has been underperforming for maybe 2 decades now has been the PSU space. And I think this time round the privatization intent seems to be real. For a long time, Air India privatization was spoken about. That has actually happened. There is a clear path that barring a few strategic sectors, they will try and exit all the other holdings. If they actually deliver on that, that is a space where the asset valuations are very attractive. In some cases, they are monopoly businesses or oligopolistic kind of businesses. And with some management change, you could see significant appreciation in stock prices. We have seen turnarounds in a handful of companies. So you had the Balcos and Hindustan Zincs and those kind of companies being privatized in almost 2 decades back. I think we are headed towards a similar thing. So that is one space I would watch for.
I know you said not to talk in averages, but everyone's spoken about how high valuations are affecting things across the board. Sandeep, what is a fair valuation, let's say, for the index? I mean, if we're talking about a tapering or the kind of multiple that you're looking at that you feel would be fair. And when it comes to the new age companies, I mean, I just want to take the example of, let's say, a Nykaa, for instance. I mean, we're starting to see it trade at lower levels to, what it's seen after the initial euphoria post-listing. And Samir earlier today was talking about it, how it would still not be on his shopping list, even at lower prices. Would it be on yours?
I think Naren mentioned, I think a lot of asset management companies, the traditional ones, have been blamed that I think we don't understand this sector. I think from our perspective, it's not a question of understanding, it's just a question of valuations. And difficult to talk about an individual stock, but I think still we believe, I think we don't understand this sector, so we'll prefer staying away. I think number two, a lot of discussion for the last 20 minutes happened about equity, and I felt debt was a little underrepresented. So when you're talking about the theme for next year, fixed income seems to be attractive. I think we clearly see 2 things which have happened in the last 3-4 years. And many times it's not about the question that you asked what we feel is right, but it's a question of how the investor will react to it. So last 2-3 years, investors have pulled out of fixed income and have made a lot of money in equity, especially in small cap. And the returns have been in excess of 20% for last 5 years. So I think from our point of view, the way we see, it's important for investors to understand that the past will not be repeated. And so the next few years, we believe fixed income is going to be very attractive, and small cap may or may not be able to give the kind of return that it has given for the last few years. We also believe as a fund house, for us at this point of time, mid cap and large cap is the theme for the next 3 to 4 years.
Okay, so that's pretty clear. I think large caps and of course value plays, banking, some of the key themes to really come out of this conversation so far. We are around the corner from budget, so I have to ask you if you think it's going to really have, he's already shaking his head, but any expectations, even if it's sectorally, sentiment-wise, it's also, of course, the year before major elections. So do you see markets being fairly robust, immune? Is it really only the global factors we're watching out for, or are you eyeing some of these other factors as well? Naren?
As I mentioned initially, we used to 90s where budget had a lot of scope to reduce taxes, customs duty, excise duty, income tax. Government has no such scope. I don't think there is the excise duty, GST Act has been passed. Everything will happen in the GST Council. So unnecessarily, maybe everyone wants the budget to be such an equally big event. It can't be. There'll be only few things that can change in the budget. So I don't think it is possible for us to have some extremely path-breaking changes in the budget at this point of time. So that's what we have to realize. It is not possible. Government hands are also tied. You are sitting at 6.2% fiscal deficit. Where is the scope to increase fiscal deficit and give a lot of handouts to people at this point of time? You have to keep fiscal deficit under control. So I think, unfortunately, the government does not have that kind of leeway at this point of time, even in 1.5 years before the election. So I think we should reduce our expectation and realize that there isn't much that the budget can change drastically at this point of time. What the government has brilliantly done, which you have to recognize, is they have improved the computerization of the income tax department, computerization of GST, and that has resulted in huge collection of taxes over the last few years. And you would have seen the tax buoyancy at the direct tax level at this point of time, or even the tax buoyancy at the GST level, without increasing in rates in the GST side particularly. And I think that is primarily because of superb computerization that has happened and the kind of tax returns that have started on the computerization side. So I think that is what has resulted in superb revenue increase, and that's where the government needs to be complimented on. But there isn't much that the budget can do. And that's why our expectations from the budget are minimal, and that's how it has to be. If nothing comes negative in the budget, we are happy. Nothing positive we are anyway expecting from the budget.
Okay, expecting neutrality. Prashant?
No, to be honest, I would 100% agree with what Naren said. I honestly don't have much to add to that.
So budget has become more of a non-event, one would say, in the last couple of years. From a market standpoint, no major expectations this time around. Rajiv?
I am fearful of a thing for which trial balloons have been floated. There is talk about uniform capital gains tax across asset classes. If that were to happen, I would think equity holding period would go to 3 years with other asset classes, which may sentimentally in the short run be a negative, doesn't affect longer term prospects. And tax rates could go to 20% with indexation instead of 10%. So if that doesn't come, that will be a relief. Otherwise, that is a possibility given all the media stories that we are reading.
And given that equity markets have been on such a roll the last couple of years.
No, I think I agree with Naren and Prashant. Over the years, budget has become a non-event. The announcements keep coming out throughout the year, so it's no more on that one particular day. But I would, as per the capital gain things which keeps coming up again and again, I think I have a little different view. I think it's just about having a clarity. This sword should not be hanging whether it's going to be increased from 1 year to 2 years to 3 years. But even if it is increased, whether from 1 to 2 or 3 and it's stable for many years, I think it will not make any impact. It's a very, very short-term sentimental thing because any investor who's investing, I think from a long-term point of view, I think is anyway investing from a long-term. And anyone who's trading is anyway paying short-term tax. So it does not matter.
So if we were to look back, let's say, for the last 1 year, and if I had to just put you on the spot, what would you say is the one bet or the one thing that you got right in the year that's gone by, and the one thing that you wish you caught in the year that's gone by?
Not say 1 year. I think a few years back, whether it was PSU, whether it was value investing, it was, let's say, quality at any price investing, which we didn't believe in. And people used to say, it'll never come back. You're not a believer at quality at any price investing. Buy 80 PE stocks, buy 100 PE stocks. Don't look at price, just buy the best stocks in the country. And people used to ask us, you're obsolete because you don't buy these stocks. But now if you look in January 2023, that strategy of buying quality at any price has been completely destroyed. Now all the people who did that, people are asking themselves, what did they do? And now I don't know what they are going to do, actually. Because they're still sitting on extremely overvalued stocks. The companies are good. Companies were always good. They're sitting on extremely overvalued stocks. So I think essentially that is what, and people used to ask us, why do you buy PSUs? So even Rajiv today talked about PSUs as a theme, and it was rare to find people who felt that PSU could be an investing universe. So I think those were the thrills for us in the last 2 to 3 years at this point of time. So I would say it was more, and the thrill of seeing that mutual funds, that SIP fought FIIs and won, was something I think the entire mutual fund sales community needs to be complimented. Because I would have never imagined SIP can beat FII. And I think that the sales community needs to be complimented.
I completely agree. That was definitely phenomenal when we saw those numbers come in. Prashant, what about you?
I think my portfolio positioning last few years was quite similar to what Naren mentioned, and I think it has played out quite well, and I would specifically like to highlight two things, maybe one or two. One, ESG as a theme had gained a lot of ground. It was never based on rational logic or fundamentals, but you can see how the majority opinion can go in the wrong direction. And I think the way ESG has been discredited or it has underperformed, I think once again highlights that in the long term markets are quite rational, but they may of course test your patience, endurance in the short to medium term. And I think I must also highlight, the defense stocks, of course they are PSUs, they were extremely cheap, they are up 4x. So I have seen time and again that focus on reasonable quality and what you are paying is extremely important, and all long-term investors should never lose sight of what you are paying and what you are getting. And if you keep that in mind, I think outcome is good. But in this market, to be honest, I don't see any futuristic themes that are deeply undervalued. I think these are reasonable markets and these are more compounding markets and then otherwise, yes.
Wise advice coming in there from Prashant.
Yeah, so last 2-3 years, there's no specific learning, but there are areas where one gets a lot of pushback from investors, and for which I don't have a very clear answer or I don't have a solution. So people either accuse us of selling too early or selling too late or holding on too late. So they expect us to identify the precise peak when stock prices are going to correct. So they accuse us of selling our consumption-oriented names or FMCG names too early. And they accuse us of holding on to big tech names, which have done well over the last 7-8 years that we have been holding. But they said, couldn't you have sold it 6 months back or 12 months back? So that is part and parcel of the investing journey, I guess.
Well, thank you for being so honest, Rajiv. Totally feel your pain there.
I think from our perspective, the key, if what went right, I should say, I think we didn't get carried away with a lot of these new IPOs which came, because I think there's always a pressure. Many times, just continuing with what Rajiv said, it's difficult to justify to people why you did not invest, because they call you old-fashioned. And it was difficult that time when it was going, and especially when the stocks were above the IPO price, it was even more difficult to justify. But having said that, I think we also believe that I think ultimately quality and valuation both have to be good. They have to be there. I think you cannot be paying excess valuation even if the business is good. And the other thing good that I think if I was to look back at the last 4 or 5 years that we've been able to do, not related to just investing in a stock, but investing in a business line, has been to invest in the ETF business. I think the fact is today, more investors are coming into ETF in the last 1 year than active mutual funds. That's again a theme which we need to be watchful of. And personally, we see that, especially in the large cap, the ETFs will get a very high wallet share.
So, the big bull always used to say this is going to be India's decade. And he said it's only the beginning of the biggest bull market ever. So I'll just close with that. Prashant, do you feel that we are just at the beginning while things may be normalizing, so to say, in terms of returns, but is the India story only just starting?
See, India is the 5th largest economy, so you can't say you are the starting point. I think we have come a long way, but I do feel that the next 2 2 decades, the current and the next decade, the growth rate should be higher in real terms than the previous 2 to 4 decades. I think stock markets are fairly valued. So, and India has structurally moved to low inflation. Till 2000, our inflation used to be 8, 10, 12%. Last 2 decades, it's around 5, 6%. I don't think we can lose sight of that, because that has an important bearing on total returns and investor expectations. So I think unless the real growth moves up to 7, 8%, till the time nominal GDP should continue to grow around 11, 12%, I think those would be realistic expectations. But we should not ignore a 12% CAGR over a long period of time, especially if it is 5, 6%, 7% higher than inflation. So I would say these are markets for the patient, for the disciplined investor.
Fantastic, gentlemen. Thank you so much for your time today and for your frank and very real insights. A big round of applause, please. Thank you so much. All right, well, you'll have a chance to network over tea as we break for a few moments. Look forward to having you back here, in a few minutes to continue some of these fantastic conversations. We'll have a power pack lined up right after this break.
Hello, ladies and gentlemen. It's nice to be here sitting in front of a markets audience after many, many years in Mumbai. I don't know when was the last time I did something like this, and I almost seem to forget that I did this for a living for so many years. In fact, this morning I was speaking to our speaker, Samir Arora, over breakfast, and he said, my God, this boy, when I first met him, he was talking about me, he was a real bacha. He was a baby, he said. So I think, must have been in my early 20s, but yeah, it was a long time ago. And Samir's been around much longer than I have, and we are old friends, and it's great to have a conversation with him today. Samir, it's great to see you.
Thank you very much, and good welcome you back to Bombay.
Thank you.
Mumbai.
Well, since you're here, I'm wondering whether you'll tell the audience to begin with that this will be a better year than last year for the stock market. Will it?
For sure, it will be better. And actually, I tweeted on it recently that the rabbit will help you more than the tiger did. And it is very simple, because if you look at the big picture issues affecting the world last year, one was the US market and the US interest rates, and one was maybe China and its policies and everything else that they might have done wrong. Both have gone past their negativity in some sense, and I think both the markets will be flat to up. China is actually already up a lot. And therefore, two external influences which were negative last year, which I think hurt India, are not there. So then we have to create our own negatives, and hopefully we will not create that in this budget by having some capital gains or something. So it should be okay.
You think it's coming? Because this time the noise is louder than last time.
No, actually, I don't think it is louder. I think the strategy is that if you don't have it, then we will all call it a good budget.
That's true. Yeah, they fly a kite before the budget. Yeah, but you don't think that 1 to can become 3 years?
It is such a waste of an opportunity to do that when, first of all, nowhere in the world do foreign investors pay tax anywhere. Like even Indian was to buy stocks in US, there is no tax in US except for tax on dividend. If you buy them in Singapore, Hong Kong, etc., etc. So you make it even tougher for an FII to justify. But the second thing is, we keep saying every day that our GST collections are up, our railway revenue is up, everything is good. Why do we need one more avenue right now to collect extra resources? I don't think it is needed, and I don't think they are doing it.
Okay. Talking about this year, when we started the year, almost everybody seemed to be saying that the first half will be tough, but the second half will be good. Do you agree with that, or is it too much of a consensus for the market?
There's too much preciseness which is not needed. Look at it big picture. In the US, the US market has been negative 2 years in a row, very rarely. In the last 25, 27 years, only once, in 2000 and 2001. Supposedly in the last 100 years, it is negative only 4 times. That 2 consecutive years were negative. So if we look at last year, what was the issue of FII selling, which was in the first half, something like $28 billion. It had to be for non-India reasons, because I don't think India did anything specifically bad in the first 6 months last year for us to have a 28 billion outflow. Because in general, foreigners invest. In India, they have only sold net in a calendar year 4 times in the last 20 odd years. And all of our bad years, 2008, 2011, 2018, you could say was India, maybe a little bit, and last year. So one reason would be US interest rates, US inflation, and that is out of the way. And plus minus 2-3 months, the US interest rates would have reached the current target, which is say 5 and 5.25 type. One will be on Feb 1. So in 2-3 months, that would be over. The China problem is over. Actually, the sad thing has been, which I never imagined, to get to their rebalance in China, it seems that they are actually taking out money from India, because the flows right now are positive in all of China, Taiwan, Korea, all markets except India. I think that is a little bit of a rebalance, which I never imagined. But I don't think that rebalance that you take out of India to fund other markets, that I don't think is a very longer term thing. So if both those markets are okay, then our external thing is positive to flat, and then we can move on in life.
But sometimes people sell something because it is done well. Do you think that could be India's problem?
I don't agree with that, because last year in absolute the Indian market was flat. So what happened was that China did very badly. Now China did very badly not for random reasons that you don't precisely know. It's like saying 2 companies are going up, and then suddenly after some time you realize that, oh my God, one company's valuation relative to other has gone up a lot, and therefore there will be a mean reversion. But if the second company has fallen because of very specific, some corporate governance issue, some very poor result kind of reason, then you can't say, no, they should move in the same band. I think China issues were specifically hurting investors, and all of that cannot be forgotten just because now you'll play a mean reversion. But in the first round, it is happening like that people are playing the rebound. Plus minus a few months, the big new allocators are unlikely to put the same amount in China as they might have been doing before in proportion and as a percentage, as if whatever happened in China was just a 1-year story. So I think it'll be okay in a few weeks plus minus.
If this is going to be a better year than the previous year, is it your expectation that we'll have double-digit returns? Because last year was flattish.
Yeah. So do big picture. So in every 6-7 years, there's one bad year. Yeah. That one bad year is not bad only for that year. It takes away the returns of the previous year, and mostly sometimes even the 1 year before that.
3 years.
So you get 4 years of returns in a 7-year cycle. So that means the years in which it is positive on average is more than the 13-14% 7-year average. So when it is up, it has to be up more. Now that part, you might be right, that might happen in the second half. Why? Because the US will be keeping these rates for some time. They say 8-9 months, whatever. So maybe by end of year, the US rates will be cut, which also allows India to cut and all that. And if the world is actually relishing a rally, then all that will happen by end of the year, because a few months will be at these high rates, which are not increasing anymore, but are still quite high, the US rates. And therefore, I think end of the year, you might in one spurt get the last 5-7% overall returns higher than 10% for sure, I think.
So the gains will come in the last quarter?
I'm saying if for the general year, the market is flat to up a little, and then you get something right at the end, that also is acceptable. All we don't like is a minus 10% kind of a year. Plus, we all accept that over time, equity markets beat debt by a reasonable number, which is like 5 to 7% per annum, which is basically the equity risk premium, which means what the equity markets deliver, relative to government 10-year type bond of that same market. That globally and in India on annualized basis is 5, 6, 7% per annum. So not improved, whether you call it compared to China, compared to Europe, and in general compared to other markets. And therefore we will get our fair share of foreign flows. That along with the fact that Indian flows are also good these days, and that there's nothing bad happening otherwise in terms of economy or this thing, yeah, you will make similar returns as you have made in the past.
The other decision a lot of local investors need to make is where do they put their money? Because last couple of years they have invested in some PMSs, mutual funds, but a whole lot of them have struggled to beat the Nifty. Should they just be buying index funds and paying peanuts? And
No, absolutely not. Please don't do that. So the thing
is it a problem? It is getting to be a problem to beat the index.
For 1 year, it has been a problem because the stocks that have gone up last year, we don't buy. Nobody buys Coal India and NTPC except the guy who bought them, but then he underperformed the previous 9 years. So the point is, some of these value type stocks, these are not even real value. These are just beaten up, forgotten, should not have been listed kind of stocks. So if they do well for some time, that doesn't really make that a viable strategy going forward. India is a growth market. See, value can work in many situations, but the main situation is that you should have the ability to take over assets, break up assets, go to court, change managements, force management, just unlocking value in some sense. All that is not possible here and nobody has the energy to do it. So we would stick with our broad thesis that the three big sectors in India are financials, consumer and technology, which is mostly the case everywhere. If you look at the Forbes billionaires list and say from where these billionaires come, because that is the genuine long-term wealth creation in long-term, all come mostly from financials, tech and consumer.
Yet I believe that you have sold your IT stocks for the first time in life.
I have sold many stocks in my life, but first time I have gone to near zero weight, which worked for the last 7-8 months, didn't work this month.
All gone? Infosys, TCS, everything?
All gone. Because, the thing is that I have 100 rupees. So I can put it here or there. I have not sold India. I have only sold one sector and bought
I'm not blaming you. I'm asking you. Because you've been an IT bull for the longest time.
I have been all my life an IT bull, and that is what made me my performance in the 90s. But over time, I realized that the IT guys have only a 2-month lead over me, if at all, in terms of what they can see. Because in 2000, I saw that they kept saying we are getting orders, and nothing happened. And now when you can see the very visible symbols that even Satya Nadella comes and says that when he said that I'm firing these 12,000 employees that are...
That's Pichai, Sundar
that
Pichai.
No, not Sundar Pichai. Satya Nadella said, Microsoft. That we are seeing slowdown in customers. Just now, I think yesterday or day before. And the cloud companies, the business software companies, Salesforce, then the cyber security companies, all of them are seeing slowdown. Only one group does not see slowdown, which is the Indian IT companies. And I don't believe it for now.
They are misleading investors, you think?
No, they refuse to talk about the future. They'll say, right now we are not seeing. Because right now you are getting orders based on the current US economy, which is actually doing well. The US Federal Reserve is trying to engineer a slowdown. Otherwise, currently, of course, the economy was doing well. That is why the inflation was high and the jobs opportunities were high, and therefore the employees were having more job opportunities. Therefore, they are acting tough and resigning or asking for higher. So this is a little bit ahead, if at all. But I don't think that they're going to massively outperform that. I will feel very bad if I don't have it. Suppose they do well, but they do plus minus similar to what my others, and I'm comfortable not owning them right now. I don't feel that, oh my God, I will regret it so much later, that why I didn't go back. So I'll go back after 6-8 months. Right now, let me enjoy.
Did you ever feel regret about not owning some of these value names which did well this year? You did buy State Bank of India.
State Bank we bought in 2020 June. That was a good one, yeah. Others we haven't bought because those we would not even consider buying. I mean, in the sense I would never.
Which are those other than Coal India and NTPC from that?
These are the basic. Who will go to buy them? Not me.
Now, any of the Adani Group stocks?
We have Adani port.
Only one? None of the others because the float is.
Could analyze them.
Okay. That's the reason.
That's one of the reasons.
Have you sold any of your financial holdings? Bajaj Finance?
Bajaj Finance, we made 70x, but we sold it.
Fully?
Yeah, and now we. These stocks, yeah.
Okay. What do you do these days with the short part of your portfolio? The ones which you don't like or you bet on the short side?
So this is one of them.
Bajaj Finance?
Leave it. There are many, but we do 2% in many stocks, in 10 or 10, 12 stocks, so 25, 30% or 40% is in shorts in 10 to 15 stocks of approximately 2% each. Okay. So no one position can kill me, but collectively they work very well. Actually, my outperformance against the index is quite high on the short because every year something or the other is doing quite badly. Now the short names, you're not supposed to talk so much in public.
This is hardly public, very small sliver of public. On this point that you just made, that nothing will kill you, I want to ask you because a lot of people in this audience and generally begin to wonder what level of diversification they should have in the portfolio. Because a few PMSs have told them that they should have concentrated portfolios of 10 to 15 stocks, and that is the way or recipe for outperformance.
It's a recipe for disaster. I just taped a program with my own team called Dhan Ki Baat, which you can see, but basically proving literally in black and white that even Mr. Buffett's concentration has not worked in the last 25 years. Initially, some might have worked. So the thing is, what we did is we looked every year at his top 10 holdings, which he reports, 10 or 50, whatever are his top holdings which are in his annual report, and seen their performance versus his own performance. And if he has 20 or 15 stocks which are concentrated, less than 2 or 3 of them even beat the index in any one period. So what that means is that his tail did better. The stocks that were not in the top 10 did better because it is just simply too much of a random bet that if you are concentrated, so let us say one PMS is concentrated and they have 10 stocks and the PMS is concentrated and they have 10 stocks. So if there are 50 people like that who have concentrated on 10 stocks each, unless some stocks are common, that means this group has collectively bet on 500 stocks. Let us say some stocks are common. So that means they are betting on 200-300 stocks. So how can they all do well? So what will happen is that the fund manager who does well will tell you his stories, and the fund manager who does badly will disappear and not be a fund manager. So this is no formula. This is a lottery. It's like I say that if you win a lottery, nobody comes and asks you, can you tell us how you chose the number? And then you'll say, I chose my birthday and then I added my anniversary and then I divided by 3. So everybody will say, oh, good idea. We'll also do the same. It's a lottery, and lottery is not a strategy.
What's the ideal number? I mean, what do you go with? 25, 30 stocks?
We go with 30 names.
30
in
stocks.
which we go 10 big names and 20 medium caps. But they were in trouble and are coming out. For example, if you buy Indian hotels after COVID, now you can't make it a 5-7% position because the hotel is closed. There is no vaccine. There is no idea whether India will get a vaccine. But you still feel like you're buying it for, it's a survivor, it's part of Tata, it's not leverage, whatever. You can't buy 5-7%. But that portfolio of 20 stocks, all the multi-baggers come without your knowing that these will be, but you get a slightly higher proportion than others or the market. And that is how it has been. So I have got, other than some specialty chemical guys, literally every multi-bagger of this country, without knowing that it will be a multi-bagger.
But they all
by
started...
buying 2%. Yeah, 2%. Whether it's Bajaj Finance, HDFC Bank, Kotak Bank, in the new life, Varun Beverages, or kuch bhi, but 2% se hota hai kaam. And then they go up whatever number of times.
What do you do when 2 becomes 10%?
No, we don't let it go to 10 because we are a fund. So new investors are coming in all the time. So 2 also doesn't mean 2 because if a stock is doing well, you can always add a little because now it's your stock. If 2 becomes 2.5 by its performance and you think everything is doing well, okay, then you add it. But one, I'm not buying 4 of anything. That's the idea. But we won't let it go beyond 4, 5.
Okay. What do you do with some of the old stars? Bank?
No, it's still our number 1 holding, and it will not be. It will be a star, I think, starting maybe this year.
Have you already seen signs of a pickup again? I mean,
No. You see, it's a technical issue also. Yeah. So the thing is that, of course, it's doing well. It's growing 89%, and it is very, very cheap. It's 1/3 the valuation of a Bajaj Finance. But the thing is, it's a technical issue. Once HDFC Bank and HDFC merge, we expect, based on these things that people put out, that $5 billion might be the selling just from index funds, because currently HDFC Bank is not in the index and HDFC in the index. When they combine, the whole thing will be in the index. Currently, 20% of HDFC Bank is owned by HDFC, which is counted as a foreigner owning it. Because HDFC is viewed as a foreign company. But it's not literally owned by FIIs. So that capacity will be released, you can say. So there are technical also.
In 75% to 80% on your financial side. So all we need is demand. We've got capacities, we've got the cost structures in our favor, and if we can get the growth, we can leverage that growth. Frankly, in my investing experience, while India has been an off and on cycle that you've seen, I haven't seen a formation of the cycle ever take place. So markets, headline, expensive, driven by a lot of companies that probably belong to a subset of businesses that got extrapolated over the last couple of years. The opportunity, should demand environment stabilize globally, I think we will feed into the rest of the world and do it very successfully in this cycle.
Right. Devina, you've been at pains over the throughout your investing career, particularly the late part of it, to say that the India story is good. You invest in it yourself. But it's never a good idea to invest just in India. You should have exposure to other kind of assets and other kind of geographies. Can you tell our audience why you believe, if the India story is so compelling, why do you need to look elsewhere?
Yeah. So for one, if you look at India, India is what? It is 3.5% thereabouts of the world market cap in equity markets. So what would be the reason to put 100% or 90% of your assets in a single geography? Every country, investors have a home country bias. Canadian investors have 60% of their assets in Canadian equities. Canada is not 60% of the world equity markets. But in India, that is very, very pronounced. And part of the reason is that historically we did not have capital account convertibility. Most of us in this room would remember a time when you could take out only $500 once every 3 years. So while now the liberalized remittance scheme allows you very good amount, 250,000 per head per annum, which means in a family of 4, that's $1 million. People have still not really gotten around to thinking about global investing, or if they think of global investing, they think a NASDAQ ETF le liya and that's enough, which is not global investing. True global investing means looking at all geographies, all asset classes, and there are a few reasons for that. And I will go back to my personal history, which was the Asian crisis approximately 25 years ago, when in just 1 year, in dollar terms, the markets fell between 50% for Taiwan to 90% for Indonesia and Thailand, South Korea, everybody in between. And we talk of the India growth stories. These were not basket case economies. These were the Asian tigers. India wanted to be an Asian tiger. You wanted to grow at those growth rates. And yet, if you were an Indonesian investor, you would have seen your net worth wiped out by 90% in a single year. For me personally, that was a wake-up call. So 1999, we were the first Asian firm to become members of the London Stock Exchange, because I said, it's no time to be in a single market. And then the next year of the NASD. So that is where, crisis is one thing, but even without a crisis, when I started working in the 80s, the dollar was 12 rupees. Now you know where it is. So it's a 85% depreciation in the course of less than a single career. So when we talk of long-term planning, long-term financial goals, long-term asset allocation, you have to look at global investing. And that means over a period of time, at least 30% of your, if not more of your assets should be global. And more so now, I mean, most people in this room would have children studying abroad or planning to study abroad, or therefore children settle abroad, maybe you even want to retire somewhere else. So those are all considerations you have to take into account. I mean, the old adage of not putting all your eggs in one basket, it is as simple as that. So while I say India will outperform, but this is not something I'm saying with a one-year perspective. But longer term, you have to look at global investing. And again, if you just buy a single other market, even if it's the largest market, which is the US, that is improving things slightly, but that is still not global, because leadership changes in 2021 when there were all these NASDAQ ETFs and funds being launched. I was trying to tell people that this is recency bias. 3 years NASDAQ has been a great performer. You think it will last forever? Nothing lasts forever. No theme lasts forever. As I said, 2003 to 2007, we heard all these stories that US is over and now it's the decade of the emerging markets. 2010 to 20, when US was performing, those stories were forgotten. You might hear those stories again. But those are no theme, as I said, whether it is geography, whether it's asset classes, or within a country, the sectors, no theme lasts forever. So that is something you have to keep in mind. And 85 to 90% of your returns, first page of Investing 101, come from your asset allocation, not from security selection, whereas we spend all our time talking about security selection, which is the next multi-bagger. But get your asset allocation right, and that includes global diversification, true global diversification.
Rhythm, would you? Yeah, I know you believe that India has been and will be the best performer among countries, but would you concede that there is a strong element of cyclicality that Gabbana is talking about? Or do you think that India is a far more structural bet than that?
I can't dispute the point that she makes. It's absolutely valid, which is from a portfolio perspective, diversification is key. You can't put all your eggs in a single basket. Unfortunately, I don't think most people have the expertise to go so diverse. So you will have to rely on professional fund managers, and as she pointed out, people just go and buy the ETFs, because imagine selecting stocks in India itself is a tough job. Now imagine selecting stocks in 25 different geographies, or doing other asset classes. So all these requires a lot of deep expertise.
But there are lots of products which are being launched.
Yeah, so you'll have to then go and buy products. I don't think there's much dispute on what she's saying. It's absolutely spot on. I mean, it's like putting all your money in a single stock. Is that good investing? No, it's not good investing. So single geography, single stock, single fixed income asset, all of these are risky strategies. Now, of course, I do what I do the best, which I doubt whether I understand everything correctly, but that's my field of expertise. So I stick to that, but I can't dispute what she's saying.
Sort of, you're a proponent of concentration rather than the kind of thought process we are hearing now, right?
So I think both concentration in India and concentration abroad. So courtesy the 18 years that my wife and I lived in London, we got 1/3 of our money abroad. And that's a concentrated portfolio of, again, very similar to what we do in India. We've invested our savings from our 18 years in the UK in global monopolies, companies whose products many of you are using, even as I talk to you, many of you are using some of the global monopolist product. High ROC, dominant franchises, compounding in dollar terms at between 15 to 20%. And similarly in India.
No, feel free to mention names as well. We are in a small crowd of friends.
So similarly in India. So if you take, say, an Apple or a Microsoft, I think Microsoft has been compounding at 15 to 20% now for the best part of 30 years. Just when I was starting to worry, because I've also been told by lots of people that you should constantly worry, even if you've invested in a great company. Worry is the name of is what you should do as an investor. Just as I was beginning to worry, they thankfully went and bought ChatGPT, right? So I'll worry a little less. But jokes apart, The global portfolio that my wife and I built is very concentrated. Similarly, the Indian portfolio that we keep harping about is very concentrated. By the same token, we have a small cap portfolio in India, similarly concentrated. And the sort of the creed I'm espousing, the story that I'm trying to convey to you is, as I think Robert Hagstrom wrote in the Warren Buffett portfolio in 1994. Robert Hagstrom wrote a remarkable book called The Warren Buffett Portfolio, 1994. He conveyed the point of view, Buffett's point of view, John Maynard Keynes's point of view, that in any country, you will have ups and downs. The business cycle is a permanent feature of modern economic life. In any country, you'll have ups and downs. But if you want to consistently compound your wealth, whether in America or UK or India or Japan or the Middle East, build a concentrated portfolio of high quality stocks and stay the course. Don't try to second guess the market. Don't try to pretend that you'll be second guessing Nifty kahan jayega, Nasdaq kahan pe jayega. If you build a portfolio of concentrated high quality monopolies at the global level, as Davina is saying, and at the Indian level, as we do, even if you do one of these two, you'll be fine. But I think what's devastating for most people, so my parents' pension in the UK, by the way, is run by one of these fund managers. That fund managers bought lots of tracker funds, and my parents' British pension. And these poor guys, right? Just imagine my parents' plight in UK. They've been retired for 10 years. Inflation in UK is 8%. Their pension portfolio compounds at 2%. Right? And this is happening to millions of families in the Western world. Right? They're being ravaged by their fund managers buying ETFs, pension funds buying ETFs, at a world where inflation is 8%. Now the result of that, Udayan, is very interesting. If you see Nifty VIX, Nifty volatility is actually lower than S&P 500 volatility now for the last 5, 6, 7 years. And the reason for that, I suspect, is because America has become such an ETF market, active investor interest has diminished, which makes that market volatile when new information emerges. Our country, for better or for worse, hasn't yet got as ETF'd as America. The result that they're going to suffer from for many years to come unless there is enlightened regulation in America is the American market steadily becomes more volatile than ours. And that's where having a focused portfolio of high quality global names, Indian names, puts you in good stead. If you're living in India, carry on buying stocks here. But the mantra I have taken is 1/3 global, 2/3 Indian. And so far, Udayan, in the last 2 years, my better half and myself have done just fine out of that.
Okay. Devina, this morning, in the first session, I asked the same question to Samir Arora, and he almost thumped the table and said, concentration is the biggest enemy of your portfolio. You seem to agree with that because you own more than 50 stocks in your portfolio. Saurabh has only 15. Why do you think that one should have a far more diversified portfolio?
Well, that's what the statistics show. I mean, people tell me that you picked Amazon at $12 and you picked HDFC Bank 1 year out of IPO. Tell me the next HDFC Bank, I want to buy it for my son or daughter and keep it for 25 years. I said, nobody has that crystal ball. If you did, you would find investors in the world who have invested, if not 100% in multi-baggers, 90%, 80%, some number like that. There is nobody who has done that. Warren Buffett says that if you take out my 8 best bets in 60 years of investing, you will find that I have underperformed the market. Because you cannot know upfront which are going to be those stocks which compound at those levels. If you would ask Jeff Bezos or Aditya Puri, they could not have told you that. So the only way to do this is to have a a portfolio of at least 25, 30 stocks, chosen with care, with a system, and yet you will find that some of them will turn out to be duds. So as I say, first thing one thing which will really help your portfolio is that when you're making a buy decision, tell yourself I may be making a mistake. So that you don't stop yourself from acknowledging a mistake if that is the case. So if you buy 25, 30 stocks, yes, if you've chosen them carefully and if you are lucky, you will find 2, 3, 4, 5 which have done, which become multi-baggers. But do you know upfront which are those 5 and therefore you can buy only 5? No. And in a concentrated portfolio, also typically I find a lot of people when they talk concentrated, it is not just the number of stocks.
Carry on.
Hello? Yeah.
Yeah.
So then don't just buy 15 stocks. They buy it only in 2 or 3 sectors. So effectively, you do not even have that diversification to the extent of 15. Because those sectors move together, and as I say, no theme runs forever. Any theme you want to put, businesses and stock markets are 2 different things. You can pick up any sector, and you will find stocks in the steadiest sectors which have not performed for 10 years, 15 years at a time. So that you have to take into account. And we believe in sectoral diversification. We believe in diversification in terms of securities. And we have backtested it. And always also remember that investing is a loser's game. So first thing you have to make sure is that you reduce volatility, you reduce drawdowns. That's what we tell our investors also, that 60% of what you pay us is for risk management, 40% is for return management. So ask your fund manager or financial advisor, what is your risk management strategy? Because the only way to win in this game is to make sure you don't lose big. So every conviction has to be held very lightly.
Kenneth, which of these 2 schools do you belong to? By the way, when you started your first answer, I think they're all cursing me because you started by saying, you can build a high quality portfolio with a 10 to 15 PE. And they said, okay, what next? And you proceeded to something else. I think that's the part they're interested in.
Okay, I've been on both.
Little louder, Kenneth.
My investing experience actually got built through through what Peter Lynch wrote in all his books, right? So one way to outperform indices is there are 2 ways to outperform indices. One, you build a portfolio outside the index, so you take the breadth of the market, and the second way to do it is concentrate within the indices itself. Okay, and both work. So I've had colleagues and I have a peer group who've done extremely well for a long period of time, and everyone has different styles. I think you've got to pick the style that works for you. Okay, and the longer you keep doing it on that style and the number of stocks that you're doing, I think you will just, over a longer term period, you'll stop making mistakes. Like Devina says, you stop making mistakes and let the winners run. And that's how I do it. So my sweet spot is anywhere between 20 and 30 stocks. That's a lot. That's 50% more, but that's a sweet spot that we are in. Okay, so that's a little bit of the concentration paradigm that I've come across.
Okay. Rhythm, I want to ask you about, there's a final session this evening about how to generate alpha. But since you're not going to be there for that section, I want to touch upon what Saurav said earlier about ETF investing. Because the strange phenomenon is that India did very well relative to other markets in 2022. But 60% of the funds in India actually could not beat the index. All the PMSs and mutual funds did far worse than the index. How do you, we know why it happened, but what's the way around that?
So, Udyan, that's not a 2022 problem.
Perennial problem.
That's a perennial problem. I think Devina mentioned this, that picking a 10-bagger or a 100-bagger, knowing that in advance is very hard and almost impossible. Likewise, picking a fund manager who's going to outperform in advance is a similar exercise, and it's not really possible. And I think it was in the 1994 Berkshire Hathaway AGM that Charlie Munger, in response to a question about how to invest, said that unless you have Warren Buffett's skills, just buy index, right? And the index investing has boomed in America as a consequence of the fact that it is very hard to know in advance which fund manager will do well. And this actually goes back to this whole concentration and diversification debate. It is all right to concentrate so far as you have the skills and, more importantly, the stomach to sit through it. I mean, what Saurav has, which a lot of us don't have, is a lot of stomach. I mean, he can sit through that volatility that a 15 stock or a 10 stock portfolio will suffer. If you don't have that stomach, and if you're prone to making mistakes, when your stomach starts grumbling and you start feeling uneasy, then you have to do what Devina is saying, which is buy a well-diversified, geographically, sectorally, asset-wise, which will not go through those drawdowns that, concentrated portfolios go through. So I think that's where the concentration versus diversification debate lies. There is nothing right or wrong. It's just about your own, what is your own character? What is your own character? Do you have the ability to sit through the extreme volatility that concentrated portfolios tend to suffer from? So going back to your question, it is as difficult picking up the winning fund manager. So if you don't have the stomach to go through that underperformance, then you have to do what Devina says. And if you can go through it, then, fund managers bounce back, just like markets bounce back, just like stocks bounce back. So those who underperformed in the last 2 years will likely outperform in the next 2 years. Only thing is we don't know who. And on the question on ETF, I think Saurabh alluded to it. It's a pretty scary thing out there, because I think now 40% of global equity assets are sitting in ETFs, and they will produce anomalies on valuations and prices, which will be, of course, mouth-watering for active fund managers. But while that process is on, it's not going to be a very easy process to deal with. And one of the reasons why active fund managers suffered in 2022 was as a consequence of this phenomena. It's starting to happen in India. It's building momentum. ETF is gaining size. In fact, it's gained, I think if I'm not mistaken, it's up 25 times in the last 5 years.
Wow. Saurabh, what is this fair amount of stomach that your investors or any investor should have? Because it is normal for fund managers to go through years where they will underperform. And it's normal for fund managers to say, in the long term, I will make good. But as a fund manager, what should you tell your investor that give me these number of years, and if I'm still underperforming, then something is wrong?
So I think that the stomach piece is exactly the heart of this, right? So just to sort of take the first inference from the stomach piece, because this is tough, because running concentrated portfolios even in America is tough, you don't have too many Warren Buffetts or Rowan Cunniffs or Lou Simpsons and so on, right? The concentrated investors, even in a giant market like America, are few and far between. And as everybody on this panel is saying, America is getting ETF'd. And as America gets ETF'd, the inefficiencies are greater, right? There are fewer and fewer active investors applying their mind. That means the opportunities for concentrated portfolios are greater. But as everybody is saying, you need stomach to do this. Now, let's understand what do we mean by stomach. What we mean by stomach is as follows. If, for example, if everybody in this room has seen that for 30 years Pidilite has made white glue, and white glue has sold, and Pidilite, I think, has compounded free cash flows at 25-27% for the last 20 years, naturally, everybody in this room will infer that Pidilite will continue compounding cash flows, say at least for the next 10 years, right? So Pidilite becomes like a long government bond, 10-year government bond. The expectation from most people in this room will be, Pidilite's done this for 30 years, they'll do this for the next 10, and let's therefore treat it like a 10-year government bond, steady cash flows for at least 10 more years. In contrast, if Coal India hasn't grown free cash flows, or actually hasn't had free cash flows many years, and those free cash flows don't grow, nobody expects Coal India to be growing cash flows for 10 years. Perhaps people expect it to grow cash flows for 2 years. It becomes like a 1-year, 2-year government bond. Now, in that circumstance, if you bang up US interest rates by 4%, naturally the company which has got greater growth embedded in it will correct more than the company that has less growth embedded in it. Coal India or a Power Grid had less growth embedded in it, it will correct less. If you have, like we do, a concentrated portfolio, it will fall more than a portfolio made up of, as everybody here is saying, a mixture of things. If I had Power Grid, Coal India, public sector banks, it would fall far less, because the embedded cash flow growth will be, the expectations will be far less. Now that we infer is an opportunity. Effectively, if you see our portfolios, profits are up 20-25%, EBITDA or cash flows are up 20-25%, but the share prices are down 20%. As everybody is saying, that's a challenge for the stomach, right? So I've had to have lots of or digestives to deal with the fact that my profits are up, EBITDA is up 25%, share price is down 20%. And all we have to do then, in inverted commas, all we have to do is tell our clients, what do you want to do? Do you want to follow share prices through the rest of your life? Or do you want to follow companies whose profits are rising 20, 25%? In fact, in our small cap portfolio, EBITDA is up 35% first 6 months of the year, although share prices are down 15%. What do you want to do? Do you want to invest in companies whose EBITDA is up 35, share price down 15? Or do you want to follow Coal India, Power Grid, State Bank of India, which is a perfectly valid way to invest? That's a perfectly valid way to invest. Our point of view to our clients is follow the companies who compound cash flows consistently. Yes, you will have rough years, like the last 12 months, but that's the nature of the beast. If you didn't have those rough years, then everybody would do what we do now, right? And therefore, that is the balance, that's the perpetual debate in investing. Do you want a basket which has got everything in it, Coal India, Power Grid, State Bank of India, Bank of Baroda, and Pidilite, Titan, or do you just want the quality stuff? If you just have the quality stuff, you will go through rough periods. In Hagstrom's book and in my practical experience, out of 3 years, you'll have one rough year, right? Typically, sometimes you have longer, but typically out of 3 years, you'll have one rough year. But that's the price you pay for superior performance in the long run. If we look at America as a whole, and if we say the Indian market will one day end up like America, the American public is saying we have no appetite for trouble. We want the whole stock market in our portfolio, hence the rise of ETFs in America. And perhaps if we end up like that, then people like me will have greater anomalies that I can profit from. But yes, as Rhythm and Udayan are saying, we will have a bumpy ride along the way.
You can hardly blame the Americans for not wanting trouble. They had Trump for 4 years.
It's a valid point.
Kenneth, the other thing which keeps coming up in conversations this time, I'm sure it comes up in conversations with fund managers like you, is you had a year where most funds delivered low single-digit returns. Fixed deposits are giving you 7-8%. Fixed income is looking quite attractive as we enter this year. Can you promise returns superior than fixed income in the foreseeable future?
Well, that's going to be one of the biggest challenges for equity, right? And I don't know about 1 year, but over a longer term period, that number is certainly quite okay. Delivering over a high yield over fixed income, that's certainly okay. Because if you look at most of the established portfolio managers who've got more than a 10-year track record and are still around in some format, they have done in excess of 13 to 15% of CAGRs through that entire period. Near term, that challenge exists. I think it's a great time for investors. So apart from just saying that equity is the only thing that you need to invest in, though I'm an equity manager, I think fixed income gives you an enormous opportunity.
Please.
The debate is actually not about fixed income. In the last 5 years, 4 out of those 5 years, the top performing asset class for an Indian investor has been gold.
Gold, I know. But gold is such a bad word for people like you, I dare not mention it.
No. That is one that begs attention, because if you look at it from a long-term perspective, again, going back 25 years, yes, the Sensex has been the best performing asset, but it doesn't fare so poorly. No. Fixed income, which is fixed deposits and the treasury, and surprisingly, even property has done very poorly compared to gold and equity. So I think the debate is this, another year for gold.
I'd just like to add to that. The gold, if you look at from about 83, 84, for 20 years gave zero return. So nothing is lost bit, which is that have that for a limited period of time, just as every other country in history has had. But we have not been able to find employment, even pre-COVID. Even pre-COVID, our unemployment rate was at a 40-year high. Unemployment is even higher among the young. So that is what worries me, that you will never get that demographic dividend actually show up in the economy, because you're not able to employ those people. And that employment drives things at both levels. One is at the output side, manufacturing or services, as well as then therefore that per salaried person consumes stuff and therefore drives demand for everything else. So that to me is that we'll miss that bus. That to me is the biggest worry. And which also ties into education, health, especially after the pandemic when children have lost 2 years of schooling. Because if you don't invest in education and health, you will have a next lot of unemployable people. So for whether for the budget or longer term policy, those have to be the focus areas: employment, education, health.
On that note, thank you very much, all of you, for joining in today. Thank you very much indeed.
Thank you, Udayan, and thank you, everybody. Well, no summit would be complete without a discussion on the macros and the fiscal picture. So let's talk about budget 23-24. Joining us is an esteemed panel of economists to really give us some insight and expectations as to what's in store for us this year. In conversation with Rahul Kanwal, News Director, India Today Television and Aaj Tak, Executive Director, Business Today, I'd like to invite on stage Pranjal Bhandari, Chief Economist, India, HSBC, Samiran Chakrabarti, Chief Economist, India, Citibank, and Soumya Kanti Ghosh, Group Chief Economic Advisor, State Bank of India. A big round of applause, everybody. Thank you so much for joining us. Rahul? I think you've scared him into... Yeah, he's... Rahul? Yes, great. Over to you for this wonderful conversation on the fiscal overhang and with an eye on the budget.
Hello and welcome. The last session at the World Economic Forum in Davos is a global economic outlook. And what I thought we'd do over the next several minutes here at the Business Today Market Summit is to do an India economic outlook with some very sharp economic minds. And the global consensus seems to be that the world could potentially be able to avoid a hard landing and a deep recession and instead get away with a softer landing and slowing growth. What does that mean in the context of the India growth story? We have a big budget coming up in just a few days from now. Crucial also because this is arguably the last budget before the election cycle kicks in. So what can Finance Minister Nirmala Sitharaman and the Modi government do to capitalize on the unique global headwinds and tailwinds that are playing out at this moment? So to talk about this at the Business Today Market Today Summit, I want to introduce our panel of guests, starting with Pranjal Bhandari, Chief Economist, India at HSBC. Flanking her, Samiran Chakrabarti, Chief Economist, India at Citibank, and Soumya Kanti Ghosh, Group Chief Economic Advisor at the State Bank of India. So let me start by asking Pranjal about what do you think Finance Minister Sitharaman can do at this moment to try and make most of the global tailwinds that seem to be blowing in India's favor?
Yeah, thank you very much. I think the best thing that can be done now is to keep the budget boring. And by boring, I mean keep it predictable, keep it credible, and just go on the path which you've promised. Now, we talk a lot about growth, But in a year like 2023, when there's a lot of uncertainty globally, I think the best thing that we can do in India is maintain macro stability. And macro stability means low inflation, fiscal consolidation, lower trade deficit than what we had last year. Because if the stage is set with macro stability, when the global economy turns and rises again in the next couple of quarters, hopefully, India will be ready for a takeoff. So I think the budget should be boring. It should basically focus more on macro stability rather than high growth. And from that perspective, I think the path is very clear. The finance minister has already spoken about a fiscal consolidation path, bringing down the fiscal deficit from 6.5% to 4.5% over the next 3 years. It should really, focus on that path. Of course, on the background, some changes can happen. For instance, improving the tax regime, and we can come back to that later, and also focusing on capex, which has been a thrust of the government, but mostly focusing on continuity rather than doing something dramatic and big bang.
Given the emphasis that we've seen on public spending and capital expenditure, do you see that continuing, or do you think it's reached a level where the government will need to start cutting back, Samiran, to some extent? What do you think can be done in this unique moment for India to try and step on the accelerator on economic growth?
Clearly, Rahul, I would say that investment. I think in the last year's budget, if you look at, this was the theme of the budget. We don't change themes every year. So there is a need to continue with that theme. And our sense is that not only in rupees trillion terms, but also as a percentage of GDP, there's a need to increase the public capex part. And increasingly what the central government is realizing is that it's only a limited areas where the central government can make a lot of capex. The power lies often with the state governments. So it's quite keen to deliver a larger amount of resources to the state governments to spend as well.
But when I speak to bureaucrats and ministers in the government, what I find is a growing sense of unstated frustration with the fact that when it comes to spending, the government is having to do the heavy lifting, and despite the deep and sharp reduction in corporate taxes, private investment isn't stepping up to the plate. And I think Nirmala Sitharaman has publicly spoken up about this a couple of times, nudging India in to do more when it comes to investment. But that, for some reason, doesn't seem to be happening.
So I don't think there is any other option but to be patient. We have to understand that even pre-pandemic, India was going through pretty slow growth compared to what India's history has been. And the pandemic has obviously had almost 2 years of low growth. And now with this whole geopolitical uncertainties, it's difficult for private capex to immediately pick up, given the background that we have seen of last 5-6 years. But what we have to also keep in mind is that we are now reaching almost all the preconditions that are required for a private capex recovery. Look at corporate balance sheets. If you look at the financial system balance sheets, we haven't seen this kind of a balance sheet in almost a decade. So with the right kind of public capex and the policy thrust that is there towards manufacturing that this government has put forward, I think it's just a matter of time we will see a private capex recovery.
But Soumya Kanti Ghosh, this is something that the pundits have been saying for a long time, that capacity utilization is in the mid-70s. India is poised for a multi-year investment cycle, an investment cycle which so far hasn't kicked off in right earnest. Why? And do you think, like Samiran, that that's now finally about to change?
Yeah, thank you, Rahul. No, I think that last 2 years during the pandemic, if you look into the corporate balance sheet, they have significantly deleveraged. And so that's the first thing. So that's one of the preconditions for investment taking off. The second point to note is that if you actually look into the bank credit today, credit growth actually has continued to expand, even though there has been some moderation in the recent weeks. And a large part of this credit growth is not only the working capital requirement, which typically comes when the inflation is on the higher side, but also term loans and also some project announcements, as we are seeing in our books. So in my sense, I think there is evidence of an pickup in private investment activity. May not be that encompassing which all of us want it to happen, But at this point of time, if I look into the sectors which has deleveraged, like steel, like, the metal sector, there is evidence of, some amount of private investment picking up. But as we progress, and as basically as all of you also, as also there has been a lot of geopolitical conflict and uncertainty. So I think as the fog clears on the global economy also, I am sure that the investment is going to take off in a meaningful manner.
One of the Modi government's big thrust areas is to boost manufacturing and to take manufacturing to 25% of India's GDP. The needle hasn't moved much when it comes to the ratio of manufacturing as a percentage of GDP. In Vietnam, it has. And the big question in India and globally is, to what extent is India being able to benefit from a global realignment of supply chains, with many global corporations looking at an India plus one strategy? Is, Pranjal, in your view, India likely to be the prime beneficiary or just one of the multiple beneficiaries of this realignment?
Yeah, I think the good news is that India has gained global market share in some high-tech sectors like mobile phones, drugs and pharma, automobile parts, and IT services. So that's the good news. But the problem is that we are actually losing global market share in trade in medium tech and low tech. For example, textiles, for example, small electronics, for example, agricultural products. I think our problem is why our manufacturing to GDP share is not rising dramatically, like, for example, Vietnam that you mentioned, is our industrial structure. We have too small firms which never grow over time. We call it the economic dwarfs, there can be different names to it. The problem is, if there are too small firms, they never gain economies of scale. They never become too efficient to sort of, really compete on a global level. And that is, I think, our real problem. And I think the big challenge is, how do you let small firms grow from small to medium to large, which is something in our country we don't see too much of.
I had a fascinating conversation with Raghuram Rajan, Pranjal, at the World Economic Forum about manufacturing and electronics. And his argument, and I'm curious to know what you think, is that PLIs is basically subsidy for capitalists, that there is very little value add happening. And while, of course, manufacturing is growing up, there's nothing to tom about in terms of it being a big achievement for the government, that this is money that could be more wisely spent in things like higher education, produce more engineers. That has a higher ROI than just giving money through subsidies to corporates.
My sense is the PLI scheme is an experiment worth doing. We are trying to sort of, look into futuristic sectors and ensure that, India at least tries, right? And the other reason why I think we should do it is because it's actually not very costly. Barring the semiconductors, it's just over 2 trillion rupees spread over 5 to 6 years, which is our 1-year fertilizer subsidy bill. So it's not that much money. And even within that, the money was made possible by retiring some old export subsidy schemes. So there was smart thinking done there, and I think this is an experiment worth doing. But is this enough? Will this change India's future? Will it make it a big manufacturing hub? I don't think. I think a lot more needs to be done. Most importantly, I think overall business climate needs to improve in a way that small firms can grow and become large over time.
Samiran, especially on the issue of value add, opinion seems very divided amongst pundits on the efficacy of production-linked incentives. Are they working in your view, or are they not working in the way they should?
So Rahul, in a very broad sense, economists will always argue against subsidies in any context, whether it is the context of in manufacturing or it is the context of food subsidy. Economists have a natural bias against subsidies. But having said that, the way to think about PLI, in my view, is that is it going to be enough to move companies who were thinking about investing in other geographies to come to India? Is that going to give that extra bit of leverage to us? And in that context, it's very important that the first few PLI schemes are success. Because I can tell you from my experience that a lot of foreign companies are thinking about India, but they are also fighting a perception battle that in the past, investing in India has been difficult. So if there are some companies which can show that, yes, India has changed and it's possible to do business in India and be profitable, then a lot of players who are waiting in the wings can also join into the scheme. While Pranjul is making a very valid point that the extent of subsidy is still very limited. It's less than 1% of GDP by our current GDP standards. The critical thing is that the sectors on which PLI is there is also less than 1% of GDP. So even if that less than 1% of GDP grows at a very fast pace, that's not going to move the overall GDP growth needle. So either we have to think of this as an experiment which brings in more investment in other non-PLI sectors, or we will have to expand PLI to a vast many sectors for us to see the whole macro impact of PLI. Otherwise, what's going to happen is that this year we will be discussing PLI. Next year when you are going to call me, you are going to find another acronym and we will keep on discussing that acronym without having the continuity that we require.
Soumya Kanti Ghosh, you're very bullish on some of the policy moves that the Modi government has made and their potential impact on Indian economic growth. But like we were hearing in the conversation with market experts before this, the fact that this is India's moment is not being said for the first time. Now, this is something that's been said multiple times in multiple years gone by. And therefore, what makes you confident that this is truly India's moment? Because in the past, we've had the knack of finding some way of snatching defeat from the jaws of victory, or not being able to capitalize on the moment like we should.
Yeah, thank you, Rahul. I think I will just very quickly quote some data points to support the point that Indian economy is actually placed in a sweet spot. The first is that look into the banking sectors. The net NPA is now at 10-year low. Credit growth is at 10-year high. Look into the digitization. The total number of UPI transactions this year is already touching 100 trillion. That could actually go up to 130 to 35 trillion at this rate, which could be 45% of India's GDP in the current year. Look into the SME sector. The overall credit growth in the current year, 10% is being contributed by the SME sector, and there is now clear evidence that a part of the SME sector is actually getting bigger. That means they are moving up the value chain. Then there is the look into the external sector, export data. Even if last year we did 420 billion, at the current rate we could actually do around 450 billion. This is apart from the services data. Tax to GDP ratio this year could be at the highest level, and India is the only country which has increased and seen an improvement in the tax GDP ratio. So there is compelling evidence of the data supporting that we are in a sweet spot. But the fact is that we need to take advantage of that. In the past also we had done, even in the external sector, we have already recouped more than 50% of the foreign exchange reserves, which is at the lowest level at the end of October. So in rupee, in real terms, it is actually appreciated if you look into the BSI data. So household debt to GDP ratio, look into the latest BSI data, it has actually now declined from the peak in March 2022. So on all counts, we are in a sweet spot. The point is, where do we grow from here?
Okay, so let's come to that, because we saw recently the World Bank enhance India's growth forecast from 6.8% to 7% for this fiscal. I'll start by asking Pranjal first for her broad sense for how the Indian economy is likely to grow next year.
Yeah, I think next year is going to be a bit turbulent and growth is going to slow down for a couple of reasons. One is global trade is slowing. You mentioned that a lot of people are not expecting a hard landing, but it's still slowing across the world. We can see trade volumes that we track very easily slowing. So exports will slow, and exports are important because they were a big driver of our growth when we bounced back from the pandemic. Then if you look at our consumers, a lot of the pent-up demand after the pandemic is now done. If you look at the deposits at bank, they are back to pre-pandemic levels. And then you have a government which is trying to bring down the fiscal deficit. Fiscal consolidation in the short run can take away from growth. So I think for all of these reasons, we will see growth softening in 2023. But we should not worry about it. We should focus about macro stability, keeping inflation low, bringing down fiscal deficit. Because once the global cycle turns, I think India today is is really geared for a takeoff. And I would agree with Soumyakanti Ghosh on many of these points he's made. I think there are two very exciting sectors, high-skill exports where India is doing well, and then the entire tech startups. I know it's slowing a little bit right now, but this consolidation is good. I think in the medium term, our tech startups can find a lot of digital answers to real-world economy
But at this
problems.
moment, what's your estimate for growth for next year?
For next year, we have growth at about 5.5%. But after that, we have growth going back to 6% plus.
At this moment, you have no intention of revising upwards the growth figures from what
No.
you did previously.
Yeah,
Okay,
yeah.
Samira, how do you see India's growth outlook for next year?
As Pranjal was mentioning that there are some headwinds to deal with, but the way I generally want to look at this number is that if you look at last 2 decades, on an average, consumption has always contributed about 400 basis points to GDP growth, at about 4%, becomes like a absolute bottom for us. And on top of it, if we get just about 7% investment growth, we are at 6% overall GDP growth. So I think 6% kind of becomes a number which is quite achievable. On top of it...
So you're slightly more bullish than Pranjal is.
Yes, I am. I think that the current data is not supporting a slowing economy. So there is right now a big disconnect between the data and the narrative. The narrative is more negative, as some of the things that got discussed earlier about headwinds coming from global slowdown, headwinds coming from fiscal contraction, monetary tightening. But you look across all high-frequency data, there is barely any slowdown in that. We are still running at a rate which is almost pre-COVID growth. So I think I will be slightly more optimistic on achieving a growth number of closer to 6 next year. But obviously global headwinds can change.
So we are getting more optimistic as we go from right to left, from 5.5 to 6. Soumyakanti Ghosh, are you taking the needle up even further?
No, I think I would tend to agree with Samira's point. We are a little higher than 6%. I think one possible advantage next year is that prices will actually be rapidly cooling off. So, I mean, for example, oil prices. Also, the fact is that the globally, domestically, I think inflation possibly has seen the worst, the peak, and inflation will progressively come down next year. Food prices has been surprisingly, even after such an bad weather in the last 3 months, I think unseasonal rains, food prices have behaved remarkably well. And with a 46% weightage in the overall CPI basket, if inflation behaves well, which is doing right now, and actually it has surprised a lot of the market expectations and forecasts, I think the stage could be set for a positive GDP surprise next year, because all GDP numbers last year, I think there is a disconnect between the leading indicators and the GDP. Last quarter GDP, the forecast which the NSO gives out 7%, I think that was nobody was expecting. So I think that next year we could see a positive surprise on a back of a relatively stable macro environment where inflation will not be an evil as we have seen this year.
Now, one of the reasons why so many global companies are bullish on India at this moment is also because what's happening in China. But on China, opinion is divided. Pranjal, the one sense is that China's decline in terms of economic growth is now permanent. The number of old people is growing up, the youthful population, working age population coming down, and therefore this idea that companies will look beyond China on the back of the pandemic, on the back of growing trade tensions between China and the United States is now inevitably going to help India. The other thought is that some of the obituaries about China's growth have been written in the past wrongly so, and China is a story which global leaders like to kick down. Look at the manner in which the economy is reopened after all the COVID cases and the deaths stabilize, and because Xi Jinping seems to be showing greater moderation and more pragmatism, China may not be as badly written off as many pundits would like to believe. Where do you see China go next?
Well, look, I just want to make one point here. What we find in China right now is that they are sitting on about $1 trillion of excess savings of households who were in lockdown for 3 years. And as they gear to spend that will provide some stabilization to global growth. When you made the point that we will not have the hard landing, I think a lot of that will come because now China is reopening and Chinese households and consumers are ready to spend, are ready to travel. So from that perspective, you can't completely write off, a very large economy like China. There are global value chains that are rejigging across the world for various reasons. A lot of people talk about deglobalization in growth, and maybe there are in goods, and maybe there are not too many opportunities there. But I think where India has a big opportunity in front of it is continuing globalization in services. I think we stand in a very unique position. We've been there from the knowledge processing center days to now the GCC, Global Capability Center days, when a lot of large multinationals want to put a lot of their research and back-end work in places like India. And I think we really stand to gain on that part of the global rejigging of supply chains.
Samir, two things could happen in China. One, because of pent-up demand on account of the economy and the country being shut for 3 years, China is bouncing back, but this is temporary. It kind of falls to a new level, which becomes the new normal for China. The other is that don't get pessimistic on China just yet, because it could bounce back and stay high. What do you think will happen next?
So Rahul, very interestingly, if you look at the IMF forecast for India and China growth, what strikes is that over the next 5 years, India's GDP growth is going to exceed Chinese growth. And that's going to happen first time after 1960s. For 1970s, 80s, 90s, 2010, 2020, 50 years, India's growth has always been lower than China. I think that way, it's an unique opportunity for India. But if I answer your question more directly, there are two things going on in China. One is the reopening trade. The other is the real estate trade. And both things can have very different implications for India. I think the reopening trade, the $1 trillion excess savings that Pranjul was referring to, is going to be spent more on services. That's not going to cause much challenge for India. It's the real estate trade. If the Chinese real estate now starts picking up, that's going to create the next commodity price cycle. And that can destabilize the point that Shomo was mentioning about low inflation in India for 2023 being a tailwind for us. That theory can get questioned. And the last issue is that to what extent this China reopening would lead to a reallocation of capital flows in the EM space. We are already seeing that in the first few days of the year, money has flown or got reallocated from India to China. The Chinese market valuations are much more attractive at this moment than the Indian valuations. So if this continues, then that can become some sort of a headwind. So commodity price effect and the capital flow effect are the two things that I will have to watch out for.
Soumya Kanti Ghosh, a lot of the current economic narrative around China was built at a time when the economy was shut. Xi Jinping acting as the ultimate emperor, taking impractical, irrational decisions that seemed to be damaging the economy. The last few weeks, though, at great cost to Chinese health infrastructure, has suggested much greater pragmatism. Does that then mean that a lot of the benefit that a country like India would have been hoping to get out of China's economic slowdown now just stays hawa mein and doesn't actually materialize on the ground?
I think that's an interesting point. But before that, let me just give you one data which Shomiran talked. I think in terms of the stock market resilience, India's the market capitalization is increased in dollar terms 2.3 times than what it was in March 2020. So that's one of the impact of this China. Now, specifically in terms of China, I just want to play a devil's advocate over here. I think China, it's always difficult to believe the data. So, yesterday there were some numbers which are saying that 80% or 90% of the population is already going to get infected. And please note that China doesn't have an effective vaccination strategy for its population, which India actually had, and India was able to quickly ramp up the vaccination for its population and in a war mode. So with the country and given the type of disease it is, the COVID, I think without an effective vaccination strategy, China may be reopening, China may actually, there could be some reallocation of capital. But over a point of time, I think India will stand at a far better advantage because after
once
this
China reopens, and let's assume that 80% of the population has been infected, whoever is vulnerable and susceptible suffers the consequences. A lot of people even die. But then the economy is open and people have immunity. So they can get back to business as earlier.
Yes, but that will take time. For India also, we saw that vaccination strategy played out over a point of time. From May 2020, when we started to vaccinate the people, we were able to vaccinate a large part of the population in 2022 beginning. So if I go by that trend only, with the same population of China and India at this point of time, I think it will take a larger time to vaccinate this entire population. Till that point of time, we can enjoy the tailwinds of the global economy. But of course, as China opens up gradually towards the end of the year, it could be competition between the two.
In the few minutes that I have left, I want to spend time talking about the outlook for GST collections. We've seen GST collections on a monthly basis hover in the range of about 1.5 lakh crore rupees. Is that, Pranjal, where you see GST collections stay next year? Do you see a potential for a moderate to high increase, or do you actually see them come down on a monthly average basis?
Well, it should rise in line with nominal GDP growth. But if you want it to rise even more sharply, like we saw over the last year, I think we need continued reforms in GST. We need to get more items into the GST umbrella. We need to talk about lesser number of slabs, more uniform rates. I think we need more reforms on GST if we want continued improvement.
Which of course every economist and right-thinking person would want. But Sameeran, are you concerned that given the practical reality of this being a general election year, that any reform, whether it is on the GST side, whether it is on tax, or whether it is in terms of pushing through hard disinvestment, will actually now only be seriously considered after the 2024 general elections? Or do you think that the government could potentially surprise?
So just a quick point on GST is that this is a peculiar year where for the first time, the central government will be collecting 1.4 lakh crores of GST compensation cess, but will not have to share it with the state governments. So that's going to make the fiscal arithmetic look much easier for the central government. But on the reforms question, I think where I started from is where I would want to end with. Public capex is one area which I call reforms, which will have no political ramifications. So it's the easiest one to push even in a pre-election year. If you look at other reforms that economists typically talk about, there are winners and losers in those reforms. And typically every finance minister will be very considerate about implementing those reforms in a pre-election year. So I'm not penciling in too many of those reforms for this year, but public capex push is something which everyone likes, affects everyone positively, so why not do it?
Soumya Kanti Ghosh, are you surprised with the government's approach on disinvestment? Arguably the most vexatious PSU to disinvest was Air India, which got pushed through with a lot of determination, and a lot of other strategic disinvestments, which should arguably have been easier to find a way to push through, have somehow not been done. And are you fearful that given the fact that we have an election, that a lot of this could be pushed out till after the next general elections?
Yeah, I think the answer is both yes and no. In terms of the disinvestment, I believe that more could have been done. But on
this is what economists love to do. They like to give answers which have both yes and no, and everybody else, like normal citizens, wondering, did he mean the yes more than, or did he mean the no more?
I'll explain that. But the good thing is that the government has been able to compensate the decline in disinvestment revenue through a surge in the tax collections. The tax buoyancy ratio, which is historically at 1.1, means that it has been much higher in the last 3 years. So whatever has been the shortfall in the non-tax revenue has been compensated by the tax revenue, and that is because of the efforts which the government has been doing. So in my sense, yes, there could be a shortfall in disinvestment, or may not be that to the extent which we could anticipate. But my sense is that a large part of that will be offset by a buoyancy in the tax revenue.
Now you have to explain the yes and no on disinvestment. It can either be a yes, that they will push through on disinvestment despite it being a general election year, or it can be a no, they're more likely to push it out till after the next elections and not take any panga at this moment?
I think in terms of the disinvestment, some of this is very politically sensitive. Also in terms of the privatization, I think maybe that may not be touched this year. Maybe that could be pushed next year. But there is always this helping hand in terms of the tax buoyancy.
This was an interesting conversation. I want to thank Pranjal, Samiran and Soumyakanti Ghosh for joining us at the Business Today Market Today Summit and sharing your thoughts on India's economic outlook. Thank you so much. Thank you.
Thank you so much, Rahul, and thank you to all of our guests. Now, I don't know how many of you invested in some of those tech stocks, the tech darlings of Wall Street while things were good. But we're here to discuss what to do with them when things are not going so good. Investing beyond Indian horizons. In conversation with me this evening, I have joining me just take a moment to make sure we're ready. I'd like to welcome on stage Neil Parag Parekh, Chairman and CEO, PPFAS AMC, and Prateek Oswal, Head Passive Funds at Motilal Oswal AMC. Gentlemen, thanks so much for joining me. All right, great. So, where should we start? Because things are taking a nosedive, and I think the best place to start is exactly there and understand how you're viewing the current situation when it comes to the tech winter that we're seeing on Wall Street. Is this just the beginning? I mean, people have lost a substantial amount of money. Did you see this coming? According to Rajiv earlier on, didn't see it coming fast enough.
Hi, thank you, Abba, to have me here. First of all, I think when we're talking about the tech sector or the NASDAQ in the US, I think we need to differentiate between mature tech companies and the new age tech companies, So I think during COVID, we've seen a lot of these companies go up multifold, obviously because interest rates were low, funding was easy. So a lot of these companies went up. Without any fundamentals, So I think that is one space that I am not that confident that it could bounce back or there's some pain left there. But on the other side, there's the mature tech, which is your Googles, Facebooks, Microsoft, Amazons, the bigger companies, which you can, they do have fundamentals. They are profitable. They are growing well. And if you've seen over the last 20 years, 20-30% fall in tech stocks is not that uncommon. So we are not perturbed about the mature tech space. In fact, they provide a good entry point right now. So I would differentiate between the two. I'm not too confident about the new age tech, but I'm very confident about the mature tech.
All right. Prateek, what do you say?
Yeah. Firstly, thanks, PT, for having me out here. In terms of, I think tech stocks or investing in US or outside of India, I think just to take a step back, a little bit, I used to be a wealth manager in the US in San Francisco in 2018, and I had about 800 to 900 customers. All of them were 25 plus million in assets, so all ultra HNI types. And when I saw their portfolios, approximately 15 to 20% of their portfolios were invested outside their home country, which is outside the US. And I saw a similar trend of portfolios in the UK, in Europe, and also in Southeast Asia. And when I came back to India in 2018, I saw that no one was really investing outside. So I think it's important, yes. And one of the key differences to why I think investing international has worked well in the last, say, 5 to 10 years' time is because of ideally diversification. What essentially investors gain by sort of, having some of their portfolio outside their home country is that what we've seen is markets in the US and markets in India or international markets versus Indian markets move in very different directions. And that provides a lot of flexibility and a lot of diversification in your portfolio. What we've also seen is that international diversification is the only such asset class that actually not only sort of, gives you the same returns as what you would have in India, but also, really leads to a much better sort of portfolio in terms of diversification, which is what we saw, last year as well. The fact that Indian markets were resilient and the US markets weren't shows that diversification just play out really well. And obviously the idea is to really, ensure that, some of your money is diversified. And that's essentially where I think, investing in international comes in. When it comes to tech stocks, I sort of agree with, Neil out here. I think if you compare, say, last year with, say, the crisis that happened in '99, where there was an entire tech rout, back then you had a lot of these companies who were growing fast, but their balance sheet and P&Ls were quite weak. If you see last year, or if you see the current status of tech, these guys are absolutely cash flowing machines. They make a lot of money. Their cash flows are very strong. I think what we've seen, which is a positive trend that happened last year, is that the expectations have come down, which is actually great because, all of these companies who were valued at trillions of dollars were still being expected to grow at 50, 60% CAGR. So I think, now that we have some normalcy in the markets, and also their business models have not been impacted at all. In fact, they've become stronger since we've seen post-COVID. And I think, the entire tech revolution is still, yet to unfold. And it's going to obviously impact a lot more markets in the future than we have. So I do think that, obviously, investing internationally is great in terms of diversification. I do think that, most people would not really understand how to diversify, which is why I think mutual funds make a lot more sense for investors.
Okay, so fair point. I mean, you talk about diversifying into investing internationally, but of course, anything anyone thinks about is tech and Wall Street. So I want to get an understanding of, when you are investing, beyond the Indian horizon, what are investors asking for? I mean, are they literally just asking for FANG stocks, or are they also looking beyond? And secondly, when you say that expectations have moderated, have they really? Because we're looking at a 80% drop or a 50% drop coming in on some of these big names.
I think for the return part of it, I think we've been spoiled. I think last few years, I think we all have been spoiled for good returns. I think the expectations are still high. I think we've not seen a bear market for a while, and the newer investors who've come, and a lot of them have come in the last 4 or 5 years, they've not seen an elongated bear market, and that's what worries me. The worry is that the expectations are a bit high still. And I am not sure that, the last 2 years or before this year, the previous 2 or 3 years was great run. We got 30, 40% kind of returns, on a yearly basis, but that spoiled a lot of people. I think return moderation, it will happen. I think some people will learn it the hard way, that, getting 12, 13, 14% return is great actually from equities. I don't think you should expect anything. I mean, sometimes now I see the younger lot at least just expect 20% return, but that's going to be tough to get. Some people will learn it the hard way. Some people will obviously, hopefully we all will educate them and make sure that, the return expectations are maintained, and that equity is a long-term product. We are obsessed with the last 6 months or the last 1 year returns, but we're big proponents, and all of us here in the mutual fund industry, we keep talking about long-term investing, equities, 5+ year investing. But in the end, everything is, we're judged by the last 6 months or the last 1 year, so that is unfortunate. That needs to change. But hopefully, some pain probably would be there. I don't think the next 1-2 years are going to be that great as what we saw in COVID. I think some normalization will come through, So I think, in fact, right now we're in a very normal market. I think that time was a abnormal market where negative interest rates or low interest rates, easy funding, markets just going up, anything and everything was going up. I think this year, or the next 1 or 2 years will be a stock picker's market. You'll have to be really careful of what you pick.
I was just going to ask you that. I said, look, you have all the research, the reports, the analysis, the insight to tell us what makes a good investment when it comes to specific stocks, or even if you're going through a mutual fund, let's say you want to know where your money is going when it comes to some of these names. Where do you see value, or what is attractive to you on foreign shores, and why?
Yeah, so when it comes to, I think investing internationally, there's typically, I would say, two ways of why most people invest. One is obviously they want to invest. I mean, there is this sexy version of, buying the FANG stocks, Google, Facebook, Netflix, Amazon, which I think is fine if you're taking a very long-term bet on those business models. The second one, as I said, is more on the diversifying nature, where you're looking at, putting in portfolio allocation towards, some of these, at least stocks or mutual funds out there, which I think is also good if you're from a long-term perspective. And there you also have to, have that patience to sort of ride the tech wave or, ride ups and downs. Well, there's typically maybe two ways of investing. One is through LRS and the other one is through mutual funds. What we've seen in my experience is that, LRS is a lot more expensive. However, investors who are looking at choice, obviously we don't have a lot of choices here in the mutual fund industry, can look at that space really well. Again, costs have to be monitored, but someone who's looking for something very simple, who's looking for a, excellent portfolio manager, who's looking at, diversifying, can look at mutual funds, or if someone is looking for a simple index fund, they can also do that. So these are the very simple ways of, going about, diversifying, your capital internationally. In terms of, spots of value, I believe that, there is a lot of value today, especially on the basis of what has happened over the last year. I mean, for example, someone was talking about China right now. China, I think, has a current PE of about 9.5 right now, which is crazy low. Obviously, it comes with a lot of risk involved. You also have, other European countries, I mean, Russia, for example, has a PE of 2, which is crazy low. So I think value is there, but I do think that, investors, especially looking at going abroad, should ideally stay away from, doing too much research, because what I've seen in my experience is that the understanding is very less. Today you'll have someone come to you and say that 97% of wealth creation opportunities are outside of India, you should go for it. I can also say that 99% of commercial real estate is outside of India. Will you go buy it? Probably not, right? So I think what's important is investing in something you understand, and which is why I think something simple is a lot more effective for wealth creation than going out there and trying to pick specific markets or pick specific geographies or specific stocks also.
So with the changing environment currently, the changing rate environment, and the fact that everyone's predicting doom and gloom, overseas, which may or may not happen, do you feel that there is more of a case to continue to invest in the India story, or as you said earlier, would you suggest perhaps keeping your portfolio diversified, maybe 20-30%, is what Prateek was suggesting, to keep for overseas markets?
Yeah, I think we as Indians, we have a home country bias, which is that we are obviously very attached to our country and we think we know a lot about our country, and we're comfortable investing in India. The reason you go abroad to invest is not to get more returns. I think it's to reduce the risk, as Prateek said, that different markets move differently, and that's the beauty of diversification. You want two asset classes to go against each other. That's diversification. There's no point of diversification. Everything moves together, comes down together. So that reduces the portfolio risk. The other thing is, like we said, most of the opportunities, or more than 97-98% of the opportunities, are outside India. So sometimes just looking at 3 or 4% of the world, and we have 3 or 4% of the world market cap. So a lot of the opportunities lie outside India. And thirdly, I would think that a lot of opportunities in the listed space are in the US or in foreign markets. Like, for example, there's no equivalent to a Google or a Amazon or something like that in India. We don't have any cloud computing kind of companies, which if you think that's going to be the future and that's the growth prospect, then you have to go outside India. So I don't think you should be searching for alpha abroad, but I think you definitely want to diversify outside India to reduce the risk of the portfolio.
Okay, fair enough. So, give us, you were talking about doing it through mutual funds earlier, Prateek. So give us the best way to go about this, the kind of return expectation, your strategy now for 23, since we've entered a new year. Just give us a holistic view.
Sure. Yeah, I think in terms of, I think in terms of return expectations, that's super important. In fact, small story, in 2021, we'd actually, we done one of the largest international funds in India that's investing directly in the US. And we actually, sent out 2 or 3 emailers to our clients saying that, you should, lower your expectations when it comes to international investing. There's a lot of, talk and all about it. And on the basis of those emails, the interest in international funds actually went up, not down. So I think it's extremely important for investors to have very lenient expectations. If you look at the last 10 years, you can see great numbers. For example, when you look at 10 years ago, the Nasdaq would have done, I don't know, maybe 20-25% CAGR. But over the last 20 years, it would have done roughly the same as what India has done. So I think in terms of return expectations, it makes sense to have the same return expectations as what you would have in India. But I think what's important is, investors should expect risk to come down dramatically because of, diversification to come in play. So I think that's what we essentially tell investors is, I think maintain your expectations and obviously have a long-term approach. The second thing, and this is what, I was, talking to Neil about, before coming here, is that there's 2 problems, at least, not when it comes to international investing, but investing in general. And that was really showed, that sort of came into the picture in 2022, is that investors have, 2 things that are, sort of not going right for them. One is there's not a lot of sensitivity to pain is a lot less in sort of today's investor profiles than what it used to be, say, 5-10 years ago. So I think whenever an investor sees some, different portfolio not doing well or whatever, they tend to react very quickly. And I think if you ask any investor, successful investor, or even any entrepreneur, sensitivity to pain is extremely important, not only in success in work, but also a success in investing. The second thing, and this is again something which has led to a lot more speculation, is investing in a lot of these. I wouldn't say fads, but something keeps happening every year. So you had the US investing, you had cryptocurrency, you had sector investing. What happens is a lot of investors tend to overvalue owning something which is extremely exotic. Because it's a lot more interesting. But actually, wealth creation happens in very simple products. I think an investor should ideally, have most of their portfolios in simple products. And obviously, if they are looking at something complex or something which is exciting, that should be a relatively smaller part of their portfolio. And the same with international funds. I think what I've seen is investors who go chase after these, electric vehicle or biotechnology or these sort of thematic funds. It's very exciting to invest in these sort of themes, but actually, wealth is made if you invest in something as simple as an S&P 500 fund or like a simple broad-based mutual fund. And just sort of sticking to, I think consistency is very, very important for investors. And investing in general, I think, remain invested. If you have a thesis of you wanting to, put in 15 to 20% of your portfolio outside, stick to that thesis and, make sure it's there for the portfolio.
Neil? If you want to add to that in terms of, what you're looking at in 2023, in terms of overall strategy, with regards to all the moving forces when it comes to global markets right now.
Okay, so let me try to answer this slightly differently, So a couple of years back or during COVID, somebody asked Jeff Bezos of Amazon that so much is changing. How are you looking at things and how are you looking at change, And he had something very interesting to say. He's like, I am not really focused on what is going to change. I am more focused on what is not going to change. So let's see for Amazon. So he said that for Amazon, what is not going to change? Even 150 years, 100 years from now, what will not change? One is that when people are searching on Amazon, they are looking for the lowest cost product, So my job is to keep making the cost lower and lower. It's not like we go to Amazon and look for the highest, the most expensive product, So cost has to come down. Secondly, people want more and more choices. So his thing is that people are 50 years from now also going to want more and more choices. They're not going to want less choice, for the products they want. They want to compare and they want to contrast. So he's like, it's the second thing I need to do is have more and more choices. Third thing is that people want quick delivery. It's like when you order, he's like, my thing is that how do I make logistics more efficient? How do I make the product go quicker to your place, It's not like when we order food or something, we want it immediately. We're hungry right now, want it after 5 hours or something like that. So he's like, these three things I need to concentrate on: lower cost, more product, and faster delivery. So he's saying that's not going to change ever. So I'm more concerned about those things. When it comes to investing and what are we looking at, so what is not going to change in investing? Partnering with good managements is not going to change. If there's a chore management 100 years back, he's going to swindle you. Today there's a chore management, he's going to swindle you. 100 years from now, chore management is going to swindle you. So partner with great management or good promoters. Secondly, buy low, sell high. Fundamentals matter. So there will be sometimes spikes in, sometimes cryptos and all will come. But in the end, you need to fundamentals need to be in check. Fundamentals with obviously growth prospects. So that's not going to change. So the way you make money is buying low and selling high. Not the other way around. So concentrate on fundamentals. Concentrate on good companies. And thirdly, from a business point of view, people, when you're dealing with people's money, they want quicker resolution of their queries, or they want faster transactions. So the other thing is, from a business point of view, is obviously try to get your tech in place and make sure that clients are well serviced, and those are the 3-4 things that we would concentrate on.
So, just broadly speaking, throwing it out there, but what are the couple of themes that are really exciting you going forward? I mean, would it be, everyone's talking about chat AI, we've got big tech investing in it all over the place. Would it be ESG? Would it be, something I haven't thought of? What would be the one theme that's really exciting you as investors, whether it be, globally, whether it be here or overseas?
So in India, we're actually pretty, we like the banking sector, the financial sector, I think that looks really attractive. Again, PSUs after a long time look slightly attractive. And if we could invest abroad, because right now there is a limit that we can't invest abroad, then we would definitely look at big tech to invest in right now.
Okay, so staying on your radar then.
Yeah, I think in terms of, exciting. And this is where, I think things have flipped over the last, 2 years. There's this two styles of investing, value investing and growth investing. And over the last decade or so, growth investing has been the dominant sort of way of, wealth creation for a lot of investors. What was expensive 10 years ago is even more expensive today. And what was cheap 10 years ago was even more cheap. And what we've seen over the last 2 years is that, investing is actually, there's been a certain shift where a lot of these value companies, the PSU stocks, the energy stocks, the utility stocks, have actually come back in a very big way. So I do believe that in terms of what's exciting, what we've seen uncover over the last 2 years is actually exciting is not as exciting anymore. The non-exciting is the one which is actually, done really well in terms of performance, not only in India, but also in the US. In the US, every single sector is down from its peak since the early 2022, except energy, which is up 60%. In India as well, if you look at the sector profile, a lot of these, stocks which were labeled junk stocks, say, 2 years ago, have done astronomically well over the last 2 years. So I do believe that, there has been a certain shift. And in terms of, going forward, it's really hard to say, which sort of camp is actually, going to do well over the next decade.
Interesting. So if you had to diversify within, your pickings in the overseas market, would you be choosing between some of the other sectors? Would you be looking at energy? He's clearly big tech. How would you break it up? I'm just curious.
Yeah. So, as a mutual fund house, when it comes to our international funds, we're purely passive. So, and I think passive makes a lot of sense, even to me, because, I think it makes the selection a lot easier. for investors who are looking to diversify internationally. You don't have to worry about, which stock to buy, which stock to sell. It's coming at you at a very reasonable cost. And it's something which has been there for, half a century. The first S&P 500 fund was launched in the 1970s. Its track record goes back almost 100 years. So I think I head passive funds at MOMC, and the reason why I like, investing in passive funds is because mutual fund has simplified stock investing, but passive funds have simplified mutual fund investing. And I think the simplest way to wealth creation for most people ends up becoming the best. So I think, especially when it comes to internationals, because there's hundreds and thousands and millions of options out there. So I think, and also I think what we've learned over the last 10 years is that information arbitrage is also becoming a lot harder, especially in the West, not yet in India. So I think really keeping it simple is what has become a default and a very good strategy for a lot of investors.
Do you think, Prateek, that we are going to see a recession in the US? What's your call on this?
Yeah, I think in terms of macro fundamentals, what's funny is that, even my reading has been diversified, so I used to read Indian news now, and now I feel like, reading The Economist and FT has become a lot more value creative because a lot of changes in the West now impact India. But in general, what I've seen is, and this is from my readings, is, when you see interviews of CEOs in Davos, there is this, sort of a lot more, the body language is a lot better from where it was last year. I think in terms of, just simple macros, I think, interest rates have sort of, at least long-term interest rates are now, plateauing, which is great. You have obviously had inflation, which was also, coming down. I think China was a big problem point last year, even that's sort of opening up. And also the global supply chains, which was an issue last year, is also sort of, loosening out. So, and also Europe's energy problem is also going away. So overall, you could see a much better body language from a lot of them from my end. I think that's, and I would say they're in a slightly better position to see what's coming than we are. So I think from that, I could say that we're definitely in a lot better position today than what we anticipated a few months ago.
Okay. And if I had to push you, Neil, and I know you may not want to talk stock specific, but if you had to choose one of the FANG stocks or any of the tech stocks, what would be your favorite and why? Even if it's beaten down today, but you're like betting on it coming back.
Yeah, I think, I won't give you one, I'll give you three. Okay, so if I had to buy personally, and I don't know what the fund will do and all, but if me personally, I'd probably buy Google, Microsoft, Amazon.
Awesome. all the three big ones. Okay.
What about ChatGPT?
What about?
That's too early.
Too early to say.
ChatGPT. No, it's clearly on everyone's radar. We're going to be hearing about it sooner than later, I think. 10 billion, right? Microsoft just put in.
Yes.
Yeah, so it's not going away anytime soon. Gentlemen, thank you so much for joining us. A big round of applause. And hope from this conversation that everyone takes away to remain invested somewhat in the overseas markets. Thanks so much.
Thanks.
As we reach the culmination of a fantastic summit today, some of the biggest voices in the stock markets sharing with you how to really chase alpha in a VUCA world. Just making sure my guests are in the room. Okay. Okay, could I request everyone to take their seats, please? And if we could close the doors so that there's not too much noise at the back. If everyone could please take their seats, I'd really appreciate it as I look to welcome our next session. In conversation with Udayan Mukherjee, Global Business Editor at the India Today Group, I'd like to welcome at the Market Today Summit, Ramdev Agrawal, Chairman and Co-founder, Motilal Oswal Financial Services, Shankar Sharma, Founder, G-Quant Investec, and Nikhil Kamath, Co-founder, True Beacon and Zerodha. Welcome, everybody.
Good evening, ladies and gentlemen. Now we come to the meat of it. Through the day, you've heard lots of things about the macro and all of that, but this is what you've come to hear, how you make money and how you beat the market. Three very experienced practitioners of all that with me. I don't need to introduce them. Ramdev, Shankar and Nikhil, all of them you know very well. Nikhil's the youngest, but he's been remarkably successful with Zerodha over the last few years, so my hat's off to him for what he and his brother have achieved over the last few years. He's also the most handsome man on stage of all of us, by quite a distance, though Shankar would dispute that. But Shankar, what's going on? In the last year, 60-70% of the PMSs and the mutual funds who investors pay 2-3% a year to manage their money have underperformed the Nifty. When you ask them what's going on, sometimes they say, last year they said because it was commodity stocks and we don't own commodities. This year they're saying because they were those rubbish PSUs and we don't own them naturally. What's the right way to look at it? I mean, it's only when their blue chip HDFC Bank does well, they are expected to beat the market? How do you explain this kind of underperformance? The lack of alpha?
Yeah, so last 12 months, I think it was Adani Group which was the problem area.
Nobody had them.
Nobody had them. And to be fair, I mean, let's be fair that fundamentally a lot of the stocks that did well, particularly this group, could not be justifiably held in a fund structure. You could hold it in your personal investing because, it's okay when then they go up 10 times or maybe 20 times. But there is no real, if you say fundamental on the ground reality because of which these valuations were deserved. I'm not disputing that figure is incorrect. All I'm saying is justifying that for a fund manager to his shareholders, to his investors, to the unit holders, to the regulator, if something were to go wrong, becomes a major problem. So you cannot play every game that is being played in the markets. It's not possible. So to be fair, the underperformance has come because of this one major factor. The Nifty has done better because of this. If you look at the difference between the Nifty and the small cap, that itself is telling you a lot of things. That small cap on an index level has not done as well. So, but the fact is there will be something that will do very well. People are underinvested. And the law of the market is very simple, that the money gets made where people are least invested. And there is no real reason why you should be investing in the least invested. But usually that's the place where you end up making most of the money. And unfortunately, the incentive structure for a fund manager is geared towards retention of assets and hopefully some growth. It is not really a structure in which you're being paid to take a fair amount of risk. And that stems from the investors into fund or PMSs. And I can tell you, I've run these structures, and investors are their worst enemies, I can tell you this, because what they want is an impossible set of combinations. They want you to beat the market, they don't want you to lose money when the market falls, all in the same stock or the same group of stocks. That's not possible. These are impossible objectives to manage at the very same point in time. It's not going to happen. And which is why you will find an odd fund which took the bet, let's say on Adani or in commodities, they will beat the daylights out of the market for a year. Okay, whether they'll repeat it or not, who knows. So the short answer to your question, Udayan, is that it's been a very tough environment in an organized form of fund management. Very, very, very tough. The headline index is not telling you what the underlying trade change has been. HDFC banks or levers or Asian Paints, they have been dogs, while the underdogs have become the big dogs. Welcome to the markets.
Yeah. Ramdev, what about this trend of public sector stocks, which did very well? And many fund managers traditionally have not owned these names, the Coal Indias, the Power Grids, NTPCs. What do you do as a fund manager when you see these kind of stocks coming back and beating the daylights of your core blue chip holdings?
So it's a problem in the sense that the markets are markets and...
Is your mic working?
Yeah.
Yes. You have to hold it closer.
Yeah. So markets are markets and they will go, like one of the things which is happening is that because of sustained fall in the interest rate for last 10, 12 years, there was a method of madness in the sense that all kinds of growth story, whether it is profit making or not profit making, they are going through the roof. Just 12 months back, we were talking about Zomato and Nykaa and all. Today we are talking about public sector bank. Just see the contrast. What do you expect? Fund manager cannot move 1 lakh crore from, I'm not saying that Zomato and Nykaa, but say from Avenue Supermart or Asian Paints and all those bluest of blue chips to, so that's not the mandate. I would say that it is impossible to do it. So, but that's what market has done. So I think there is somewhere very deep, I'm all the way growth investor, good time, bad time, but clearly somewhere value is asserting. There is a very strong value rally right now. Maybe it was overdone on growth side, and even the decline in the interest rate was also overdone. So, like whatever the pendulum is swinging from that 18%, 10-year in 81, 82 to literally zero to now maybe 3-4%, but definitely not minus 20. So from 0 to maybe 3-4%, 5%. So there is a clearly change of cycle there, and we are still struggling with accepting it. What has happened. But even now, today, the same companies are still cheaper than your growth companies.
True. Nikhil, is it driving local investors?
To add here,
Sure.
as a follow-up answer to your question, Udayan. In the 90s, most of us were born in the 90s in this business. And a lot of the mutual fund managers who have great 25-year records, who became CIOs and then some of them retired. I can tell you one thing. A lot of the performance actually stemmed from 4 or 5 years of from 95 up until 2000. And I'll tell you why. I'm talking the index beating. Because the tech sector, the TMT sector, okay, Infosys, Wipro, Z and all that, they did not have any participation in the Sensex. Okay, so the Sensex actually did nothing between 96 and 2000. If anything, it was probably down a bit. But everybody had tech. And they beat the daylights out of the index. Okay, they beat it by like 10-20% points every year. Now that put performance points into your bank, which you ate off for the remainder of your career for 20 years. So you cannot complain that, look, the market is moving in a direction where I am underinvested, because you were in a underinvested area which was not in the index, that did phenomenally well, beat the market. The market did not have those stocks in the index. So, the market cuts both ways. So we cannot really complain. I'm just pointing out historical facts so that we understand that the markets usually are a tricky place to be in, and we can't just make 1% for doing nothing.
True. Nikhil, is it driving a class of local investors towards passive investing? Because they look at the index and say, I pay 0.2%, just buy the index. And that's good enough from these fancy investors you pay so much money for to manage my money. Is that a fair point, or do you think active investment will actually beat passive investors in the medium term?
So, Udyan, it's a tough answer because we have an active management fund.
I know.
If you look at it historically, I think passive has done better. That 1-2% a year, if you were to compound that over 20 years, mathematically, I think it is quite hard for an active fund to beat a passive fund. And
Even in India. People think it's in the US. In India, it will be different.
Well, if somebody is charging 2% every year for 20 years, that's a significant portion of your corpus. That being said, I think active does better in flat markets or range-bound markets, and passive probably does better in trending markets. Considering how expensive the markets are today relative to the rest of the world, maybe there is a case to be made why active could do better in the next 2 or 3 years when Nifty doesn't give stellar returns. But over a long term, I think passive will continue to outperform because our fee structures are not efficient enough. I don't think anybody can really bring in alpha for a client charging 2%, having a distributor in the beginning who charges a fee and an exit load and all of that. I think it will be quite hard in that model for active to actually outperform.
That's remarkably candid of you to say it because you are in that game yourself. Are you doing something to disrupt that or change that?
Well, I would say we are trying, but I don't think we're doing anything significantly different to warrant a change to kind of, weigh the scale more towards the active narrative. We are charging much lesser and stuff like that, but I don't think that one thing is enough because we're still charging maybe 10% of carry, and to get that much alpha is quite hard over the long term.
Shankar.
I'll tell you one simple golden formula to beat the market as an active fund manager, okay? And that is if you get the bear market right. Because your biggest alpha will come when the market falls 40 and you're falling only 20 or 10. In a bull market, you will not be able to beat the index. Impossible. And therefore, if you have the skills to get a bear market right, and you fall half the market, you fall 25% of the market, you have put 20% point in the bag, and then you will gradually fritter it away over a 3-4 year period to still end up ahead in the game. And which is why it's an underappreciated skill to get the bear market right. Okay? And bull market, ultimately bull market, most people will have similar stocks. It's very hard to be away from, the consensus trade. So therefore, the skill where you can add value as an active manager is to get the bear market right. And occasionally, if you get that right, and I think every 3-4 years you will get a down year, just make sure you get that part right.
When is the next bear market according to you, Shankar?
I don't think it's happening anytime soon, which is a problem for active managers. Okay, it happened, 2 years back, in COVID. Now, if you were alert enough, you could have seen that. I mean, it was not difficult to spot that there was some degree of fall coming, not a bear market, maybe not a huge bear market, but I think from February 2020, there was enough data and the screen was telling you from Japan up until Italy, schools are closing down and everything. I mean, that was not like a SARS virus. It was very clear this was a catastrophe, a calamity, and they would have some impact. So if you positioned yourself through some hedges or if you could short in your structure, I think you would have made significant alpha. Right there, in a month, you could have been up 20% relative to the market if you were smart enough to do that.
Ramdeo, you've had a very long career in the market. How do you do it? Because every year, there is some distraction. Sometimes it is digital stocks, which you may or may not own, which are going up. Sometimes it's commodities, which are having a bull run, which you may or may not have. Do you just say, I forget the noise and stick to my 20 stocks, which I know? Because it's easier said than done, right?
More like if you ask me personally, I'm more like a prop investor who doesn't care so much about 12 months appraisal. And I'm buy and hold. And the longer run, if there is in the QGLP framework, if you have bought good quality stocks at reasonable good price, and your holding period is long. See, even if you get the price wrong to start with, but if your holding period is 10, 15, 20 years, then what happens is that even if you have paid a little more, it doesn't hurt. The growth G is equal to R. That's what I practice and it used to work very well. But what has happened is that the kind of stock prices we have seen in last 5-7 years, even today, is absolutely absurd. We used to get good stocks in 90. Our problem is that we have seen 40 years of the market. And we have seen Asian Paints at 17, 18 P multiple and we didn't want to pay 15, 16. You know, that's the kind of history we started with. Then it became 22, 25. Now you are talking about 80 or 100. That doesn't fit into my psyche. You know, so that's a bigger challenge. How do you buy at 80p and still make money? That doesn't work with me.
I know, but sometimes does it lead to you making mistakes? Like last year, you did buy some digital stocks. Do you regret that? Was that a mistake?
Yeah, that was a clear mistake.
Which one did you buy?
I bought Zomato.
Only Zomato?
Only Zomato.
If you, on hindsight, would you have bought it or you should not have ventured?
I should have not even bothered. See, actually, I don't bother about any IPO.
Why did you buy it then?
But
it's
you know,
not
my
your kind
fund
of
managers,
stock.
they were on my head. They were telling me, sir, use your office to get some allocation. I mean, I'm telling you, this is the truth. So, you know, then for me also to pick up the phone and talk to the company, they convinced me, sir, this is a terrific thing. So that's how, and then you get sucked in. One guy, two guys, they have better degrees than me. So, you know, you start, and then environment is like that. There's so much of demand. The management is worshipped. They don't come to Mumbai. You have to come and meet. They don't even declare quarterly results properly. They have their own formats. All kinds of nonsense. And still you get into that. See, that optimistic market, you get this. Last time in 2008, I got sucked into Central Bank of India. Can you believe this?
Central Bank of
Central
India?
Bank of India. At the peak of 2008 boom, I ended up buying Central Bank big time. So you get sucked in. Because then right now nobody wants to believe PSU Bank. I'm telling you, in 2 years' time, the most coveted blue chips will be PSU banks. PSU banks. Because there will be sustained performance. This is a credit cycle. Credit cycles are 3, 4, 5 years. This is the most reliable cycle. If there is one, any cycle which is reliable is credit cycle. So 3, 4 years, once say it has started turning around. We have only published a report. Motilal Oswal has published a report where they are saying that PSU banks, they made losses 2 years back. Aggregate, they made 10, 15, 20,000 crore losses. And I think 24 or 25, they are predicting 1 lakh crore plus profit. Now, market is not going to be, I mean, they won't be discounting at 5p multiple only. So 5 goes to 10, and the earnings come to 20, say 15, 20% also. You see what kind of stock performance is going to be there.
Okay, that's a stock record right there. Nikhil, what do you do with the problem that Ramdev just described? Because, you know, I've heard you talk about that as well, that some of these valuations you cannot just justify. Yet, Asian Paints goes from 50 to 60 to 70 to 80p multiple. As a fund manager, how do you look at that when you see this explosion in multiples happening?
Well, it's hard, Udyan, but I think these valuations correct from time to time. Maybe not inside of a 10-year cycle, but longer than that. For a fund to have the freedom to kind of have a higher allocation to things like debt and commodity, I think become increasingly relevant. So when you see valuations are so high, if I have the freedom to have 50% into debt and commodity, for example, I think that helps a lot in catering to this particular problem. But like Ramdev was saying, I agree with him. Many times I think we are forced to take some kind of an allocation or participation because there is pressure from investors on the fund. But I guess because of what happened last year, I hope people wisen up this year and next year because I don't think the retail will treat them so kindly when they come into the market with not too much profit but crazy valuations.
But I remember you did not make that same Zomato mistake last year. We spoke once and you said at 125, there's no way, gun to my head, I won't buy that stock. Have you changed your mind at $50 to Zomato?
Well, I still haven't. See, I'm also a part of the startup ecosystem. And I kind of meet and know most of the unicorn founders and we all hang out and stuff like that. This problem of not being able to raise money at the valuations of last year, I think we're at the very beginning of the pain. I don't think we have seen it yet. The cost of capital for a foreign PE or VC was probably 2% last year. Today it sits at 6%, and their risk-taking ability will totally be changed by virtue of that. So there will be down rounds. If people in America are firing 10% of their workforce, and I'm not talking about companies that are not profitable, but companies which are in some cases sitting with billions of dollars of cash on their book, if that is going to happen there, it will also happen here. I think the timing is something one cannot call. So I think the next year or two will be reasonably hard, not just in the West, but also in India.
Shankar, you're about to launch. No, I will ask you about tech, but I want to ask you more urgently about the stuff that you're getting into now, which is small caps, which is what people want to hear about. Do you think in this kind of environment, small caps will end up beating large cap blue chips hands down? Your fund is going to be largely a small cap fund, right?
Yeah, no, the fund is different. Fund cannot do only small cap, because I've always believed this. Investing in small caps is like joining the mafia, right? It's very easy to enter, but it's impossible to exit. So you have to be very, very careful when you talk small caps. There are all kinds of companies out there, and I was in Dubai, on Sunday, and I thought Sunday was going to be a relaxing day, and I ended up having 5 meetings with 5 small cap promoters on a Sunday.
Indians?
In Dubai.
No, Indian promoters.
Indian promoters.
All of them.
In Dubai, who had come to see me, and they said, Sunday ko kam se kam aaram karne do. I was catching a flight for Bombay that night. So there is this all kinds of promoters crawling out of the woodworks. Each one has a great story. But I can tell you many will fall by the wayside, and therefore it is a very treacherous area of the market. I just want to be very clear about it. However, my view is this, that yesterday's story is over, meaning your Asian Paints, HDFC Bank, Kotak Banks and all that, they are not going to give you any money worth the while at all.
Not even beat the index?
No, I'm 100%. I've been clear for the last 2 or 3 years, okay, because there was enough data to show that they had run out their course in terms of valuation expansion. And now, even if they grow, the multiples will keep compressing instead of the multiple remaining constant or expanding. Okay, so I've been very clear on that trade, and some of the numbers, HDFC Bank, not bad, but the market is already saying that, I've had enough of this. So the trade has changed. Fund managers may or may not change, but the trade has changed, right? So small caps is where money will get made. It is also the place where you'll get taken out to the cleaners for sure. So if you want a simplified back of the envelope advice, buy 50 of them, put 1 or 2% of your investable capital into each, and then hope that 5 of them will become 20x or 40x, which statistically will happen. It has to happen. That's the way the game works. If you think each of them is going to be 20x, forget about it. Many of them will become reverse compounders, meaning at the price you bought, they will keep halving from every price till they go to 0. And, you will see that happening. But I just wanted to add to what Nikhil was saying, and the venture capital ecosystem has distorted the whole spectrum of IPOs, of valuations, everything. And we saw that story 22 years back in the dot-com boom as well. That time people had a website and hence they got valuation. Now people have an app and hence they get the valuation. Okay, but there is nothing in the middle. Okay, so I was looking at the data, broad, back of the envelope. Which are the greatest companies in the world? And first of all, why do you call a company great? Okay? In my view, there is only one metric that defines a company's greatness. Sustained long-term returns to shareholders. You can make money, lose money, free cash flow, not free cash flow, ROE. Nobody really gives a damn. Agar 10-20 saal mein you are compounded 20% plus, you consider it a great company. Now look at the history. Apple listed in 1985. I think Microsoft listed around the same time, a year later. Okay, they were in their infancy. They were virtually in a garage or just outside a garage. Tiny companies. They listed right there. Amazon listed 1996, within I think 2 years of starting the bookstore. Okay, very early in the journey. Infosys listed 1994, almost like it was still a startup in every sense of the word. Correct? HDFC Bank, it listed when it was Worli and a few other branch offices. That defines how much returns your stockholders make. And all these are great companies in hindsight because they listed very early in their corporate journey. They did not have venture capital coming in the middle, providing the unlisted capital, whipping up the valuations, and then IPOing out when the businesses or the growth cycle was kind of coming to a near peak. And they distorted the entire return spectrum by capturing the return from start to the midpoint for themselves and then leaving the stock market, the IPO market, to fend for itself by listing those companies when they've already more or less sucked the juice out of the returns of those companies. So my view is that small cap investing, I am saying to every promoter who's got a good business model, please list as early as possible. Let the retail be your venture capitalist. In which case they will lose money in some, but the 20-50 Xers will come out of those because what is being taken away by the VCs should now come to the retail investor.
Fair enough. Ramdev, how do you go about investing in mid caps and small caps? Because, you know, that is what causes such a lot of excitement for the retail investors. You've had tremendous experience with successes, but you've also had your failures. Can you just give us one or two examples of mistakes you made? What are the ones which really worked out and what you took away from those?
Yeah. Then, you know, what I've seen in last 20, 30 years is that the opportunities come. See, you have a framework. I work with the framework. I have a framework. I'm looking for a certain story to build up. And say, I saw first time mobile phone and I was damn excited. It's a network business. I had read a book by Michael Mubison and how it is going to work. Now, I was looking for a network business opportunity in 2003. And Bharti came with IPO at $45. Immediately they beat it down to $19 because it was making losses. Same situation like what is happening now. So they beat it down to 19-20. We didn't know. I was very clear at 45 it is useless company. So the banker was known to me. He was saying, you guys don't know how to value a mobile company. At that time, mobile was a new frontier. So I said, you guys don't know how the stock market works. यहाँ जो दिखता है वो बिकता है. आप प्रॉफिट नहीं कमा रहे तो हमारे लिए जीरो वैल्यू. You are useless. मतलब don't talk to me. आप करो जो करने का. Then in 2003, Sunil Bharti Mittal announced we are broken even. Then you could see it's a quarter on quarter 25-30% kind of growth. So I'm all the way growth investor. If I can find a company in mid cap is a good place to start. Small cap is they're small because they need to be small. Kind of useless fellows. So, you know, like they cannot think of big. I mean, HDFC Bank, I know, I was the first investor at $40 when 1,000 crores market cap was there. So, very small is, I would think they will never make it to the big board. It is the mid-sized companies like iShares, your Bharti, or even HDFC Bank. When it started, I think it was less than 100 rank company on day one. Infosys at 400 crores or 500 crores they started. That time it was a little obscure in terms of software, but still they were not that small. I mean in 93, 94 to have 400 crores market cap was good. So I think we should start somewhere at the mid or something like that. And there if I get a story which I think, because I read the paper every day, it is a surprise to me that this kind of story can build up. Return can be very high. That's where I think I have made money, and I think there are enough stories.
No, one mid-cap mistake you made, just to illustrate to the audience what you should not be doing. A recent example of a mid-cap mistake that you made.
So I told you.
No, that's digital. That's a different league. I mean, regular company.
Yeah. So there was. I don't want to name the companies. Don't like it.
Come on, you just said.
Okay. So I got the story of Sterlite Technology. When the,
Sterlite Tech. Okay.
Yeah, Sterlite Tech. When it was making only that digital cable. What is that? Optical cable.
Fiber cable.
Okay, and there was a boom globally. I didn't know the difference between commodity and consistent companies and those kind of things. And it was seriously making a lot of money. I heard about this story at $100. By the time I could make up my mind, it was $300. And by the time I bought it, it was 500 rupees. The moment I completed the buying, so don't chase your stocks too much. You know, so the moment I bought, I saw a price of 750, and before I could enjoy, it was again dropped to below my purchase price. And by the time I sold it, I must have sold it 50% loss. So and now I think the fight is even more deeper. Cost of getting entered into a smaller company is extremely high, And if by chance you go wrong, then you are completely cleaned up by the time you get out. And particularly when you are running public money, it's a nightmare. Yeah. If you're running a private money, still you can pace it up. Your quantity will be small. So I think audience, if they are running private money, perfectly all right to do small cap, even small mid caps. It's actually, that's the place, actually they have the advantage. The upper side is so intensely researched. I mean, the managements tell us, this is, I'm telling only to you. Okay, when you come out of the room.
In front of a few hundred people, it's all right.
So when they come out of the room, the next guy says, this is what he told me. So everywhere he is telling the same thing. I'm only telling to you. So you have no advantage in the large caps. True. Even management is trying to give you something which he doesn't know about the company. And it's already priced in. So I think, guys, we have to be very careful when we are buying very large cap. It is better that fund managers only battle it out day in, day out. In mid and small, you have a great chance to be ahead of the market because that is not being researched.
Nikhil, what's your recipe for creating alpha? Because there are various approaches. Some say you must have a long-short approach. You buy some and you short some. Some say do a multi-asset play that will smoothen out the rough edges and you will create alpha. What's your strategy?
Well, what we've been trying to attempt is the multi-asset class approach. But to be candid, Udian, I don't think there is a recipe because we haven't figured out how to do it yet.
Okay.
What we are attempting to do is take advantage of many discrepancies in the market to try and create as little as 20 to 30 bips of alpha a month. That's what we set out to do. We've largely done that over the last 3 years, but we've been able to do that because markets were not as efficient then as they are now. And progressively, as they get more efficient, it will get harder for us to find that alpha. We also have a mandate that we stick to large caps alone. Unlike what he was saying, Mr. Ramdev was saying, I find it easier to invest in large cap companies because I do not have to worry too much about the compliance and governance aspects of them. When you go to a smaller company, you need to put in incrementally a lot more work and you will still be wary of whatever is being reported is above board. So I recommend that, investors as well, whenever you're looking at companies, stick to something that 100 other people are researching because if something has to be caught, it's probably caught by then.
Except in Satyam, they never caught it. Don't you remember?
Yeah.
No, but the thing is, I agree there is hopefully better governance in the larger caps, hopefully. But, the fact is, we will make money where there is danger. Where there is extreme safety, there is no money. It's well discounted. Everybody knows it. And frankly, I think the biggest marketing success in Indian fund management has been that of a fund which marketed HDFC Bank, Asian Paints and all these old stories as something absolutely new and gathered.
He was here this morning.
I believe so. And gathered AUM when people are paying you money to buy HDFC Bank and Asian Paints. I don't think that the bigger set of idiots in this whole planet. Trust me. It's absolutely ridiculous. These companies are well discovered. They have great governance. They have great ROEs, great cash flow, great everything. And why should you anyway pay somebody to put money into those and only those? If you're putting that as part of a larger, little dangerous companies also, I can still get that. But just in those 10 names, I really don't get it. So the fact is there is danger wherever there is money. Okay, and that is what we are getting paid to do as professional managers, to sift out the least dangerous of this lot. Because if you just completely avoid them, then so many companies were small caps back then. Okay, in the 90s, which became huge companies. They are missing out on that chance to get the next Infosys or the next Bharti also.
Sure. Nikhil, what's the current strategy? You were going to tell us what are you doing right now to create alpha?
So, Udian, honestly, to second what I was saying earlier, we've reduced our equity allocation a lot.
To how much, roughly?
To about 37%.
That's it?
Yeah. We've increased gold considerably, about 10-15% gold, and the rest is in debt. Nowadays, you're getting AA paper, reasonably good paper at around 9%. if one were to assume stock markets traditionally give out about 10-11% a year, you really ask yourself, is that additional 2% worth all the volatility and all the chaos that comes along with it? So we have a larger chunk than usual in fixed income right now.
Okay. Shankar, one tenet of investing for many Indian investors is exactly the opposite of what you're saying. Basically, buy the blue chips and forget about it. In the long run, you'll be okay. But you're saying that will not necessarily work in beating the market.
No, I'm not saying it's either or. I'm saying you can do both. You should, and you should have a decent allocation. I'm not saying what is a blue chip is all up in the air anyway. A blue chip, in my view, is a company that makes money for investors.
So Asian Paints, HDFC Bank.
They are good companies. They may or may not be. I mean, I might want to buy their debt instead of buying their equity. But the point is very simple. It should not be an extremist approach that I'm going to buy only those and not this, and only the small caps and not the large caps. Ultimately, it's about balance, and balance will give you stability. It will not blow out the lights. Let's be clear about it. And investing, in my view, on a fund basis cannot be about blowing out the lights. It's about staying in the game without getting really injured in a bad. I mean, on my prop side, I'm willing to take that risk. I'm willing to meet 5 promoters on a Sunday and, lose money on 4, but make in 1, almost like a VC approach to investing. But on a fund basis, it's impossible. Nobody will, I mean, you will get killed if you were to adopt that kind of strategy.
Right. Ramdev, you just spoke to us about public sector banks, that the credit cycle is starting, next 2-3 years will be great for them. But we know that these credit cycles, they make a lot of money, but it almost always ends quite badly for them. After 3-4 years, there might be trouble again. I want to ask you about selling. How do you decide when to sell a stock and get out? Because everything is cyclical. It does well for a while, and then there is a time to sell it. Contrary to the theory that you should get married to the great stocks forever. When do you sell? When will you sell your PSU banks?
PSU banks, the moment it doubles, get out.
Just double?
Yeah. I mean, you have a price target, double, 50%, whatever. In 3 months, if you get 50%, run. Because this is not buy and hold, for sure. This time, I realized that buy and hold has to be with the consistent companies. The companies which have a terrific track record. I think what we invest a lot more on trying to understand the future. Actually, we should spend 2/3, 70-80% time in trying to understand the past of the company. And past tells you a lot more about the future. Because future is uncertain, very few can predict it. In fact, the entrepreneur himself doesn't know. You ask me what is the future of my company, it's very tough. Future is bright, for sure. But if you ask me a specific number, I can't give you. Actually, I don't have a number. So that's the case with all the entrepreneurs. They have very little knowledge, but unless they think that they know everything about future, without bothering about the past. Past has been completely wretched. They have not made money. Return on equity have been 2-3%. Pathetic track record. But from here onwards, it is going to make in their Excel sheet 25-30% compounded. And that's what we buy. So I think from here onwards, I'm going to focus a lot more on knowing the company's past. Not that I was not knowing, but even the companies I was holding, I was not knowing enough. So I think one message is very clear. Please know in every aspect of life, you do a lot more study of the past. For the marriage, for the hiring a manager, you look at the only past. Because the manager is going to say, I'm going to do all the wonders. So...
Okay. Shankar, what's the next couple of years going to be like for the market, you think? We've just come out of a very ordinary patch last year. We did better than the rest of the world, but returns were average. What's it looking like from here?
No, I think if I look at the world and just go analytically from Japan down to South America, there are very, very few markets you can make sustainable money. And about the only market I see is India. And of course, I look at, I see Turkey as being a decent bet. I put a lot of money there, and hopefully...
In Turkey?
Yeah, I've made a good amount. Actually, the index there is up 60% in dollar terms this year, by the way. It's beaten the daylights out of the Nifty. So it's been a good trade. So I mean, again, now there is danger. Everybody I talked to about Turkey said, "Tu pagal ho gaya kya sala? Ye koi country hai kya? Inflation 85%." I like such stories. Okay, I like those are the places. There's a lot of danger. So you will make some money there. So, but otherwise, I can tell you the mantra in investing is this: you have to be able to time the markets. You have to be able to time the cycles. You may remain invested, but invested in what? That's the key question. Sometimes stocks will do well, sometimes commodities will do well, sometimes your blue chips will do well, sometimes small caps. You need to be nimble. Fund managers are lazy. They are busier looking at asset gathering as a profession rather than being actively involved in understanding market cycles. And very few fund managers get that. I've been in the business long enough to know. Cycle nahi samajh mein aata inko. And that is where the problem of alpha generation lies.
Nikhil, last word with you. The few times I've spoken to you over the last year or so, you've sounded more circumspect than most of the others I speak to. I mean, they say India is a great story, bullish. You sound a bit more bearish. Why? I mean, are you still like that, or have you changed your view?
I'm still like that. I think it's a disservice to people when everybody on TV always says bullish stuff, you know. If I were a retail investor looking upon a TV channel for some advice, and everybody is constantly saying, you know, buy, 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 and I'm not talking today, but every year over the last many decades, it's the same story. So if nothing else, I think one voice on the other side is useful. But outside of that, on a relative basis, I find more opportunity today. Like, say, I'll give you an example. Meta in America at 13, 14 times earnings probably looks more attractive to me compared to many of the tech stories in India. And if one were to truly argue, they are spending a lot more money on research and innovation than we are back home here in India. So I think there are stories like that outside which are available at a discount right now. Like Tesla is probably 30, 35 times 1 year forward earning or 2 year forward earnings. So as an international investor, if I were to be looking to allocate money today, why I choose India when we have not corrected and the rest of the world has corrected so much, I still don't know why exactly I am wagering on India today versus those companies at the discounts that they are available. Everybody says the India story is great, but you know, if you go to another country, the narrative is the same in those countries in their own media, and people are saying exactly the same thing. For that reason, maybe I'm a little bit more skeptical than I have been in the past, more so this year than before, I think.
Great. Lovely hearing your thoughts, gentlemen, and to see you in the flesh after a long time. Thank you very much, all of you. Pleasure.
What a fantastic note to end the summit on, with Shankar Ramdev and, of course, Nikhil bringing us all those insights and the constant question, how do we time the markets? Do stay back and join us for drinks and dinner. And I'd like to also thank our sponsors as we close the evening. Powered by Radico, Spirit of Excellence, Exchange Partner NSE, Banking Partner AU Small Finance Bank, Mutual Fund Partner ABG, Financial Technology Partner Heckyl, Fashion Partner Gabbana, Energy Partner BeOne, and Digital Media Partner Daily Hunt. Thank you so much.